Hello students. In this particular video, let's have a discussion related to a very important topic for UPSC, that is the concept of taxation. Now, in terms of UPSC exams, where are the questions asked on taxation? You can expect questions on taxation in terms of prelims as well as in terms of mains. Now, in case of prelims, if you basically go through the last 5 to 7 years of question papers, there's a guaranteed question on the concept of GST from 2016-2017 when it has been introduced, and before that, there have been guaranteed questions on different concepts, different ideas under the ambit of taxation, and not just limited to the prelims. Even if you refer to the previous year question papers in the mains, there have been questions on taxation. Now, in this particular caveat, let's start the discussion on the taxation. Now, what we will be covering under this particular model? One, we'll start with the basics of taxation. Let's try and understand what you mean by tax, why it is imposed. Then we'll have a look at all the types of taxation systems. You must have heard of the concept of a direct tax, indirect tax. We'll have a discussion related to all the types of classifications of the taxation systems. Once we are done with this, we'll have a look at certain detailed discussion related to some of the types of taxes. And within this, the most important for you from the UPSC exams perspective will be the concept of a GST, goods and services tax, which we'll discuss threadbare extensively in this particular video. After this, we'll discuss what are the problems with the taxation structure in India, what are the various reforms which have been implemented by the government over a couple of years, and what kind of committees have been set, what are their recommendations. Then we'll discuss one basic idea of a Laffer curve. Now, in terms of a Laffer curve, you need to understand the concept, that's more than sufficient. And related to all of this particular discussion, we'll also have a discussion on the previous questions which have been asked both in prelims as well as in mains from this particular module of taxation. Now, let's start the discussion here. Start with the basics in taxation. Now, first and foremost, what do you mean by the term tax? What do you understand by the term tax? Now, please understand this. Every one of us, you, me, your parents, your relatives, everyone in the Indian economy as well as in the global economy would have ended up paying in one or the other way a tax to the government. Unless you're living in an isolated place, you don't consume anything, you don't purchase any services, no connection to the modern world whatsoever. Only in those particular instances you may not have given any kind of a tax to the government. But all of us who are living in this particular modern economy, in one or the other way, would have ended up paying certain amount to the government in the form of a tax. For example, if you're earning an income, government will collect income tax from you. If you're purchasing anything from the market, now it is collecting goods and services tax, that is an indirect tax for you. So in one or the other way, we all have paid certain amount of a tax to the government. Now the question is, what do you mean by the term tax? The tax basically is a levy that is imposed by the government. It's a compulsory charge or a levy that is imposed by the government. It imposes this and collects it from the people, from the companies. That is the basic idea of a tax. Now please understand this. These particular types of taxes could be imposed on the companies, that we call it as a corporate tax, could be imposed on individual income earners, we call it as income tax, could be imposed on consumption of goods and services that all of us purchase from the market, that is a GST. So different types of taxes are imposed and collected by the government. That's the first point. There's a very funny statement related to the concept of a tax. One of the experts basically says that every person will face a death only once in their lifetime, but the taxes will keep on incurring. This particular person will keep on paying taxes recurringly over and over again. So the taxes are paid, these are imposed by the government. There are different types of taxes. But the question is, why does government impose a tax in the first place? Why does it impose a burden on all of us? The simple reason to that is, one, it requires huge amount of money. Now you'll ask me, sir, why does government of India require money? Let's take a very simple example in the current affairs situation so that the point is very clear to you people. During the pandemic, which all of us have gone through, are going through and have suffered because of which, the government wanted money for developing healthcare. Government wanted money for developing other type of infrastructure. Government needs money to provide subsidy to the people, for example, free food grains to the people. So understand this, not just during pandemic, but even during normal times, government needs a source of revenue. In simple terms, it needs money, it needs to earn income so that it can incur expenditure. That is one very important reason why these particular taxes are imposed and collected by the government. Now, when I say government, please understand this. Central government will impose and collect certain types of taxes. State government also imposes and collects certain types of taxes. The direct taxes, which we'll discuss further, are generally imposed and collected by the central government, whereas indirect taxes are imposed and collected both by the state government as well as the central government. For example, taxes on petrol and diesel are both imposed and collected by both central government as well as state government, whereas a taxes such as, let's say, income tax, imposed and collected but later distributed between central government and state government. So this is the basic idea, or this is one very important reason why government of India imposes taxes and collects the taxes. This is the first very important function. But let's go beyond this. Government generally can raise money through various means. For example, have a look at this. Government can impose a tax, collect a tax, use it as a source of revenue. That is, it is one of the ways through which money is collected by the government for expenditure purposes. But is it the only way? No. There are different ways. For example, government can borrow from the market. How does government borrow from the market? Government issues certain instruments. Do not worry about this as of now. We'll discuss this in detail under banking. So have a look at this. Government can issue certain instruments in the market, which are famously referred to as G securities, and use it to borrow from the market. Let's take an example here. Imagine I'm the government and you're the investor. So I'll issue a security or an instrument to you and collect money from you. But based on the maturity of the instrument, it could be 3 years, it could be 5 years, it could be 10 years, it could be even 6 months. So based on the maturity, I will repay the amount with certain interest. But nevertheless, the idea here is when I'm issuing the instrument to you and collecting money from you, it becomes a source of revenue for the government. It becomes a source of money collection for the government using which it can incur certain expenditure. But what is the most important point here? The term borrowing is very, very important. Why? Borrowing basically means what? Today the government will collect the money, no doubt. But after the maturity period is over, it has to repay the amount. So it is not a one-sided flow like a tax. In case of a tax, it is a one-sided flow. What do you mean by one-sided flow here? Imagine you're the government, I will pay income tax to you. Imagine I paid 1 lakh rupees income tax in this particular year. This particular 1 lakh rupees is a simple transfer from my account to you people or to the government. In return, government doesn't pay back the 1 lakh rupees to me, nor does it pay any interest on the 1 lakh rupees. So the taxes are important source of revenue for the government for a simple reason. These are one-sided flows. Whereas on the other hand, if government borrows from the market by issuing G securities, then it has to repay the amount. Not only that, it also has to pay the interest on the borrowing. Same thing when government borrows from other countries also, or international financial organizations such as World Bank, such as New Development Bank, etc. So can government borrow from them? Definitely yes, they can borrow. But the important term that you need to focus here is the idea of borrowing. The borrowing essentially means you have to repay not only just the value but along with the interest. Let me give a very simple example. Government of India is developing one of the very important infrastructure projects under the Ministry of Railways. That is, I am referring to Bullet Train project. Now to develop this particular Bullet Train project, Government of India has taken a loan from a foreign country. Underline the term loan here. Why? No doubt today Government of India has got the money for developing this particular infrastructure, but after a certain period of time, it not only has to pay back that particular money, and it also has to pay interest along with that. So government can borrow from multilateral organizations such as a World Bank, such as a New Development Bank, but it is in the form of a borrowing. It has to repay it back along with the interest. Now another important source of revenue is concept of disinvestment. In detail about disinvestment, we'll discuss when I take a fiscal policy. As of now, simply understand this. Disinvestment essentially means Government of India owns these particular companies. These are referred as CPSEs, Central Public Sector Enterprises. Now Government of India, since it owns majority of the stake in these particular companies, government can simply sell out these particular companies in the market, or government can sell a part of the ownership in the market. But essentially, disinvestment is a process which is used by the government to sell ownership of a particular company which is owned by it and collect the money. Is okay? That particular process is called as a disinvestment. So through disinvestment also government can raise money, but the catch is the ownership of government in these particular CPSEs will start coming down. That is the catch there. So have a look at this. There are different different sources or there are different methodologies which can be used by the government to collect revenue like this. But the most important source for the government will be in the form of taxes. Government will be imposing direct taxes, indirect taxes, collecting a lot of money in this particular form of taxes. And generally, when you look at the budget documents, right, generally it has been seen that more than half of the total money that is collected by the government will be in the form of taxes. Now, how much is collected will vary from one year to another year. Out of total money collected, how much is in the form of a tax will vary from one year to another year based on the economic scenario, based on what is the rate of a tax, how the Indian economy is performing, how much is the earning and expenditure of the household. There's so many parameters which will definitely influence how much is the total tax revenue or tax receipts collected by the government. But generally, it has been found that more than half of the total revenue collected by the government will come in the form of a tax revenue itself. So this is one very important function of the concept of a tax. Second one, income redistribution. What's the basic idea of income redistribution here? Have a look at this. Imagine there are two people, X and Y. X earns 10 lakh rupees per annum and Y earns 1 lakh rupees per annum. So based on the income itself, we can simply deduce that X will be able to get access to better healthcare, better education compared to Y. Again, I'm not saying best education or best healthcare, I'm simply comparing both of them. Compared between X and Y, X will be able to provide better food for his family. He will be able to get better healthcare because he has got more money. Whereas Y will not be able to match X in this particular situation. So what government will do, because X is earning more, it will impose more taxes and collect more taxes from X. Is okay? It will collect more taxes from X, using to provide certain type of healthcare to Y, certain type of food grains to Y. Again, I'm just giving you a certain example. So basically what it has done, it has taken away some of the income from X and it has distributed that with Y. This basic idea is called as income redistribution. And because government of India runs huge amount of a subsidy program, government of India provides a huge amount of welfare measures for the poor people. It basically finances for all of these particular measures using these particular tax revenues. So this is basically the process where it is collecting more amount of a tax from rich, using it to provide a welfare social programs for the poor people. Income redistribution. The third function, promote savings as well as investment. What is the basic idea? Let me take a very simple example. Government of India says, if you invest a part of your income in the form of, let's say, public provident fund. Is okay? If you take your income and part of this particular income, if you take it and invest in a PPF like this, when I impose and collect income taxes on you, I will not collect a tax on this particular investment. What do you mean by this? Let me take a very simple example. Imagine your income is, let's say, 10 lakh rupees. I'm just taking an arbitrary number. It could be much more than that also. Don't worry about it. So imagine your income is 10 lakh rupees. And government of India, let's say, I'm just throwing an arbitrary number here. Government of India says, I will impose and collect 20% income tax on this. Is okay? Again, I'm not entering into the correct methodology of calculation of income tax. It is usually done slab-wise like this. Let's not worry about that because it is not important for UPSC. UPSC will not ask you to calculate income taxes. So let's take an arbitrary example or a hypothetical example here. Your income is 10 lakh rupees. And the income tax rate that is imposed by the government is 20%. And if I basically look at it on the face value, 20% of, let's say, 10 lakh rupees will how much? 2 lakh rupees. Again, I'm saying this is not the correct methodology and you don't have to worry about correct methodology here. So you are asked to pay income tax of 2 lakh rupees to the government. Now, government says, under various sections of Income Tax Act, if you make an investment in PPF out of this particular 10 lakh rupees, I will not take that investment to calculate your income tax. What does it mean? As per the present guidelines, up to 1.5 lakh rupees, that every individual invests in the PPF. PPF stands for Public Provident Fund. This particular amount of investment can be used as a deduction. What do you mean by deduction here? Have a look at this. Your income is 10 lakh rupees. If you don't invest anywhere, government will impose and collect on 10 lakh rupees income tax. But what you have done, imagine you have invested 1.5 lakh rupees in the PPF. So government will use this to deduct it out of the 10 lakh rupees. You are left with how much now? 8.5 lakh rupees. Government now will impose and collect income taxes on this particular 8.5 lakh rupees. So what it has basically done, it has promoted the concept of savings and has also promoted the concept of investment in the market. Again, this is one example. There are different avenues of investment that can be done, which will basically be considered as a form of a savings as well as investment. Government generally uses the tax policy or tax measures to promote all of this. So this is the third function. And the fourth function is to promote growth in the backward regions. Imagine government of India says, you develop this particular industry, you set up this particular industry in this particular area, I will give you a tax break of this. That is, in a sense, taxation policy will be used to promote industrialization in certain areas. So that is another very important function of a tax. So these are some of the functions which are important for you to understand why the taxation policy is used by the government. Now, once you have taken care of this, there's a small idea of a canons of good taxation system. Now, do not worry about the term canons here. Canons basically refers to the idea of a characteristics. Is it okay? You can use the term either characteristics or you can simply use the term feature. What is a feature of a good taxation system? I've listed 6 features here. Let's try to understand what are these 6 features. The first one, canons of equality. What do you mean by canon of equality? Please understand this. It basically says everybody should be imposed and collected the tax from. Is it okay? I'll repeat the statement here. Government should impose the tax on everyone and collect the tax from everyone. But the idea of equality here basically means impose the taxes on everyone equally and collect from all of these particular people. But please understand this. If I apply this particular canons of equality just on the face of it, that is, imagine X is earning 10 lakh rupees, Y is earning 50,000 rupees per annum. If I impose, let's say, 40,000 rupees of tax on both of them and say I've imposed or I've basically implemented canons of equality, this is unfair. Why? There is an idea of a canon of capability. What do you mean by this? Either use the term canon of capability or canon of ability. The basic idea is both of these particular taxpayers, X as well as Y, are not earning the same amount, are not on the same level of income. And since they're not earning anywhere near, how can you impose the same amount of a taxation and call this a canon of equality? That is the precise reason. Generally, this idea of a canon of equality, what does it represent? It doesn't simply say that equal amount of a tax has to be imposed. No, the basic idea is the amount of a tax that is collected from these particular taxpayers should be based on their capability to pay, their ability to pay the taxes. That is the first canon of a good taxation system. The second canon is canon of certainty. What do you mean by this? Canon of certainty basically means the taxpayer should know how much the tax is supposed to pay, how he is supposed to pay this particular tax, and what is the process that he is supposed to follow. Is okay? How, where, how much? All of these particular questions must be addressed under the concept of a canon of certainty. The canon is canon of convenience, which essentially means whenever the tax is imposed and collected from the taxpayer, it should not create inconvenience for the taxpayer. Although this particular canon says it should not create inconvenience, any amount of a tax that we pay to the government generally creates an inconvenience because it is the amount that is going out of our pockets. But the basic idea is, for example, let's take this example here. Imagine you have got your income on first of this particular month. Generally, what happens after receiving the income, you start incurring expenditure, and generally in the last 5 days of this particular month or last 10 days of this particular month will be difficult because the amount of the savings in the bank account will keep on depleting. You'll be worried about it. There is a situation of a cash trapping. That is, the amount of money that you have is very less at this particular point of time. You're waiting for the first of next month when you're going to receive the income again. Now, what if in the last 5 days when you have very less amount of money, when you are worried how can you sustain these remaining 5 days, government will ask you to pay taxes then. For example, income tax. So generally, it will create certain inconvenience for this particular taxpayer. That is the reason. Generally, what happens is, imagine here is a person who is earning income from a particular company. He is a regular salaried employee of this particular company. So what government says, I do not want to create inconvenience for this particular person by asking him to pay tax at any point of time. The company, before paying the income to this particular person, let the company withhold a certain amount of a tax. Is it okay? For example, imagine he's earning 1 lakh rupees per month because he's an employee here. And let's say hypothetically, I'll take a arbitrary number here. He's supposed to pay 15,000 rupees a tax to the government of India. That is income tax. So rather than full amount of 1 lakh being transferred to this particular person, which he will later use it to pay income tax to the government, what government says is the company, before paying the income of 1 lakh rupees, before crediting that into his account, let it withhold 15,000 rupees and transfer remaining 85,000 rupees into his account. And this particular 15,000 rupees, which is the income tax, should be transferred to the government by the respective company. So what it has done, it has created a mechanism not to create inconvenience to this particular taxpayer. That is a canon of convenience. Fourth one is the canons of economy, which essentially means whenever government will impose and collect a certain amount of a tax, it will create expenditure. Is okay? For example, government has to set up an office, government has to purchase certain systems, certain employees will have to be appointed in order to ensure that the taxes which are imposed by the government are collected. So in the process of collection of these particular taxes, in the process of all of this, government will incur certain expenditure. So what the canon of economy says is the expenditure incurred by the government to collect these particular taxes should not be very high. You should not incur high expenditure to collect these particular taxes. If your expenditure is very high, which essentially means you're spending a lot of money to collect these particular tax revenues, you better withdraw these particular taxes. That is the basic idea of canon of economy. Fifth one is canon of buoyancy. What do you mean by buoyancy here in the context of a taxation? It simply means whenever the GDP of any country increases, what is GDP? Gross domestic product. Whenever the economy of a particular country starts performing better and better, which is represented in the form of increased GDP growth rate, the amount of taxes which are collected should also increase. That is very rational. For a simple reason, if GDP increases, what does it mean? People are spending more. Companies are performing better and better. So because of all of this economic activity, don't you want the government also to collect more taxes? Definitely yes. So idea of buoyancy is when any country starts performing better and better, with improvement in the national income like this, with improvement in the GDP like this, the tax revenues collected by the economy, by the government should also be increasing. That is the basic idea of canon of buoyancy. And the sixth one, canon of diversity, which essentially means the taxes will have to be diverse. You cannot simply impose only one or two taxes and raise revenues from these particular taxes only. If that happens, it essentially means there is only few amount or few number of taxpayers who are feeling or who are taking the burden of total tax revenues in the economy. Let's take an example so that you understand the concept very clearly here. Imagine in case of India, there is only income tax. I understand the logic here. Imagine in case of India, there is only income tax. Whatever is the source of revenue that is collected by the government in the form of taxes, be it the central government or be it the state government, only it is collected through income taxes. So don't you think when only income tax is there, the house owners who are supposed to pay property tax, they are exempted, they are not feeling any burden. The consumers in the market who are purchasing certain goods and services, they are not paying any taxes, they are not feeling the pinch of the taxation. So essentially what has happened, only few people in the system, that is like the companies or the individual taxpayers, are bearing the burden of full amount of a tax revenue. That is not a diverse taxation. The taxation should be diverse in essence means all the income earners, all the stakeholders in the economy, all the people who are consuming goods and services, all the importers must be imposed with different types of taxes, and government should be collecting all of these different tax revenues. That is the basic idea of a canon of diversity. So these are the characteristics which will define whether the taxation system is good or bad. We have taken care of basics of taxation. What are the taxation systems? So different types of taxation systems. We'll have a look at different types here. Let's try to understand all of them. The first type is a direct tax and indirect tax. Very often, in the context of income taxes, they use the term is a direct tax. In corporate income tax, is a type of a direct tax. GST, indirect tax. What is the basic idea here, right? What is the difference between a direct tax as well as an indirect tax? Now, to understand the difference between both of them, before you need to understand two very important terms here. One is called as incidence of a tax, and the second one is impact of a tax. Is it okay? I'll repeat the terms here. One is incidence of a tax, and the second one is impact of a tax. What do you mean by incidence of a tax? Please understand this. Incidence of tax basically means who is the person who is bearing the burden of tax. Remember this. Who is the person who is actually paying this particular tax out of his pocket? That is the term incidence of tax. I'll give you an example, don't worry. Second one is impact of a tax. Impact of a tax means the person who is transferring, who is giving this particular money to the government. Is it okay? This is very important, so I'll repeat it again. Incidence of a tax essentially means the tax will be falling on whom? Who will pay this particular tax? From whose pocket the money will come actually. Second one is impact of a tax. So obviously when the tax is imposed and collected by whom? Government. So from whom the tax will be collected? Who's the first point from whom the tax is imposed and collected? Imposed and collected by whom? Government. So from whom the tax will be collected? Who's the first point from whom the tax is collected by the government? Now what is the basic difference? Let's try and understand this using two examples here. First one, income tax. In case of income tax, imagine here is a person X. He earns 10 lakh rupees per annum income. Now have a look at this. Government will impose the income tax on whom? This particular person X. And who will bear the burden of this particular income tax? From whose pocket this particular income tax will be collected? It is the same person X. So what has happened? In this particular example of income tax, the incidence is on X, the impact is on X. If I am earning certain income, which I am doing, government will impose income tax on me, and I will pay the income tax out of my pocket. And when I say out of my pocket, I don't literally take the situation where I'm taking money out of my pocket and giving it to government. No, from my account, from my income, certain amount will be deducted by the government. So essentially, it means I'm giving the income tax to the government. So incidence is on me, impact is on me. In such situations, these are called as direct taxes. These are called as direct taxes. Income tax is a direct tax. Corporate tax is a type of a direct tax. Okay. Now, on the other hand, indirect tax. Let's take an example so that you understand the concept here. All of you heard of GST. We'll discuss this in detail. Do not worry about it as of now. GST stands for Goods and Services Tax. Under the GST, what government says is the manufacturer will have to pay GST or the seller will have to pay GST. Let's take a very simple example. You go to a fast food restaurant, either KFC, McDonald's, whatever it is. Don't worry. You have gone there. You have purchased certain food whose price is 100 rupees. Now you take a pocket to pay 100 rupees, but the person who is selling this particular product to you will simply say, "Sir, 100 rupees is the actual price, but on this there's a GST of let's say 5%, which essentially translates to what? 100 rupee plus 5 rupee." But you basically tell him, "So GST is applicable to you." It's okay. You will tell the shopkeeper or the person who is selling this particular product to you, "So GST is applicable to you." But he will say, "Sir, yes, GST is imposed on us. We will pay this particular 5 rupees to government, but this particular 5 rupees I will not pay out of my pocket. What I will do is when you purchase the product, I will ask you to pay 5 rupees in addition to 100 rupees." Is okay. So what will he do? He will collect 100 rupees as usual, plus he will also collect 5 rupees GST. But this particular owner, or let's say shop owner, or a fast food joint, whatever it is, or a hotel, whatever it is, he will collect 5 rupees from you, but he will give it to the government. So have a look at this. In this particular example that I've taken here, the incidence from whose pocket this particular 5 rupees is coming? You, that is consumer or a customer. So the 5 rupees coming out of the pocket of the customer. But who is giving this particular 5 rupees to the government? It is the shop owner. Is it okay? So in this particular case, incidence is on us, for consumers. Impact is on the shopkeeper. So whenever incidence and impact are on two different people like this, it is called as an indirect tax. Is it okay? I'll repeat the process here again. Whenever incidence and impact is on the same person, it is called as a direct tax. And whenever incidence is on one, impact is on another, it is called as an indirect tax. That is the basic difference between a direct as well as an indirect tax. Let's go beyond this. Generally, we say direct taxes are more specific in nature. Indirect taxes are universal in nature. What do you mean by this? indirect taxes can differentiate between the income earners. Direct taxes can differentiate between the taxpayers. For example, generally government says if your income increases like this, the amount of the income tax that you're supposed to pay will also increase. For example, let's take an arbitrary number here. Government might simply say if your income is up to 5 lakh rupees, you don't have to pay any income tax. Again, I'm just taking an arbitrary example here. If your income is 10 lakh rupees, you will have to pay 20% tax. If your income is, let's say, more than 10 lakh rupees, you'll have to pay 30% tax. So have a look at this. When income is up to 5 lakh rupees, you don't pay any income tax to the government. When it is more than 5 lakh and up to 10 lakh rupees, you will end up paying 20% income tax. And when your income crosses more than 10 lakh rupees, you will pay much higher income tax. So what generally happens is in case of a direct tax, it can differentiate between the taxpayers. It can simply tell a taxpayer who's earning very low amount of income, don't pay any income tax. And the one who's earning very high amount of income, pay higher amount of income tax. So it can differentiate. On the other hand, the indirect taxes do not differentiate. Indirect taxes are universal in nature. What do you mean by this? Imagine you go to a shop, assume you're X, you go to a shop, and there is a billionaire Y who also comes to the same shop. Don't ask me why billionaire is coming. That is not the point here. So let's assume an income earner, but he's earning a moderate amount of income. And why is a billionaire? Both purchase, let's assume. Okay, both of you purchase, let's assume. Both of you will end up paying same amount of GST. So does the GST differentiate between X and Y? No, it doesn't differentiate. Assume there is another person Y who earns, let's assume 1,000 rupees a month, very low amount of income. He also purchases the same soap. He will also end up paying the same amount of indirect tax, that is GST. So indirect taxes do not differentiate between the taxpayers. Direct taxes actually do differentiate between the taxpayers. So in the system, when the taxes are collected, what we expect, what we want is more and more amount of direct taxes compared to indirect taxes. For a simple reason, direct taxes can differentiate between the taxpayers, whereas indirect taxes do not differentiate between the taxpayers. But in case of India, what generally happens is, if 100 rupee of a tax revenue is collected, total direct as well as indirect. If 100 rupee worth of taxes are collected, more than 60% of these particular taxes are indirect taxes. And somewhere around 1/3 plus are in the form of a direct tax, which essentially means we are imposing and collecting more of indirect taxes compared to direct taxes. And this particular system generally is referred as a regressive taxation structure. Remember this particular term. This is referred as a regressive taxation structure for a simple reason. In case of Indian economy, what we are doing, we are imposing and collecting more in the form of indirect taxes, which doesn't differentiate between a rich person, a poor person, a middle income household, and a billionaire. Right? So we need to impose and collect more and more direct taxes as it is done in case of OECD economies. In case of OECD economies, generally the structure is more than 60%, around 65% to be more precise, is in the form of a direct taxes, and the remaining 35% of the total taxes collected is in the form of indirect taxes. That is more of a progressive nature of taxation in case of OECD economies. So this is the discussion related to the idea of a direct as well as indirect taxes. Next one, progressive and regressive. I use another term here, progressive, regressive, and proportional type of a taxation. Now, what is progressive in the first place? Progressive means when the income increases, when the earning increases, the amount of a tax should also increase. Is it okay? As the income increases, the tax will also increase. That is the basic idea of a progressive taxation structure. For example, in case of India, income taxes operate on the same principle. As your income keeps on increasing, the amount of a tax that is imposed and collected by the government will also keep on increasing. That is the right approach. Second one is a regressive taxation structure. Now, in case of regressive taxation structure, please understand this. Whenever the income is low, the amount of a taxes collected could be high, and whenever the income is very high, amount of a tax collected and imposed and collected could be lower. Now, again, don't misunderstand the term regressive taxation here. Generally, government of India, for that matter, any government might use this kind of a regressive taxation structure. Let me give a simple example so that the point is clear. In case of India, the corporate tax rate earlier was 30%. Earlier. Now, very recently, this has been reduced to around 25%. I'm talking about the overall effective taxation rate. Some of the will tell you the corporate tax rate is 22%. They're also correct. I'm also correct. Now you simply say, sir, 22 and 25%. Don't you think both are different? Yes, I know both are different. But why there are two numbers given like this? 22% is called as a card rate. Remember this. 22 is referred as a card rate. On paper, how much is imposed by the government? But along with this particular 22%, government will also impose additional taxes in the form of assessors like this. That will basically drag this particular 22% to over 25%. That is called as an effective tax rate. Is it okay? So earlier, the corporate tax rate on card was 30% and effective was somewhere around 33%. Very recently, government of India has reduced this to a card rate of 22 and effective rate of over 25%. But please understand, if you are a corporate who is covered under this, you are paying a card rate of 22 and effective rate of 25%. But on the other hand, if there's a startup, and it is recognized so by the government of India, it can choose not to pay any taxes on its profits in 3 consecutive years. Is it okay? Again, what are all these particular guidelines with respect to startups? How do you define startup? We'll have to get it later. Don't worry about it as of now. If you're a startup and you're recognized so by the government of India says, on 3 consecutive years, you don't have to pay any income tax. That is corporate tax to the government. So have a look at this. On one hand, there are companies which are paying an effective tax rate of 25%. But on the other hand, there's a startup which has chosen to use this particular provision. It ends up paying 0 rupees to the government. So don't you think that there's a kind of a regressive taxation structure being used here? Definitely yes. But more importantly, government uses these kinds of taxation systems in order to achieve certain objectives. It is not blindly being used by the government. Don't think government of India knows that it is losing revenues here. Definitely yes, it knows that. But the objective here is not to show up, not to increase the taxes here, but rather to promote startups in India. So there are different ways through which government will be using this idea of a regressive taxation structure, but it will be in order to promote certain objective. And the third one is proportional taxation structure. What is the proportional taxation structure? Irrespective of the income, tax rate will remain the same. For example, imagine there are 3 companies like this, X, Y, and Z. Whatever the income is doesn't matter. The government will impose, let's say, 10% taxes on all of them. This is called as a proportional taxation structure. So these are the 3 types of the progressive, regressive, and proportional taxation systems. The next is ad valorem and a specific type of taxation system. Now, what do you mean by the concept of ad valorem and specific? Please understand this. In case of ad valorem, the tax is imposed and collected based on the value of the product. Is it okay? Based on the value of the product, the government will impose and collect the tax. That is called as an ad valorem tax. In case of a specific type of a tax, the government imposes and collects the tax based on certain physical attributes of the product. For example, it could be length, it could be a liter, it could be, let's say, breadth of the product, etc. Let me give an example so you will understand. Starting with ad valorem. Earlier, in case of Indian economy, the government had imposed a concept of value added tax. I use the short form here, VAT, value added tax. Now, in case of value added tax, how the system works, we'll understand that later. But under the VAT, based on the value addition, government would impose and collect the tax. So under the ad valorem, generally what we say is based on the value, government imposes and collects the taxes. On the other hand, in case of a specific type of a tax, government will impose the taxes based on certain physical attributes, based on certain physical characteristics of the product. Best example for this is the excise duty that is imposed by the central government. I'll use the full term here, central excise on petrol. So have a look at this. When central government will decide the excise duty on petrol, it generally decides on per liter of petrol. For example, imagine the actual cost of the petrol is, let's say, 60 rupees. The central government will simply say per liter, 6 rupees per liter. Okay, on this particular liter of petrol, I will also impose 10 rupees excise duty. Is it okay? Right now, whatever is the price of this, it could fall from 60 rupees to 50 rupees. Even then, it will remain 10 rupees. It could increase from 60 to 70 rupees. Even then, the central excise will still remain 70 rupees. Because this particular 10 rupees is not connected with this. Rather, it is connected with the volume of petrol, that is 1 liter of petrol, will attract 10 rupees. That's it. So that is the basic idea of or one example of a specific type of a tax. Right? Remember this particular example. Central excise on petrol is a type of a specific type of a tax where government will impose and collect the central excise based on 1 liter or per liter of petrol that you're going to consume. So this is the basic idea of ad valorem and a specific type of a tax. Now generally experts say that rather than being dependent on specific type of a tax, please shift it to the idea of ad valorem tax. Is okay, I'll repeat the statement here. Rather than being dependent or rather than implementing more and more types of specific types of taxes, please be dependent more on ad valorem type of a taxation system. Why? In case of ad valorem, certain flexibility is always given to the government. Whereas in case of a specific type of a tax, no, you do not have that kind of flexibility. Now you simply ask me, sir, what do you mean by flexibility here? Let me give an example. Imagine rather than imposing central excise on petrol in the form of per liter like this, what if government of India said, whatever is the price of the petrol, without the taxes like this, whatever is the price of the petrol, on this I will impose 10%. Is okay, I'll impose 10% tax on this particular price. Now when it is 60 rupees, 10% of that will be how much? 6 rupees. When it will become 50 rupees, the government will impose excess of 5 rupees. When it will become 80 rupees like this, increasing from 60, government will impose 8 rupees. Now what kind of flexibility am I referring to here? Have a look at this. In one system, if it is calculated as a percentage of the pricing like this, when the price of the petrol without the taxes is 80, government will impose how much? 10% of 80, that will be 8. So price will be how much? 88 rupees. On the other hand, whatever is the price, if government imposes a per liter 10 rupees like this, if the price of the petrol is 80, then the excise, including excise, the price would become 90. Now whether it is 88 or 90, it is costly. By any stretch of imagination, 88 or 90 rupees, yes, I know difference is 2 rupees, but for common man, this is costly. But in the first case where the government is imposing in the form of ad valorem tax, that is 10% of let's say 80, government will have certain flexibility. What kind of flexibility? Government might simply say, I'm reducing the tax from let's say 10% to let's say 5%. In that particular scenario, the taxation rate, if reduced, the market price will also come down. So that kind of flexibility is always there with the government under the ad valorem taxes. But in case of a specific type of taxes, it is very difficult for the government to reduce these particular taxes. So that is the reason various committees such as Ranjit Committee recommended that more and more of ad valorem taxes should be implemented compared to specific type of taxes. Next type of a taxation system, surcharges and cess. Surcharge and cess. Let's start with the first one, surcharge. Surcharge is nothing but a tax that is imposed and collected on the tax that is already paid by a taxpayer. I'll repeat it, I'll simplify this. Understand this? Surcharge is generally an additional tax which is imposed and collected by the government. And when I'm using the term additional tax, it simply means there's already a tax which is imposed. Is it okay? The taxpayer is already paying a certain amount of tax. In addition to this tax, he's also asked to pay a certain amount of tax. That additional tax is called as a surcharge. Let me give a very simple example so it is clear to you. Imagine here is a person X. He's earning annual income of, let's assume a hypothetical number here, 30 lakh rupees. Let's assume the tax rate is 20% here. I'm putting arbitrary numbers here. Let's not be worried about exact calculation, not important for UPSC. So have a look at this. When government says 20% of 30 lakh rupees, he's supposed to pay a certain amount of income tax to the government. But government says, you're not just earning 30, sir. You're earning much higher than what a common man is earning in India. Is it okay? You're not just earning 30 lakh rupees, you're earning much higher than what a common man earns in India. Per capita income in case of India is around 1 lakh rupees plus. So this particular person is earning 30 lakh rupees per annum. So government says, just 20% of tax on your income is not sufficient. We want to impose more taxes on you. So in addition to this particular 20% tax, government might simply say 10% surcharge. Is it okay? So in addition to 20%, he is also expected to pay 10% surcharge. This additional tax is called a surcharge like this. But please understand, this particular 10% is not calculated on the income like this. It is actually calculated on this particular 20%. Again, how it is calculated, what is the exact number, you don't have to worry. But surcharge is an additional tax which is imposed and collected by the government whenever income of a person crosses a certain threshold. In case of India, more than 1 crore rupees, there is a surcharge. More than 2 crore rupees, there is a surcharge. More than 5 crore rupees, there is a surcharge. Shift to the next one, cesses. What do you mean by cess? Cess is an additional tax imposed by the government. Is it okay? It is also a type of a tax which is imposed by the government. But the difference here is, in case of a cess, it is always imposed and collected with certain objective to be achieved. Understand this? The difference between a surcharge and cess, both are types of taxes only. But the difference is, in case of a surcharge, government wants to reduce the income inequality. Government wants to collect higher amount of revenues. Whereas in case of a cess, government imposes and collects this particular cess with certain objective in the mind to be achieved. For example, earlier there was a cess called as Krishi Kalyana cess. Now, by the name itself, you can understand what is the objective of this particular cess. There is a cess called as education cess, or to be more precise, known as become health care and education cess. Again, no prices for guessing for what purpose or what is the objective of these kinds of cesses. So government will impose and collect these particular cesses, but with certain objective in the mind. Now, in order to understand this much more better, let's go beyond this. Surcharges are more permanent in nature. Cesses are temporary in nature. Means what? Imagine government of India wants to achieve 100% literacy rate, and for that, it has imposed this particular kind of a cess. Once the government achieves 100% literacy rate, what is the meaning or what is the objective of collecting the money now? The objective has been met. So that is the reason we simply say surcharges are more permanent in nature. Cesses are temporary in nature. Surcharges are usually imposed in the form of percentages, whereas cesses are either they can be imposed on the value or they can be imposed in the form of percentages also. Right? So that is the basic difference between surcharge and cess. Now going ahead, both surcharges and cesses are imposed and collected by the central government. These kinds of cesses which are collected by the central government, generally it goes into consolidated fund of India, and central government doesn't give part of these particular cesses to any state government. Now you will be confused as to what I'm actually referring to. Please understand this. These kinds of direct taxes are imposed and collected by the government. For example, let's say corporate taxes, income taxes. Now when these are imposed and collected like this, don't you think that part of these particular taxes should also be given to states? For example, states such as Punjab, states such as Haryana, Madhya Pradesh, Uttar Pradesh, Gujarat, Tamil Nadu, Karnataka, Andhra Pradesh, etc., which are contributing very high amount in terms of tax revenues for the central government. Don't you want some of these particular tax revenues to be given to them? Definitely yes. That is the precise reason. Whenever these kinds of direct taxes are imposed and collected by the central government, these are put into a fund called as central divisible pool. Is it central divisible pool? From these particular revenues which are kept under this particular divisible pool, the Finance Commission once every 5 years will recommend how much should be given to states. Is it okay? One of the most important function of the Finance Commission is to give recommendation as to how to divide the tax revenues between the central government as well as the state. But not all the tax revenues. I'm referring to those particular tax revenues which are kept under the divisible pool like this. And the direct taxes which are collected by the central government are generally kept in this particular divisible pool. That is not to say that indirect taxes are not kept here. And indirect tax such as GST is also kept under this, but not completely. When I discuss GST, I will tell you about what part of the GST will go to this particular divisible pool. But more importantly, understand this: these kinds of the taxes which are imposed and collected by the government are not kept under the divisible pool. These will directly go to consolidated fund of India. But much beyond this, in terms of cesses, please understand. First, it will go to consolidated fund of India. Then these particular cesses will be transferred into dedicated funds. Remember this: these will be transferred into these particular dedicated funds. So what do you mean by dedicated funds? Government would have imposed and collected these particular cesses for a particular objective to be made. Now, if all of these particular cesses are put just in the consolidated fund of India, there might be a situation wherein these cesses are used for some other purposes. For example, government of India, imagine, has collected cess for education purposes. It has kept the money in the consolidated fund of India, but this the money has been used for development of a national highway. That is not allowed. So what government generally does is CFI, Conservation Fund of India, then basically transfer that into dedicated funds like this. And from these particular dedicated funds will be withdrawn for meeting particular objectives. So this is a discussion with respect to surcharges and cesses. Next, countervailing and anti-dumping duties. Okay, countervailing and anti-dumping duties. Now to understand this, two types of duties. First, we need to understand the basics here. Let's start with one example. I will bifurcate the picture here. On the left hand side, I will give you one example. Right hand side, I will give you another example. Please do not get confused. Let's start with the left hand side. Imagine here is a country X. From country X, goods are being exported into country Y. Now let's say here is a manufacturer who, when exporting, he has to export and sell it to the buyer in Y at 100 rupees. He has to sell it at 100 rupees. But the government in country X, understand this very carefully. The government in country X will tell the exporter here, for every 100 rupees that you are exporting like this, I will give you 10 rupees back. Is it okay? If you export the goods for 100 rupees, I will give you 10 rupees back. So if I'm an exporter here, I don't have to sell it at 100 rupees because I'm getting 10 rupees back from the government. So what I do, I will simply export it. Let's say 98 rupees. Is it okay? I'm just throwing arbitrary numbers here. In essence, what you need to understand, this is an exporting country, this is an importing country. Whenever the exporting government or the government of exporting country provides the subsidy to the exporter like this, it will reduce the price of these particular goods. It will basically make these particular goods much more competitive. What do you mean much more competitive? What if the same good is manufactured in this country, which is an importing country, but the cost of the production in this particular importing country comes at around, let's say, 102 rupees. So have a look at this. Because government has given a subsidy here, government has given an assistance, the products will become much more competitive in this particular importing country. Now this particular importing country will not be happy with this. Why? More and more imports keep on coming into the Y country. The domestic manufacturers will be affected. When the domestic manufacturers is affected, employment will be affected. The amount of revenue in the form of taxes collected by the government of Y will be affected. So understand this. In such situations, the importing country, to negate the subsidy given by exporting country, I'll repeat the statement, understand this very carefully. The importing country, to negate, to reduce, to offset the subsidy given by exporting country, will impose additional taxes. Anyways, whenever this particular product that is import will land into a particular country, customs and duties are imposed. In addition to this particular importing country, to offset the subsidy given by the exporting country, could impose additional taxes. These additional taxes which are imposed to offset the subsidy, or these are also referred as anti-subsidy measures. Remember the term. These are also referred as anti-subsidy measures or anti-subsidy taxes. This is referred as a countervailing tax. Is it okay? I'll repeat it so that it's clear to you, because you get confused when I discuss about anti-dumping duty. In case of a countervailing duty, what happens? The importing country has found that the exporter is exporting at a lower cost because he's getting subsidy from his government. Now this particular importing country is worried. Why? If the exports keep on coming into their country at cheaper prices compared to the domestically manufactured goods, people will purchase these imports only. So what government does is, in addition to the customs which is already imposed, or import duty which is imposed on the imports, it will add more taxes. And the objective is what? To offset the subsidy that is given by the exporting country. This tax is called as a countervailing duty. It is also referred as anti-subsidy duty or anti-subsidy tax. Remember this. Shift to the other side. Let's take another example. Here is country X, here is country Y. This is exporting country, this is importing country. Now follow the sequence very carefully. You are a manufacturer here. Is it okay? You are a manufacturer in country X. What you do is, actual cost is, let's say, 100 rupees. That is wherever you sell in other markets, or in the domestic market, you sell at 100 rupees. But you, when you export it to country Y, you will export it at 98 rupees. Is it okay? You can understand the difference between the first situation and second situation. In the first situation, the exporting is done at 98 because government is giving subsidy. But in the second system, in this second situation, you are exporting at 98 rupees. In essence, you are suppressing the prices. When you are selling the same product everywhere else, you are selling at 100. But when you are exporting that to Y, you are suppressing this particular price to 98 rupees. And you are exporting it to country Y. This is done in order to ensure that when this product will land in country Y, it will be cheaper. Cheaper compared to what? Cheaper compared to domestically manufactured goods. And when this particular product is cheaper in country Y, demand for these goods will be very, very high. And you as an exporter, you keep on exporting these particular products into country Y itself. This is called as a dumping activity. Is it okay? In case of a dumping, you artificially suppress the price, start exporting more and more to a particular country. That activity is called as a dumping activity. Now what is the problem here? Now the government of country Y will be worried about this. Why? You are dumping the goods in their country. They are cheaper and the demand for that is increasing, which is affecting the domestic manufacturing. So in order to control this particular activity of you, what the government here will do is impose a certain additional taxes because you are dumping. Is it okay? The normal taxes are imposed, the customs duties, import duties are imposed. In addition to this, it will also impose one more type of a tax which is called as anti-dumping duty. Is it okay? It is called as anti-dumping duty. So in the first situation, to offset the subsidy given by the government, impose a tax. In the second situation, to control dumping activity, impose additional tax. That is the basic difference between countervailing duties as well as anti-dumping duties. Now in case of India, now going beyond this, earlier there were different agencies which were basically investigating and implementing these particular types of additional duties. Now please understand, earlier there was an authority called as the DGAD, Director General of Anti-Dumping and Allied Duties, which used to investigate and recommend the duties such as countervailing duties, anti-dumping duties, etc. In addition to DGAD, there was another authority, Director General of Safeguards, DGS, which used to investigate and recommend implementation of safeguard duties. In addition to this, there was a DGFT, Director General of Foreign Trade, which used to give recommendations with respect to implementation of the quantitative restrictions to us. Now in the year 2018, what government of India has done is, it has taken all of these particular functions of investigation with respect to different types of taxation and has kept all of these particular functions under only one authority. That is, in 2018, government of India set up Director General of Trade Remedies, TR, DGTR. Now this is the authority which will investigate and recommend CVD, countervailing duties, anti-dumping duties, safeguard duties, and quantitative restrictions. And this particular authority functions under Ministry of Commerce. That is the first point here. And furthermore, you need to remember this: DGAD used to function under Ministry of Commerce. DGS used to function under Ministry of Finance. This is the second point. Third point: yes, it is a DGTR which will investigate and recommend implementation of all of these types of additional taxes. But it is the Ministry of Finance which will actually notify these particular duties. So all these points are important. Please remember with respect to countervailing as well as anti-dumping duties. Now, there is one more type of a tax that I forgot. That is the basic idea of a safeguard duty. Now, what do you mean by safeguard duty? This is another situation, third situation here. Let's say current affairs, you will understand what we actually mean by this. Government of India is actually promoting renewable energy projects. By 2022, we want to achieve 175 gigawatts of renewable energy, and furthermore, we want to more than double it to around 450 gigawatts. That has been the objective or target which has been set up by Government of India. But out of this particular renewable energy, there is one type of renewable energy, that is solar. To develop this particular solar energy projects, you require certain materials, certain inputs such as solar panels. In case of India, the material that is required to implement these particular solar energy projects is not sufficiently produced. As a result of this, we are heavily dependent on import of these solar photovoltaic modules. And this is short form here, SPV modules, solar photovoltaic modules. So we are heavily dependent on the import of these particular solar photovoltaic modules. We mainly are dependent on countries such as China. More than 80% of what we actually import comes from China itself. Now we are depending for a simple reason: the domestic manufacturing or domestic producers are unable to meet what is the cost of import. In a sense, imports are cheaper, imports are better in terms of technology. That is the precise reason we are dependent on this. Now, when these particular imports will keep on coming into India, understand this: there is no subsidy given here. There is no fault in terms of dumping activity. It essentially means that the domestic industry is unable to meet the competition of imports. In this particular situation, to safeguard the domestic manufacturing, to safeguard the domestic producers, government will impose a safeguard duty. But whenever these particular safeguard duties are imposed, the objective is, remember that, the objective is to protect, to safeguard the domestic industries for a certain period of time, during which they will also develop and start competing with the imports. For example, in case of India, to safeguard these particular solar photovoltaic manufacturers or producers, government of India has imposed the safeguard duties on these particular solar photovoltaic modules. But that is being implemented for a certain period of time. And the objective is, for this particular period of time, the domestic companies will start functioning more efficiently, and after the time period is over, these domestic producers will be able to compete with the foreign manufacturers and exporters. That is the basic idea of a safeguard duty. So this is a discussion with respect to countervailing and anti-dumping as well as safeguard duty. There's one more term that is left out here: quantitative restrictions. Let's not discuss that today, but definitely yes, when I discuss about WTO, I'll tell you about that idea of quantitative restriction. Now let's discuss the concept of MAT or minimum alternative tax. Now to understand the concept of a MAT, you need to understand certain basic points here. First, please understand this: the companies will have to prepare two statements, okay, or two basically annual financial statements. Now these particular two statements are one profit and loss account, and the second one is a balance sheet. Okay, so every company annually will have to prepare one profit and loss account and a balance sheet. In case of a profit and loss account, what we generally have is a list of the incomes and expenditures. And in case of the balance sheet, we have a list of the assets and liabilities. Okay, now look at this. I'll focus on the first part of the discussion here. That's a profit and loss account. Imagine here is a company XYZ. This particular company XYZ this year has generated an income. Using the term income, we can use the term revenue or sales turnover. It has generated income of, let's say, 500 crore rupees. And from this, there is a deduction of expenditure, let's say 300 crore rupees. So total book profit. Now look at this. The term that I'll be using is book profit. What is the book profit? 200 crore rupees. Now, the government doesn't impose corporate tax on the book profit, at least earlier. What they will do is, from this particular book profit, we will allow for certain deductions. For example, if there are depreciations, like the company is allowed to deduct it. If the company has announced a dividend, if the company has to claim certain exemptions, all of them can be deducted, basically subtracted from this particular book profit. And after you subtract all of these particular deductions, whatever you arrive at is called as a taxable profit. It is called as a taxable profit. And applying the same corporate tax which is present now, let's say 22%. Right? Like the company is allowed to deduct it. If the company has announced a dividend, if the company has to claim certain exemptions, all of them can be deducted, basically subtracted from this particular book profit. And after you subtract all of these particular deductions, whatever you arrive at is called as a taxable profit. It is called as a taxable profit. And applying the same corporate tax which is present now, let's say 22%, right, without including the concept of a surcharge and cess, the government would simply impose a 22% corporate tax on this particular taxable profit. And let's say, for example, if the deductions are worth 100 crore rupees, taxable profit would be how much? 100 crore rupees. And this particular tax rate would be applicable on this particular 100 crore rupees. Now, over a period of time, what has happened there are certain companies which are referred to as zero tax companies. Okay, there are certain companies which are referred to as zero tax companies which are using certain provisions and claiming huge amount of a deduction in such a way that they will either end up paying very less amount of a tax to the government or no tax at all to the government. Is it okay? I'll repeat the process here again. These are referred to as zero tax companies, and these particular companies will claim huge amount of a deduction which will reduce the taxable profit to a very, very low level or nil in certain situations. And when the taxable profit is very low or no taxable profit at all, then government will be able to collect very less amount of a tax or no tax at all. Such type of companies are called as zero tax companies. Now the concern for the government is these particular companies are earning profit. They are also announcing dividends to the owners and the shareholders of the company. But when it comes to paying the tax to the government, they are paying very negligible or no corporate tax at all to the government. To overcome this, government initially introduced the concept of a minimum corporate tax. Okay, they initially introduced the concept of minimum corporate tax back in the year 1987. And over a period of time, this particular minimum corporate tax has been renamed as a minimum alternate tax. Now, what is the idea of minimum alternate tax? Please understand this. Very recently, it has been reduced to 15%. How it is applied, how it is calculated. That is the point of discussion here. I'll take the same example. Here is a particular company XYZ which has made a book profit of let's say 200 crore rupees. And from this, it will claim certain deduction. Okay, let's assume they have claimed deductions of let's say 190 crore rupees. So taxable profit, I'm writing TPA, taxable profit would simply to how much? 10 crore rupees. If government of India imposes a 22% tax on this, the amount of tax collected by the government will be very, very low. So what government says is, in this particular situation, what I'll do is I'll not impose a tax on the taxable profit here. I will impose a tax on the book profit. How much is the book profit? 200 crore rupees is the book profit. I will impose a 15% tax on the book profit. And that naturally would be much, much higher than how much in the form of tax they are going to collect when they impose a tax on the taxable profit. In this particular calculation itself, if I impose 22% on 10 crore rupees, government will be able to collect how much? 2.2 crore rupees. And if I impose 15% on 200 crore rupees, I'll be able to collect how much? 30 crore rupees in the form of a tax. So government says, sorry, for you, I will not impose tax on the taxable profit. Rather, I will impose a tax on the book profit. This is called as a minimum alternative tax. So whenever these particular companies, which are famously known as zero tax companies, do not pay any tax or pay very, very negligible tax to the government, government will apply the concept of a MAT and impose a tax on the book profits and not on the taxable profit. Now, the concept of a MAT has been introduced as a part of Income Tax Act itself and is applicable to all the companies. And in any company or in situation of any company, if they are paying very less amount of a corporate tax because of a huge deductions, government generally impose minimum alternate tax for a higher amount of tax from these particular companies. So this particular concept is referred as minimum alternative tax. The next concept is the concept of a GAR. GAR stands for General Anti-Avoidance Rules. Okay, General Anti-Avoidance Rule. Now, what is the meaning of this? Let me put it in a nutshell or in a simple terms first, then we'll have a discussion as to what the concept of GAR is. To understand this, in the idea of taxation, there are three terms. One is called as a tax planning, and the second one is the concept of a tax avoidance, and the third one is the concept of tax evasion. Now, what is the basic difference between all the three? The basic difference is, in case of a tax planning, it is completely legal and ethical. In case of a tax evasion, it is illegal. And in case of a tax avoidance, it is extreme or unethical tax planning. Now, simply says, what is the meaning of all the three? We are able to understand it. Let me give a very simple example. Government of India, under the Income Tax Act of 1961, has various provisions. For example, Section 80C, right? Section 80D, so on and so forth. Using these particular sections, the amount of a tax that you're supposed to pay to the government can be reduced. Right? Let me elaborate with an example here. Government of India basically provides a concept such as a public provident fund. You can also take a loan for construction of a house. So have a look at this. If you have taken a loan for construction of a house, under Section 24 of Income Tax Act of 1961, certain amount of interest that you pay to a bank in a particular year can be claimed as a deduction by calculating income tax. And if you're basically having a PPF account, public provident fund account, if you make a contribution into this particular PPF annually, up to a certain amount of the contribution can be claimed as a deduction by filing or calculating the income taxes to the government. So if you do this, the amount of a tax you're going to pay to the government obviously is going to be down. And if you basically use these kinds of tools, the amount of a tax you're going to pay to the government will become lower. Okay, this is a concept of a tax planning. You're basically utilizing all the provisions which are provided by the government to reduce the tax liability here. Second one, the concept of a tax avoidance. I'll come to this. Let me finish the tax evasion first here. What's a tax evasion? Let me start with an example here. Imagine here is a businessman who is in the real estate business. This year, he has generated a total revenue or income of let's say 10 crore rupees. But while filing the income tax returns, he basically states that he has generated income of only 2 crore rupees and he'll pay income tax on this particular 2 crore rupees only. Now this is the problem. Have a look at this. The amount of income that he has generated is 10 crore rupees. But while filing the income tax returns and paying income tax, he's telling the government that he's earning only 2 crore rupees in this particular year. By under-reporting your income, by not reporting your income, by misreporting your income, you can generally reduce the amount of a tax you can pay to the government. But that is a violation of the provisions of the Income Tax Act. And if you're caught doing this, Government of India has all the powers to impose certain penalties on you. But this particular methodology, which is unethical, illegal, to reduce the income tax liability, is called as a tax evasion. Now come to the middle part, tax avoidance. What is the idea of a tax avoidance? Understand this. The idea of a tax avoidance is again the amount of a tax you're going to pay to the government will be reduced, but you're going to use a certain loopholes in the taxation structure. I'll repeat the statement here. The idea of avoidance means that the companies are going to use a certain loopholes in the taxation structure, and these are going to reduce the amount of a tax that they are going to pay to the government. Now, is it illegal? No, it is not illegal because there are no provisions prohibiting such an activity. But please understand, this is definitely yes unethical. Government doesn't expect the companies to find the loopholes and misuse these particular provisions in the Income Tax Act. Now, let me give you an example. Right, we'll connect it to some of the current affairs events so that you understand what is actually happening in the current affairs also. I'm pretty sure all of you heard of a Vodafone tax case, and I'm also pretty sure all of you heard of a cane tax dispute with India. Now, understand this. Related to these types of tax disputes, generally there is one terminology called as retrospective taxation, and there is also need to understand another concept related to this, that is bilateral investment treaties. BIT, bilateral investment treaty. Now, what is the concept of retrospective taxation as well as bilateral investment treaty? Let's elaborate on both of them. Whenever a law is formed by the government, whenever a provision is implemented by the government, and the application of the provision comes from the future date or from that particular respective date itself, it is called as a prospective law. Let me give an example so that you understand this. Imagine today Government of India says the income tax that you're supposed to pay this year, the rate will be reduced from 30% to 20%. I'm just taking a hypothetical example here. The income tax rate will be reduced from 30% to 20%. But the application of this reduction in the taxation rate will come from enforcement from tomorrow. They're saying that the application of this law will be made from tomorrow, or let's say from today itself. If government does that, this kind of laws are called as prospective laws. From the future date, the application is done. Whereas in case of retrospective law, government says, although I'm introducing the law today, I'm introducing the provision today, the application or the date of enforcement of the provision will be from a past date itself. For example, take the same initiative of the government. Government of India announcing that the income tax rate will be reduced from 30% to 20%, but not from today. Rather, let's say from 1st January 2020. Is it okay? Have a look at this. The government says, yes, we are reducing the income tax rate, but the application of this income tax rate will be from 1st January 2020. So whenever the law or the provision is introduced today, but the date of application, date of enforcement of this is from the past date, these are referred to as retrospective laws. Now, in case of a taxation, understand the sequence here. There is a company called as Vodafone company. Okay, even today it is present in India. Vodafone, right, is basically a company within the telecom sector. Earlier, there was a company called as Hutchison. Yes, sir. I'll use the short form here, Hutch. This particular company had certain telecom assets in India, and this particular company sold its asset to Vodafone company. Now, look at this. When the purchasing of assets is done, obviously what will happen? Vodafone will pay a certain amount to Hutchison. Yes, sir. Now, earlier we discussed the concept of a capital gains tax. As per the taxation authorities, this particular Hutch company, by selling the assets to Vodafone company, has made certain capital gains. And because it has made certain capital gains, the company is supposed to pay certain capital gains tax. But how is government of India expecting collection of this particular capital gains tax? Imagine Vodafone is supposed to pay, let's say, 1,000 crore rupees to Hutchison, and out of this, as per the calculation of the government, 100 crore is the capital gains. And imagine the capital gains tax is 30%, which essentially translates to what? 30% of 100 crore will be 30 crore rupees. So 30 crore rupees should be paid by the Hutch company in the form of a capital gains tax to government. Now the government says when Vodafone pays the amount to Hutchison out of 1,000 crore, it should simply withhold 30 crore rupees and give it to the government. And the remaining 970 crore rupees should be paid to Hutchison company. Is it okay? This particular concept is also referred to as a withholding tax. That is, the government is asking the Vodafone company to withhold a certain amount of a tax and transfer it to government, and the remaining amount should be transferred to the Hutchison company. Now this has not been done. Vodafone has simply paid all the 1,000 crore to Hutch company. So what the taxation authorities did? They basically sent a tax notice to Vodafone company asking this particular company to pay up 30 crore rupees. Now this particular case, right, was taken to Bombay High Court. Bombay High Court basically ruled in favor of the tax authority. Then it went to Supreme Court of India. Supreme Court of India basically looked at this and stated that there are no provisions in the Income Tax Act which allows the tax authorities to go back in time and apply tax on these kinds of transactions. Is it okay? I'll repeat it again. The Supreme Court of India basically stated there are no provisions in the Income Tax Act which will allow the government of India, to be more precise, the taxation authorities, to go back in time and apply the taxes on the past transactions. So basically, Supreme Court of India ruled in favor of Vodafone. Now, in the year 2011 and 2012, the government of India introduced a budget, and in that particular budget, that is in the Finance Bill of 2012, government introduced the concept of a retrospective taxation. What does retrospective taxation means? The tax authorities will be allowed under this particular law to look into any transaction that has taken place after the implementation of Income Tax Act of 1961, and if there is any amount of a tax to be collected, they will simply send a tax notice and collect this particular tax. Is it okay? Right, so what has happened? The law has been introduced post 2012 in India in the form of the piece of legislation, but the application of this law has been from a past date. That is the reason this is a concept of a retrospective taxation. Now, armed with this particular power of retrospective taxation, the authorities, the tax authorities, again sent a tax notice to Vodafone company, and now Vodafone company dragged India to international arbitration. And please understand this particular company has actually won the case against India under international arbitration. Now the argument within this particular international arbitration generally is with respect to concept of a bilateral investment treaties. In case of there was a taxation dispute, in case of a gains and tax dispute, generally you'll find the mention of bilateral investment treaty. Now this idea of a bilateral investment treaty, have a look at this. Imagine you're a foreign investor, you want to invest in the Indian market. That is, you're a foreign company, you want to bring a lot of investments into Indian company and wants to invest in the Indian market. But you're concerned or you're afraid that the government might change and the new government or the present government itself could change the policy which is not in your interest. That is, your investments could be put at risk by the change in the policy, which will again target only your investment. So under this particular situation, multiple countries like this will enter into these kinds of treaties, which are referred to as a bilateral investment treaty or BIT. Under BIT, which has been signed between India and many countries until 2015, the basic idea is the bilateral investment treaties will protect the investment of the foreign companies in the home country. That is, if Indian government has signed a BIT with the United Kingdom or let's say USA, any investment in the form of let's say Yemenis which are made from these countries into Indian market, they will be given fair and equitable treatment. That is, any policy will not be changed which is going to harm only their investments. So that is the basic idea of bilateral investment treaties. Case has basically used that India has violated bilateral investment treaty. Right? Vodafone also used this argument, and in international arbitration, generally these kinds of cases are upheld. So these are certain points of discussion with respect to the concept of a retrospective taxation and the idea of the Vodafone tax case and what is the application of all of these cases in the UPSC context as such. Now have a look at this. Government of India, to overcome the issue of a tax avoidance, again focus on the concept of a tax avoidance here. To overcome the issue of a tax avoidance, has introduced the issue or the framework of GAR. What is GAR? General Anti-Avoidance Rules. Now under general anti-avoidance rules, what is generally done is whenever there are two parties in a transaction, let's say A enters into a transaction with another company B, what is the motive of this particular transaction is generally found out. For example, A will conduct certain transaction with B, and if the motive of this particular transaction is to avoid a tax which is supposed to be paid to the government, then government or the tax officials will reimpose the tax on such transactions. Now you'll be concerned or you'll be having a doubt as to what I'm actually referring to. Let me give a very simple example here. Imagine there is a company A and there is another company B. Okay. If there is a transaction between these two companies, generally what we say is they should maintain arm's length pricing. I'll write the term here, arm's length pricing. Now what is this idea of arm's length pricing? Imagine I'm buying certain goods and you are selling certain goods. Both of us are conducting transaction here. Now whenever such transactions are conducted, we will try to protect our own interest. Both the parties, right, in a transaction always try to protect their own interest. For example, if I'm buying the goods, I want to purchase the goods at as low price as possible. I want to purchase the goods at a cheaper cost. If you are selling a good, obviously you would want to sell it at a higher price. So generally what happens is there is a negotiation which is conducted and we will arrive at a particular decision. This particular process is called as arm's length pricing mechanism. That is, both the parties are trying to protect their own individual interest, right, and arrive at a particular decision. Now whenever such mechanism is not followed, whenever you do not follow arm's length pricing, obviously there will be certain issues with respect to taxation. How so? Have a look at this. What if these two companies are related companies? Okay, these two companies are related companies. Means what? A owns B. Is okay. A owns B, but this is a subsidiary which has been set up, let's say, outside India. Now A will purchase the raw material. A will purchase, let's say, certain goods. A will purchase, right, let's say, human resources or expertise from B and makes a huge amount of payment for this. Now what's the problem here? Whenever such transactions are conducted, the revenues of A will be affected. That is, when you pay more money to purchase, let's say, raw materials or machines, etc., obviously the cost of operations are going to increase, and when the cost of operations are going to increase, that will shorten, or that will basically reduce the amount of profits that you generate. And when the profits will come down, that will definitely have an impact on how much taxes you are going to pay to the government. Let's have a look at this. Whenever there is no practice of arm's length pricing like this, that will have an impact on how much tax revenue could be collected by the government. Such a type of transactions are referred to as impermissible avoidance agreements. Okay, have a look at this. And the concept of a GAR, it simply says if there are certain impermissible avoidance agreements, and right, in these particular agreements, the amount of a tax paid to the government of India has been avoided, then we are going to reimpose recharacterize the transaction and reimpose the tax that has been avoided. So generally, whenever there is no arm's length pricing mechanism, and if the transactions are conducted only to avoid taxes, there is no commercial component in these kinds of agreements. These are all called as impermissible avoidance agreements. And the tax authorities will look at these particular agreements, and once they conclude that there is an impermissible avoidance agreement, then the GAR officials or the tax officials will impose the tax on these particular transactions and collect the tax revenue. This particular framework, a set of guidelines which is used by the tax officials to characterize the transactions or the agreements between the parties like this, is called as a general anti-avoidance rules. And GAR provisions have come into force by amending Income Tax Act of 1961. It was initially proposed in the Direct Taxes Code. Later, it was introduced as a part of the budget documents itself. And it has already come into force in case of India. So please be very, very careful here. So these are certain taxes which basically come under the concept of direct taxes.
Next one, we have taken care of the types of taxation systems. Let's try and understand certain
Types of taxes now. We'll discuss the income taxes, the corporate taxes, and the most important one, the goods and services taxes. That is different types of direct taxes and different types of indirect taxes. Now let's have a discussion related to some of the direct taxes. Once we're done with direct taxes, then we'll take up indirect taxes. Now starting with the concept of income tax. Now, in case of income tax, for UPSC exams, you don't have to worry about how income tax is calculated. If you have been reading the newspapers, you will have a slight idea that there are two types of income taxes as of now. There are two different methodologies to calculate income taxes. But should you learn the methodology? No, for UPSC that is not required. Certain basic important points are, this is one type of a direct tax which we've already established, because the incidence and impact is on the same person. We're calling this as an income tax. This is levied on income earned by the taxpayer. Government of India introduced the Income Act for the first time in the year 1886. Over a period of time, it has been amended, and in the year 1961, the Income Tax Act was implemented. So whenever they are saying IT Act of 1961, please remember this is talking about Income Tax Act. It is not talking about Information Technology Act. Please do not get confused. There also they simply write it as IT Act. So when it is IT Act of 1961, they're talking strictly about the economics, not the science and technology. Income Tax Act of 1961. Now within this Income Tax Act of 1961, there are various number of provisions, there are various sections. Should we mug up these various sections? Not important. So with respect to income tax, what do you need to understand? Type of direct tax imposed on income earned by the taxpayer. Third, right now, the Income Tax Act of 1961 provisions are applicable. Next, the corporate tax. In case of a corporate tax, understand this, the government imposes a certain amount of a tax on the earnings, or to be more precise, the profits that are earned by these particular companies. That is the idea of a corporate tax. The companies are supposed to pay taxes on their incomes. Now, very recently, there has been a discussion with respect to corporate taxes in case of Indian economy. What is the discussion? Let's try and understand that, and let's have a critical evaluation of this particular concept of reduction. Now, have a look at this. Earlier, I remember I used the term card rate. Earlier, the government had imposed a card rate of 30% on these particular companies. That is basically on their corporate profits, they're supposed to pay a tax of 30%. In addition to that, they are supposed to pay a certain amount of cesses as well as charges, which used to drag this particular corporate tax to a very high level. You don't have to mug up all of these particular numbers because these are older tax rates. But definitely, yes, you need to remember the new tax rate. That is important for UPSC exams. Now, have a look at this. Earlier, the system was like this. If you are a company whose turnover essentially means the overall revenue for a year. So if your turnover was up to 250 crore rupees, then your tax rate, that is the corporate tax rate, was reduced from 30% to 25%. Okay. Now have a look at this. This particular threshold level was increased from 250 crore rupees to 400 crore rupees. So essentially, if you are a company whose turnover, that is per annum, was up to 400 crore rupees, the card rate applicable was 25%. Again, card rate 25, plus charges, so on and so forth. It used to drag the effective rate to around 29%. But if your turnover is more than 400 crore rupees, then the corporate tax rate, that is the card rate that was applicable, was 30%, and the surcharges was much, much higher. But what government of India very recently has done is, it has dismantled this particular system of bifurcating the companies based on the turnover, and has plainly said, whatever your turnover is, doesn't matter. The card rate of corporate tax that is applicable on your company will be 22%. And in addition to cesses and surcharges, your effective tax rate will increase to 25.17%. You don't have to mug up the decimals. If you remember, up to 25% more than sufficient. Now, beyond this, there are two more lines given here. If you are a new manufacturing unit which is set up within a specified time period and become operational within a specified time period, the tax rate, the corporate tax rate which is applicable to you would be 15%, which in addition to the overheads will drag it up to 17%. Now, another type of tax is a minimum alternate tax, which is a short form representing in the form of a MAT, minimum alternate tax, which we'll discuss later. In case of a MAT, it has been reduced from over 18% to 15%. Now, what is MAT? Give me some time, we'll discuss this particular issue. But focus on this. The corporate tax rate very recently has been reduced to 22%, and the effective rate will be 25%. Now, what was the critical evaluation? Right? Which objective government of India has reduced these particular corporate taxes, and what are the concerns related to this particular policy of the government? First and foremost, let's focus on the benefits. What are we trying to achieve with reduction in the corporate tax rates like this? Please understand, at this particular point of time, when this particular corporate tax rate was reduced, there was a trade war that was happening between USA and China. And when the trade war essentially means what? The trading partners in competition will keep on imposing tariffs on each other. I'm trying to simplify the definition of a trade war for you. I'll repeat it again. Trade war essentially means what? Imagine I'm one country, you're another country. You're exporting goods and services to me, I'm exporting goods and services to you. Now what I'll do, I will target some of the goods and services that you're exporting, and I'll impose a certain additional taxes on this. Now, as an exporting country, you will not be happy with this. So what do you do? In retaliation, you will also target some of the goods and services that I'm exporting to you. You will target and impose a higher amount of taxes. So once you have done, again I'll retaliate, again you will retaliate. So this particular process of competitively imposing these particular tariffs will keep on continuing. As a result of this, what will happen? My exports, when they land into your country, they are costly, and your exports, when they land into my country, they will become costly. So the process of a competitive imposition of these particular tariffs on each other is called as a trade war. So at this particular point of time, when the government of India decided to reduce the corporate tax, there was a trade war which was happening between USA and China. And one of the outcomes of the trade war is what? The GDP of both the countries will be affected. No doubt, economic activity will be affected. GDP will be affected. But more importantly, there are certain manufacturing companies, there are certain producers who are located in China. Now, when USA targeted their exports and imposed a higher tax on this, their revenue will get affected. So if you are a company who is located in China and government of USA targets your products and says your products when they land into my country, I will impose more taxes. So you will feel burdened by this particular tax. Your revenues will be affected because imagine you're producing this particular pen. Until now, you used to export it to USA, and imagine the tax rate was 10%. So $100 plus 10% of that will be $10. So your product when it will land into USA will become $110. Now USA says no, not 10%. In addition to 10%, another 15%. So overall taxation rate will climb up to 25%. Same pen, you're manufacturing in China, you're exporting it to USA, $100 plus 25% tax. So it will turn out to be $110 pen will land in USA. And when it increases like this, when the price of this particular pen increases like this, you will become very costly. That is, your products have become very costly in USA. So demand for your products will be affected. Your revenue will be affected. So what you do is, just because you're present in China, USA government is targeting. So what do you say? Let's relocate. Let's move from China. Let's relocate it to some other country from which I can export and still make it cheaper for my products to be sold in USA. So these particular manufacturers or producers started moving out of China and looking into other countries. So one of the objectives that they always want to focus on when these particular companies are moving like this, or they want to set up in any country, they will always want to pay lesser amount of taxes to the government. So at that particular point of time, government of India said, come to India and set a manufacturing facility in India, and we'll reduce the corporate tax. So earlier, imagine you are a company in India. Earlier, the profit is 100 crore. The card rate would be somewhere around 35%. So 35% of profit of 100 crore would be how much? 35 crore rupees. So you as a manufacturer or producer, you are paying 35 crore rupees to government of India. Now government of India has reduced this particular card rate from 30% to 22%. In the overheads, even after counting overheads, the operative tax rate or the effective tax rate would somewhere be around 25%. Now the same profit of 100 crore, you are paying how much tax to the government? 25 crore. So before you are paying 35 crore, now you are paying 25 crores. So amount of tax that you are paying to government of India will come down. So this is expected to attract the foreign companies into India. That is the most important objective that the government was trying to achieve. So have a look at this. It will attract a lot of investment in India. These particular companies are moving away from China. They are relocating from China. We want them to be present in India. We want them to move this particular manufacturing in India. So it will promote investment. It will also promote ease of doing business. Lower the amount of taxes. More companies will find it easier to conduct business in India. This has been a long-standing demand for the manufacturers. Why? Please understand this. Even before government of India decided to reduce this particular corporate tax rate, there are many other countries which actually reduce the corporate tax rate. For example, in case of USA, the corporate tax rate when Mr. Donald Trump was the president, they actually slashed this particular corporate tax rate from somewhere around 35% to 21%. So there was this particular movement across many of these particular economies around the world where the corporate tax rate has been reduced to provide relief to the domestic manufacturers, to attract investment, to bring back manufacturers. So this has been a long-standing demand for the manufacturers or the companies in India, both service providers as well as the producers or the manufacturers. The government of India should reduce the corporate tax rate. So the government of India has met one of the long-standing demand of these particular corporates. This will make India much more attractive, will attract a lot of these particular foreign companies, and the government expects these particular private sector companies, which are going to get the benefit of this particular lower tax reduction or tax reduction by paying lesser taxes. These particular companies are expected to make more investment. Now some of you will be confused with this particular statement as to what I'm actually referring to. Take the same example. You are a manufacturer. Until very recently, imagine you made a profit of 100 crore rupees. On this, you have paid 35% corporate taxes to government. 35 crores you have given. You are left with how much? 65 crore rupees. But now, government of India has reduced the effective tax rate to 25%. You will pay 25 crore rupees to government, and you are left with how much? 75 crore rupees. So with the same corporate profits, now after deducting the taxes, you are left with more money. And when you are left with more money, what government expects is you will take part of this and increase the investment in the economy. And when you invest, what do you mean invest here? You will set up one more manufacturing facility. You will purchase a better technology. You will diversify your manufacturing or production activity. So you will create jobs. You will create employment opportunities in the economy. That is what is expected by the government by reduction or by reducing this corporate tax rate. Now, having looked at the positive side of this argument, positive side of the impact that could be achieved because of the corporate tax reduction, there will certainly be certain concerns. There will always be certain concerns with any economic decision of the government. Now, what are the concerns related to this? First one, have a look at this. It will provide benefits in the long term, but the timing is not correct. What do you mean by this particular statement? Understand this. Whenever you talk about GDP, gross domestic product, what do you mean by GDP? The market value of goods and services which are produced in India. That is the basic idea of GDP. This particular GDP can be increased in multiple ways. For example, you can produce more and export more. Is it okay? You can produce more and start exporting more. Right? But essentially what has happened, the production in the Indian economy has increased, which essentially means GDP has increased. You can produce more and sell more in the domestic market because the demand for these particular goods has increased in the domestic market, which essentially means the consumption has increased. So have a look at this. GDP can be increased in different ways. One, you produce more, you export more. Because it is produced in India, GDP of India will increase. It can also be increased by producing more and selling to the domestic market because the consumption in the domestic market has increased, which essentially means demand for your goods and services has increased. Third way is increase investments. The companies or the corporates or the producers, they will invest more. They will create employment. And what's the objective here? When they create employment, they are paying more salaries. And when they are paying more salaries, these particular employees are consuming, demanding more and more goods and services, which again will lead to what? Higher production in the market. So there are different ways to which the GDP of any economy can be increased. But this particular reform of the government, that is a reduction of the corporate tax rate, what they're expecting is the investments in the market will increase, which will contribute to increase GDP or revival of the GDP. Various experts say, yes, your objective is correct. You want to reduce corporate tax rate, investment will increase, which will lead to revival of the economy, revival of the GDP. Yes, objective is correct. But the timing of the decision is not correct. What do you mean by the timing? When government of India took this particular decision to reduce the corporate tax rate, Indian economy was going to a slowdown. What do you mean by slowdown? The technical idea of a slowdown is the GDP growth rate is actually slowing down. It's okay, the GDP growth rate is actually slowing down. Means what? Imagine in 1 year, the GDP growth rate is 5%. Next year, it has come down to 3%. Next year, it has further fallen down to 7.2%. Next year, it has further fallen down to 0.1%. So is the GDP increasing? Yes. The market value of goods and services is increasing. For simple reason, GDP growth rate is positive. But if you look at the GDP growth rates, absolute value of GDP growth rates, they're actually coming down like this. So that is the basic idea of a slowdown. And the slowdown generally implies that the overall demand for goods and services is actually coming down. Is that okay? The demand for goods and services is coming down. For what reason? Now have a look at this. What government of India expects is you will reduce the corporate tax rate. Companies will have more profits. They will invest more, right? And that will lead to revival of economy. But what generally happens is corporates do not create a demand; they run behind a demand. What do you mean by this? Imagine you are a manufacturer. You have the capacity to manufacture 100 products per day, per month. Don't worry about it. You have the potential. You have all the required facilities to produce 100 units in the market and sell them in the market. But because there's a lower demand, what will you do? Will you keep on producing 100 units or will you keep on reducing the production? What if you can produce 100, but the demand for your products is limited to 60 only? And you can produce 100, but people are buying only 60. Even then, you will keep on producing 100. No, what will you do? You will cut down your production to somewhere around 60. So that what logic says is, do not incur higher cost. If the demand is less, reduce your production so that you contain your losses. So argument here is the producers will run behind the demand. If there's a high demand, generally you will keep on producing more and more. If there's a low demand, generally then you will keep on producing lower and lower so that you can contain the losses. Right? So that is the logic here. What government of India expects is by increasing the investment, the companies will create employment. But what is actually existing right now? Companies are suffering because the demand in the market is very less. At that particular point of time, I do not want to invest more. I do not want to produce more because there's no demand in the market. So that is the logic. Right? So the argument is not only in the longer term, this particular reform of the government will provide benefits to the producers, the overall economy, so on and so forth. But right now, this is not the correct reform to be introduced. First point. Second, understand this. Government of India has just reduced the corporate tax rates. Is it okay? But what about other structural reforms which are required? Now, what do you mean by other structural reforms? Whenever a company wants to manufacture more, sell more, or even wants to set up a manufacturing facility in India, it is not just focused on the tax rate. There are other factors also. For example, what kind of a credit is available in this particular economy? That is it easier for them to get access to loans or not? If they want to set up a manufacturing facility, will they be able to acquire the land easily or not? And in case of India, believe me, land is a very, very important subject and a very, very important hurdle for promotion of manufacturing in India. Land acquisition is not very easy in case of India. Yes, government of India has implemented Land Acquisition, Rehabilitation and Resettlement Act of 2013. But despite introducing this particular act, acquisition of the land is not very easy because of various issues. So when you're a manufacturer, you want to set up a manufacturing facility in India, will you be happy just with the corporate tax rate? What if getting access to electricity is very, very slow in India? What if getting access to loans is very difficult in India? What if getting construction permits is very difficult in case of India? What if the tax laws or the labor laws are very difficult to implement? So as a manufacturer, you're not just focused on the corporate tax rates, you're also worried about other factors also. Right? So argument is there is a requirement of other structural reforms which are supposed to be implemented by the government so that this particular reform will be able to generate a lot of benefits for the economy. And have a look at this. There are other policies by the government itself which hinder the investments in the economy. Now, what do you mean by other policies here? For example, government of India on one side says make in India. But on the other hand, also says I will try to curtail how many imports are coming into India. In the recent times, there's been a lot of discussion with respect to Atmanirbhar Bharat or self-reliant India. Yes, it's a very good objective. But in the process of achieving these objectives, there are certain measures which have been taken by the government which are hindering the investments in the Indian economy. Let me give a very simple example so that you understand what is the point I'm trying to make here. The idea of a self-reliant India is not at all a bad concept or not at all a bad idea. Government of India is not saying that only Indian economy will develop doing this. Government of India is also not saying only the Indian companies will be able to operate. All that the government of India is trying to do with this idea of self-reliant India is it is promoting manufacturing, it is promoting the production of the goods and services within the domestic territory. Please do not misunderstand the idea of self-reliant India. It is not completely negative sense. Now, what is the problem with that? The problem is, let's take an example. There is a company such as BSNL. It is a government-owned entity. Now, in order to develop infrastructure, it will require certain technology. I'm giving you a current affairs example here. Now, whenever it will acquire certain equipment or technology, it will call for a bid. That is, the different companies will have to participate and give proposal to the BSNL. BSNL obviously will choose the correct or the lowest bid. Now, here comes the problem. Very recently, government of India stated that in order to make this particular segment self-reliant, the foreign manufacturers, the exporters of these particular equipments to BSNL will not be allowed to participate in the process of bidding. That is, here is a BSNL. They want to purchase equipment. Until very recently, they could simply purchase it from an exporter or from a domestic market or any supplier from the domestic market. But what government of India now says, if this is an exporter, do not allow him to participate in the bid process itself. Now, problem is that BSNL says, so far, whatever equipment we have purchased, we have only purchased from the foreign manufacturer for a simple reason. The technology that they are using is much better, and most importantly, the cost at which they are selling it to us is cheaper. It makes perfect sense for the BSNL. But government of India says, no, under Atmanirbhar Bharat, self-reliant India will not allow you to do that. Source it from the domestic manufacturer, domestic producer only. These kinds of policies, what they will do is, they will hinder the investment by a foreign company. How so? Imagine you're a foreign manufacturer, you're a foreign company, you want to set up a manufacturing facility in India. But the problem is, the raw material or the technology that you require, all of that is not available in India. So you want to import it from, let's say, rest of the world. But what if government of India says, once you set up the manufacturing facility in India, government of India says, you want to get the benefit of corporate tax rate, you want to get the benefit of, let's say, subsidies, source it only from the domestic market. Because we want to become Atmanirbhar Bharat or self-reliant. That kind of a decision of the government will hinder the manufacturing activity of this particular foreign company. So there are various other policies which are basically hindering the economy from getting or leveraging the benefit of these particular companies from this rate reduction. In addition to this, please understand, speaking of from the fiscal perspective, numbers perspective, earlier, the government imposed how much corporate tax rate? Effective rate was more than 30%. Now the effective rate has been dragged down to 25%. So obviously when the corporate tax rate will come down like this, the amount of tax revenue that they are going to collect will come down. It's just natural. Right? The amount of tax rate will come down, which essentially means the tax revenue will also come down. Here comes the problem. Government of India's financials are very, very tight as of now. It's okay. The financials are very, very tight. In a sense, the expenditures have shot. That is basically because of the pandemic, because of a higher subsidy. The expenditures have been very, very high. On the other hand, because of the slowdown, the recession, because of the pandemic impact, the amount of revenues or the receipts or the income that it collects have come down. That is natural. So as a result of this, the amount of fiscal deficit is very, very high. What is fiscal deficit? As of now, simply remember this. Fiscal deficit is the difference between the expenditure as well as the total receipts of the government. Again, not the complete definition. When I take up the budgeting concept, we'll discuss this. Another way you can simply say that fiscal deficit is nothing but the market borrowings which are done by the government. Now have a look at this. When the fiscal deficit of the government is very high, one of the ways of bridging this particular fiscal deficit is tax revenues. But government of India, by reducing the corporate tax rate from 30% to 22%, has actually added to this particular fiscal deficit. Now, in addition to this, there's another concern: state governments. Because earlier we discussed the concept of finance commission and divisible pool. The government used to impose and collect these particular corporate taxes and add them to the divisible pool. And from that, a part of that would have gone to the states based on the recommendation of finance commission. Now, because government of India has reduced the corporate tax rate, the amount of taxes which are collected and added to the central divisible pool will come down. And when this central divisible pool will come down, part of it which is going to the states will obviously come down. So as a result of this particular decision of the government, it is expected that the states overall have lost around 60,000 crore rupees annually in the form of corporate taxes. So these are certain concerns which have been raised with respect to this particular decision of the government to cut the corporate tax rate. Next, the concept of capital gains tax. Now, in case of capital gains tax, please understand the basics first here. The idea is, imagine you've purchased a land. Okay, you purchased a land. Let's say hypothetically, cost is 2 crore rupees. Imagine you purchased a land of 2 crore rupees in the year 2021. Now what you do? You will own it, let's say, for 2 years, and you will sell it in the year 2023. And let's say when you sell it, the cost would be 3 crore rupees. So you've purchased it at 2 crores, you've sold it at 3 crores. In a sense, you've made a profit of 1 crore rupees here. Again, this is not how the exact calculation is done. Let's assume this is how it is done. Okay, because there is some maintenance charges, there are so many other charges which are deducted or which are added to the initial acquisition cost of 2 crores. But let's not be worried about that because UPSC is not focused on that. So have a look at this. You've purchased an asset, land is an asset. You've purchased an asset at 2 crore rupees, and after owning it for a certain period of time, you've sold it at 3 crore rupees. And you've made a profit or you've made a gain. For a layman such as you and me, we call this gain as a profit. But for government of India, it will not use the term profit here. It will use the term capital gains. Is it okay? So understand this. Whenever the taxpayer owns, that is purchases an asset, either movable, immobile, and sells the asset after a certain period of time, the difference is referred as a capital gains. And on this particular capital gains, government will impose a tax which is called as a capital gains tax. Is it okay? I'll repeat it again. You as a taxpayer or me as a taxpayer, we will own certain assets, movable, immobile. Movable such as shares, immobile such as land, property, etc. So we will own these particular assets for a certain period of time and we'll sell it after a certain period of time. And if the selling price, obviously, right, we want that. If the selling price is higher than the price at which you have purchased, the government will call it as a capital gains. And on this particular capital gains, government will impose and collect a tax which is called as capital gains tax. I'll use a short form for the CGT. This is the first point. Second point, have a look at this. Whenever the government imposes the CGT, there are two types of CGT. The long-term CGT and the short-term CGT. What do you mean by this? In case of some of the types of assets, the government says, follow this very carefully. In certain types of assets, the government of India says, if you purchase, own, and sell it within 1 year period. Is it okay? imposing will be short-term capital gains tax. Best example for this is the securities, such as shares. Let me clarify this. Imagine you purchased a particular share on 1st of January, which you don't like, 1st of January, and you sell the same share in the same year, right? Let's assume on 30th of April. So you purchased, owned, and sold within 1 year. On the gain that you make here, government will impose a tax which is called as short-term capital gains tax. Now, what if you purchase, own, and sell it in a period more than 1 year? That is, imagine you purchase the share today in this year, you sell it after 2 years. That is basically after 1 year time period. So if you purchase, own, and sell it after 1 year time period, on the gains that you make, government will impose a tax which is called as long-term capital gains tax. So idea here is, in some of the assets, government says 1 year. That is the difference between long-term, short-term. In some of the assets such as land, government says 2 year time period. Earlier it was 3 years, as well as 2 years. Again, government can change it. Do not worry about it. But the basic idea is this, right? From one asset class to another asset class, what will be long-term, what will be short-term, government will change it, right? In case of some assets, the difference will be 1 year. Purchase, sell it within 1 year, short-term. Purchase this year, sell it after 1 year, long-term. In certain asset classes, 2 year will be differentiating factor between long-term and short-term. So this is the basic idea of the capital gains tax.
Now let's try and understand the concept of indirect taxes. And in the indirect taxes, please understand the most of the discussion surrounding this will happen on the concept of GST itself. But to understand the importance of GST, to understand why GST is so important and revolutionary reform, you need to understand the evolution of the indirect taxes, especially concept of the excise duty or production duty, which was earlier imposed by the government, then the movement to the concept of VAT, and then finally to the movement of the concept of GST. So have a look at this. To understand all of this, you need to understand two very important concepts. One is the idea of a cascading effect, and second one is the concept of input to tax credit. Again, don't try to read these from the government website. So these are very, very complicated issues. Let's try and simplify, and as per the requirement of UPSC, understand the concept. So that should be more than sufficient. Let me start with the first one here, the concept of a cascading effect. To understand this very carefully, earlier the central government used to impose a tax which was referred to as a central excise, and this particular tax was imposed on production activity. Okay, it was imposed on production activity, and the state government used to impose a tax which is referred to as a sales tax, and this particular tax was imposed on the sales of finished goods. Now, what is the side of production activity and the sales of the finished goods? Let's take a very simple example here. Imagine this is a car. Okay, imagine this is a car which is manufactured, and car which is manufactured in the market obviously becomes what? A finished good. This particular car, right? Let's assume is manufactured by Maruti company. So this particular company will sell it to, let's say, first distributor. He will sell it to second distributor. He will sell it to, let's say, showroom owner, and finally the showroom owner will sell it to a customer. Is it okay? This is the basic flow chart. Now understand this. I'm looking at the only sales part here. That is, the car is already manufactured. But even before the car is manufactured, there are certain other events which are going to take place. For example, this particular company would require tires to manufacture this particular car, would require glass to manufacture the car, would require certain plastics to manufacture this particular car. So thousands of components, raw materials, or intermediate goods would be actually required by this particular company to prepare, to manufacture, or to produce a finished good or final good such as Maruti car. Now focus on this one component, a tire. To get this particular tire, can I simply say that Maruti will purchase the tire from another company, Yamaha, but this particular company, Yamaha, to manufacture or to produce tire, would simply source the raw material from another vendor. So have a look at this. If you want this particular final good to be present in the market, there are so many economic events or the production processes and sales processes which are happening in the economy. Now, until unless the car is manufactured, which is a finished good here, all these activities before the manufacturing stage or the final stage of the car, all of these activities are called as a production stage. And once the car is manufactured, all these particular stages, until unless it reaches in the hands of the customer, this is called as a sales stage. Is it okay? So on these particular production activities, the government used to impose excise duties, and on the sales activities, the government would simply impose the sales tax. In addition to the excise, over a period of time, post 1990, government even introduced the concept of a service tax also. So understand this. This is the basic idea of a supply chain of these goods in the market. Now, should we remember whole supply chain as for UPSC exam? No. I just want to understand the concept of a cascading effect and why GST is much better compared to earlier system. That is the reason I'm explaining everything. So have a look at this. Earlier, what used to happen is, I'll simply take an example here where A will sell the good to B and B will sell it to C. Okay. So have a look at this. A is manufacturing and selling certain good to B, and B will sell this particular product to a C or let's say consumer. Now, what is the idea of a cascading effect? A cascading effect means it's a process where a tax is imposed on an existing tax. Is it okay? I'll repeat the statement here. It is a process where a tax is imposed on an existing tax here. What is this idea? Let's elaborate. When A will manufacture, he wants to sell the product at 100 rupees to B. Is it okay? The selling price is how much? 100 rupees. Now the government says, I will impose a tax because there is a certain economic activity happening here. And for sake of simplicity, assume tax rate imposed will be 10% uniformly. So government will impose a tax of, let's say, 10% or 100 rupees. So 10% or 100 will be how much? 10 rupees. So when B will purchase the product from A, he would have paid 100, which is the selling price, and also 10 rupees, which is a tax. And a total of how much? 110 rupees. Now imagine this is a raw material. B will use the raw material to manufacture a good and he will sell it to C. But what he does, he simply says, sir, I've already paid 110 rupees when I purchased the raw materials. Now, because I'm manufacturing this raw material into a good, I would also want to earn 20 rupees on this. So I will sell it to C at what price? 130 rupees. But again, government comes into the picture and says, I will impose a tax of 10% here. But have a look at the problem in this particular equation here. When we will say that the selling price is 130, out of 130, there is already a component of a 10 rupee tax. Is it okay? Out of 130, there is already a component of the 10 rupee tax. And if I impose a 10% tax on 130 rupees, it is as good as saying that I'm imposing tax on an existing tax. And whenever this is done, this is called as a cascading effect. Whenever it is done, it is called as a cascading effect. And understand this, as a result of the cascading effect, the market prices will be higher. The consumers will bear the burden of all of these particular indirect taxes. Now, to overcome this particular issue itself, government introduced the concept of a VAT, value added tax. Because in the earlier system, when there was an excise duty regime, service tax regime, as well as a sales tax regime, there was a cascading effect which was taking place in the system. So government said, let me try to abolish this particular cascading effect so that the market prices will come down. The amount of a tax burden on the consumer will also come down. For this, they introduced the concept of a VAT. Now, in case of a VAT, please understand this. The whole idea is we are going to impose a tax on the value addition of a product. Is it okay? Right? Overall in the system, we are going to impose a tax on the value that has been added to the product so that the cascading effect will not take place. Now, how it is done, what is the calculation? We'll have a look at it in a minute. But to understand this, you need to understand another concept which is called as input to tax credit. I'll use the short form here, ITC, input to tax credit. Now, what do you mean by input to tax credit? Simply understand this. whenever you are purchasing certain raw materials, imagine you're a manufacturer and you're purchasing certain raw materials, and when you purchase these raw materials, you have to pay certain taxes on the raw material. Okay, on the inputs that you use, you will have to pay certain amount of a tax on this. So government says, whatever taxes you've paid on the inputs, I will give it back. And you will get this particular tax back when you collect the tax on the output. I'll repeat it, then I'll give you a calculation here. Follow this. Government says, whatever taxes you've paid on your inputs, that is the raw material, intermediate goods, etc., that you've purchased, all of these particular taxes will be given back to you when you sell the output and collect the tax. This is called as an input tax credit. Now, how does this work? Let's have a look at this. Imagine, here's a manufacturer. To manufacture an output, to manufacture a good, he will require 3 raw materials. And the 3 raw materials, when he purchases, let's say he will pay a tax of 100 rupee, right, on the first raw material, a tax of 100 rupee on the input A, tax of 120 on input B, and tax of 130 rupee on input C. So when he purchases all the 3 inputs, what is the amount of a tax he has already paid to the government? He has paid a tax of 350 rupees. Now imagine he has manufactured a product. The cost of manufacturing, I'll just take an arbitrary number here. Let's say is 1000 rupee. Okay, the cost is actually 1000 rupee. That is the cost of raw material, excluding the taxes, labor, profit, etc. Now have a look at this. Without considering the taxes that he has paid on the raw material, what is the cost? 1000 rupee. He will simply say these taxes are paid by me. I've paid a tax of 350 rupees already to the government. Now what I'll do is, in addition to 1000, I will also impose and collect 350 rupees. Now in addition to this, what the government of India says, also collect 400 rupees in the form of a tax on the output. So have a look at this. The input taxes are getting added. On the output, again, government is asking him to collect the taxes. The taxes are getting added along with the other taxes in the system. This is basically idea of cascading effect. Again, I'm not showing the exact calculation. You don't have to be worried about exact calculation here. Simply understand this. The manufacturer would simply add these particular taxes when he's willing to sell, when he's ready to sell the product to a buyer in the market. But if he does that, and again, government imposes tax on the output when it is sold, that will lead to cascading effect. Right? So what government says is, please do not add this particular 350 rupees. Right? Imagine you are this particular manufacturer. Right? The government tells you, please do not add this particular 350 rupees when you're selling the product. Then you simply ask the government, sir, then who will give me this particular 350 rupees? Right? The customer has to pay to me, but you are telling me do not impose it on the customer. Then who has to pay this? Government says, please do not worry. What is your cost? 1000, right? And what is the tax I'm asking you to collect now? 400 total. Right? Sell the product at 1400. Out of that, right, you will receive back your 1000. And the tax, which is 400 rupees here, out of this, please withhold 350 rupees. Because in the previous step, how much tax you have paid to me? 350. So withhold this particular 350. And how much is left out? 50 rupees is left out. Transfer this to government. Is it okay? Transfer this to government. Right? This particular concept is called as an input to tax credit. What has the government done here? A manufacturer, when he has purchased raw materials, or let's say intermediate goods, he has paid a tax of 350 rupees, right, in the form of the purchasing of these inputs. Government says, when you sell the output, again collect the tax, right? How much tax you are collecting? 400 rupees. Out of this 400 rupees, please withhold. Take back your 350 rupees and transfer the remaining 50 rupees to the government of India. Right? Now there are 2 things here. One, do not come to a conclusion that government is incurring a loss. No, government is not incurring a loss. In the first step, government has collected 350. In the second step, government has collected 50 rupees. 400 rupees it has collected. That's the first point. Second point, the manufacturer, when he pays the taxes on the inputs worth 350 rupees and gets back the same 350 rupees when he sells and collects the tax from the consumer, he will not transfer this 350 as a form or as a part of the selling price, thereby basically ensuring that there's no cascading effect in the system. Is it okay? So this particular concept was introduced by the government under the concept of a value added tax. Now let's look at how the system will work. Same idea. A will manufacture a product, let's say at 100 rupees and sells it to B. So when B will purchase it, he will purchase it at 110 rupees. Now out of 110, already there is a tax component of 10 rupees. Now have a look at this. Now he will add a value of 20 rupees. So he should be selling, again I'll come to the calculation, he should be selling it at 130 rupees. But government says, please do not sell it at 130 rupees. What you need to do is, out of this particular 110, right, because his calculation is how much? 100 plus 10 plus 20. This is a tax on the inputs. So out of 130 rupees, there is a 10 rupee input tax. So do not calculate the tax on full 130. Please take out this particular 10 rupees. Do not include it. So he has to basically calculate it like this: 120 plus 10% of 120 rupees. So 10% of 120 will be how much? 12 rupees. So have a look at this. He will sell it to C at 132 rupees. Is it okay? He will sell it to C at 132 rupees. Now understand the concepts here very carefully. So how much tax he has collected in the second step here? He has collected a tax of 12 rupees. How much tax has been paid by B in the first step? For this first step and second step. In the first step, how much tax B has paid? He has paid a tax of 10 rupees. So he will withhold that. He will simply transfer the remaining 2 rupees to the government. And when this kind of a calculation is done, you will see that there is no cascading effect in the system. Whatever taxes are paid on the inputs by B are given back to him when he will sell the output in the market. Thereby no cascading effect. And second, please understand the logic here. What is the idea of a value added tax? I stated that whatever is a value addition in the system, on the value addition we will impose a tax. How much is the value addition here? In the first step, A has added a value of 100 rupees to the system. In the second step, B has added a value of 20 rupees to the system. So how much is the total value addition? 120 rupees. And if I impose a 10% tax on 120 rupees, how much should be the tax? The tax amount collected should be worth 12 rupees. Now have a look at how much government has imposed and collected in the form of tax. In the first step, it has collected a tax of 10 rupees. In the second step, it has collected a tax of 2 rupees. So 10 plus 2, 12 rupees. So neither government is losing the tax revenue, nor the customer is feeling a burden of a higher indirect taxes. So it is a benefiting a manufacturer, it is a benefiting government in the sense that it is ensuring that the market prices of the goods are coming down, the burden of the indirect taxes on the consumer is coming down. If you're producing and exporting into the international market, obviously because of a lower market price, your products will become much more competitive. All these are some of the outcomes that you can obtain from having a concept of an input to tax credit. And under VAT system, we actually introduced this particular concept of an input to tax credit. Now to eliminate the idea of a cascading effect, we introduced it. But over a period of time, it was realized that no, despite introducing VAT system, even today there is a cascading effect in the system. How so? Let's try and understand this now. In case of VAT, there is also a parallel tax which is called as a service tax. Now understand this, in many instances, whatever input taxes you have provided or paid in the form of a service taxes were not allowed to be used as an input tax credit in the subsequent steps. So as a result of this, there was a cascading effect in the system. In other situations also, let me give a simple example here. Imagine a good is credited in the subsequent steps. So as a result of this, there was a cascading effect in the system. In other situations also, let me give a simple example here. Imagine a good is manufactured in the state A. Okay, or else I simply say yes one. And the manufacturer is A. Now from the first state, the good is moved across the border and sold in the second state, S2, and the buyer is B. Now, after purchasing this particular good, this particular buyer will add certain value and sell it to C. Is it okay? Now, in this particular case, what I'm saying, A will manufacture the good, sell it across the state border to B. B will add certain value, sell it to C. Understand this? Whenever the goods are moving across the state border like this, the tax that was earlier applicable was a central sales tax. Okay, that is the first point. Second point, have a look at this. The central sales tax is imposed by the central government, fixed by the central government, but it is administered by the state government officials, right? And specifically the sales tax officials. Now, have a look at this. The central sales tax, which is administered by the sales tax officials of respective state, they will be collecting the sales tax in the state where the production or the origin of the good has actually happened. Is it okay? I'll repeat the statement here. The central sales tax is administered and it is retained by the state, but more importantly, it will be collected at a point where the movement of the good actually starts from, or where the production actually starts from. Such a type of taxes where the tax is imposed and collected at the point of production is called as origin-based taxation. Okay, it is referred as origin-based taxation. Done. Now, have a look at this. The good is manufactured in the first state. It is moving across the border to the second state. Let's have the same numbers here. A will manufacture this at 100 rupees. He wants to sell it to B at this particular price. But government says, I will impose a 10% central sales tax on this. Is it okay? I will impose 10% central sales tax on this. So obviously, when B will purchase it, he has to pay how much? 110 rupees. But more importantly, out of this particular 110 rupees, the tax of 10 rupees has gone to the which state? Has gone to the first state. Is it okay? It is imposed and collected by the sales tax officials in the first state and will be retained by the same state itself. Now, B has purchased this particular product at what price? 110 rupees, out of which 10 rupees is a tax. He will use it to manufacture a good and he wishes to sell it to C at 130 rupees. In the earlier system, when there is an input tax credit, what we expect is B will be given back this particular 10 rupees. And when I say given back, he is allowed to withhold this particular 10 rupees when he will sell and collect the tax from the consumers. But here comes the problem. In this particular situation, B has no doubt to pay the input tax of 10 rupees, but that particular tax has gone to the first state government. That tax has gone to the first state government, and he is in the second state. He cannot ask for the input tax credit from the second government or second state's government. So obviously, second state will deny giving any amount of input tax credit to him. So what he will do? He will simply say this particular tax of 10 rupees, which I paid on my input, I will add it in my selling price. And the selling price again advances to 130. 10% tax on 130 would be how much? 13 rupees. Now C will have to pay 143 rupees. So look at this. Despite introducing the concept of VAT because of interstate trade and commerce, even then there was a problem of a cascading effect in the system. So government of India looking at all of this basically stated that let me replace the idea of a VAT with a much bigger concept of a GST, goods and services tax, under which I'm going to subsume many of these particular indirect taxes as well as the cesses. But more importantly, in relation to concept of a VAT, what are the important points here? The important points are when value added tax had two forms, one by the central government and the other one was implemented by the state government. At the central level, there was excise duty that was subsumed under the concept of a sen VAT, which was implemented by the central government. And at the state level, the sales tax was basically subsumed under the concept of a state VAT. So central government has to pass legislation, and even the state governments individually had to pass this particular legislation. And basically, VAT is a multi-point tax collection, hence reduces the cascading effect. Right? That is what we have seen in the earlier examples. Imposed on the manufactured goods, the taxes were ultimately paid by the customer. Please understand whether there is a cascading effect or no cascading effect. Ultimately, whatever is the burden of indirect taxes is transferred on the consumer himself. The consumer has to pay for these particular indirect taxes. Though it is reduced, the incidence of cascading, there were certain incidences because of not allowing service taxes to be used as an input tax credit or because of interstate trade and commerce. So these are certain points related to VAT. Now, to address all of this, we have introduced GST. So why we have introduced GST? Let me start with the basics here. One, we want to eliminate the cascading effect. Every one of us will agree with this. We want to eliminate the cascading effect. Right? That is the precise reason under GST. At every step of production or sales stage, there will be a component of input tax credit that will be provided by the government. How so? We'll have a look at it later. Please do not worry. Earlier, there are multiple indirect taxes. Now, please understand this. We had multiple indirect taxes both at central level as well as at the state level. Central government had multiple indirect taxes. State governments had multiple indirect taxes. But within this, again, the situation was very much complicated for a simple reason. Same product sold across a different state attracted different indirect taxes. Right? That is, the rate of application was different in different states. For example, a product such as a cell phone or a mobile phone, right, the amount of taxes which were implemented across the state were completely different. In one state, the VAT or the sales tax that was imposed was 5%. In another state, it was 8%. In the third state, it was 14%, so on and so forth. So the amount or the rate of indirect tax, though the indirect tax is the same one on the same product, varying from one state to another state. This creates a lot of complications for the businesses in terms of filing the tax returns, claiming input taxes, marketing and selling these at different prices in different markets. So there is a problem with respect to this, and we are trying to address all of this. Setting off was not allowed or was difficult in certain cases, right, where excess credit is there, excess tax is paid, it is called as a credit, or it is given back to the taxpayer, which is called as a credit. And in many cases, setting off of these particular taxes was not allowed. Transportation costs, right, were adding to the cost in the market price. Now, what do you mean by this? Have a look at this. Imagine here is the production base of a manufacturing company. It will manufacture goods in this particular facility. It will take these particular goods in multiple states into different markets and will sell these particular goods. But please understand, when the goods will have to move at longer distance, obviously cost of transportation will increase. First point. Second point, whenever the goods were moving from one state to another state earlier, at interstate border, they were supposed to stop and get the documents verified. Is okay? At interstate borders, there were checkposts, and these particular the drivers or the companies which are involved in the logistics of transportation, they were supposed to submit all the documentation which delayed the process of transportation. And always remember this, cost of transportation is decided by multiple factors. Higher the time taken, more the consumption of the fuel, all of them will add to cost of transportation. And in case of India, you can use this particular statement across all the industries, simply saying that cost of transportation or cost of logistics is very high in case of India. When you talk about the cost of logistics in the context of other countries, countries such as USA, China generally have a cost of logistics in the range of 6% to 8% of GDP. Whereas in case of India, the cost of transportation generally ranges around 13 to 14% of GDP as such. So in essence, you need to reduce it, you need to drag it down. And with the implementation of GST, we have been able to basically eliminate the checkposts which have been set up at interstate borders, thereby reducing the cost of transportation, in a sense, reducing the time and reducing the cost here. Okay, the lines between goods as well as services are getting blurred. As basically understand this, it was very difficult to predict what kind of a tax is
imposed by the government or the tax officials. For example, intellectual property rights. In many of the instances, these were treated as a goods and imposed tax accordingly. And in many of the situations or the instances, these were treated as services and taxed accordingly. And more to understand this, whenever a good is reaching a marketplace, reaching a customer, there is always a combination of the good as well as the services within this. What do you mean by this? Imagine this particular pen. You are purchasing this particular pen in the market. It is a good, no doubt, it is a good, or it is a commodity. But to make this particular pen available, first the production has to happen for this particular good. Next, the warehousing has to happen. Next, the transportation has to happen. So have a look at this. When I talk about production, you can simply say tax on good. You can implement and impose that. But what about the transportation? Transportation is a service. So government will impose a service tax there. So whenever you are purchasing a good in the market, purchasing a commodity, the tax incidence on all of this, right, is a combination of taxes on goods as well as taxes on services. So it is becoming very difficult over a period of time to delineate, right, where we are supposed to implement the goods taxes and services taxes. But under GST, we do not want to differentiate it. We simply say that doesn't matter whether it is a good or a service, we can simply put it under the ambit of the GST itself. So these are some of the reasons why we have implemented goods and services tax. Now, apart from this will basically subsume or streamline the indirect taxation structure in India. Like earlier I mentioned, there are multiple indirect taxes implemented or imposed by the central government as well as the state governments. What we have done, we have taken these indirect taxes, kept it under the ambit of one tax, that is the goods and services tax. That is the reason the central theme, understand this, the central theme of GST. Right? In one line, if I want to explain what is GST, it stands for one nation, one indirect tax. Some of the books will go further and also write one national market. And what is that? I'll give you a meaning of this in a minute. So have a look at this. When I want to explain the theme or explain what is GST in a single line, one nation, one tax. I can use one indirect tax also. One nation, one tax, one national market. Now what is this idea for one national line? One nation, one tax. I can use one indirect tax also. One nation, one tax, one national market. Now, what is the idea for one national market? If you want to sell a product across the state lines under GST, doesn't matter in which state you're selling the product, the GST rate shall remain the same. Is okay? I'll read the statement here. National market essentially means whenever the goods are sold across various states, right, throughout India and different states, doesn't matter which state the sales is happening, the GST rate shall remain same. For example, take this particular pen. If I'm selling this particular pen in Karnataka, if the GST rate is let's say 9%, when sold in Bihar, it will remain 9%, Uttar Pradesh 9%, Jammu and Kashmir 9%, Gujarat 9%, Madhya Pradesh 9%, West Bengal 9%. So when the goods are sold across the boundaries, across the state lines at the same GST rate, that is referred as a national market. The tax rate which is applicable remains uniform, remains the same. That is the concept of a national market. Now some of you will start having a doubt and raise a concern that, sorry, when you're saying the tax rate is same, we can see that the market prices of the goods will vary. Right? For example, if you're purchasing let's say a product, right, such as MTR products, the prices of these particular products will vary from one state to another state. That is naturally going to happen for a simple reason. When you're manufacturing a product in one state, but from that particular state, imagine you need to travel, let's say 600 or 1000 kilometers or 2000 kilometers to supply this particular product. Cost of transportation will get added, right? Logistics, warehousing cost will get added. That is the precise reason. Market prices might vary, but if this particular product attracts a tax of 12% in this particular state, it will also attract the same tax across all the states in India. That is the concept of a national market. Now, the concept of a GST was introduced for the first time in the form of a bill, Constitutional Amendment Bill in 2011, again in 2014. Now, what is this idea? Please understand this. Under the Constitution of India, we have a Schedule 7. Under Schedule 7, what we have done, we have distributed the powers to central government as well as the states like this. And amongst all the powers which have been distributed, one set of powers relates to financial powers. And armed with the financial powers, only central government will impose indirect taxes and collect it, and the state government will also impose indirect taxes. But what we are trying to do under the concept of a GST is we are going to take away these particular indirect taxes from the central government also, from the state government also, and subsume it, put it under only one type of a tax, that is a GST. Now, if I don't amend the Constitution and simply bring in the GST, don't you think we will end up violating the Constitution of India, or the provisions of the Constitution of India? Why? The Constitution has divided the powers between center and state. So without amending, without changing the respective provision, how can you simply take these particular indirect taxes powers away from central as well as state taxes as such? So that is the reason in 2011, 115, the Constitutional Amendment Bill was introduced. But please understand, in the 2014, there were Lok Sabha elections, the Lok Sabha was dissolved, and this particular bill got lapsed. That is the precise reason. Again in 2014, when the new government was formed, we introduced another new bill, 122nd Constitutional Amendment Bill, and this is the one which was passed as the result of which GST was introduced. And also remember this, because we are basically tinkering with the powers of the central government as well as the state governments. More importantly, the state governments. Obviously, this particular Constitutional Amendment Bill has to be passed by at least 50% of the states also, which has been done. Now, as a result of all of this, we have implemented a GST from 1st July 2017. Now, this particular bill will empower both central government as well as the state governments to decide regarding these particular indirect taxes. Whenever I'm talking about GST, please understand I'm talking about indirect taxes. So this particular bill or the act now has given the powers to both central government as well as the state governments to take a decision collectively regarding these particular indirect taxes. How it is done? Give me a couple of minutes, I'll explain that also. Right? Have a look at this. There is a constitutional authority which has been set up by the government, or to be more precise, the President of India, which is known as or which is called as GST Council. In the GST Council, there is a representation of both the central government as well as the state governments. Is it okay? It has representation both from the central government as well as the state government. What is the role of the GST Council here? Earlier, right, in the previous slide, I used a statement. Right? The statement was the act or the bill empowers both the central government as well as the states to take a call or decide on these particular indirect taxes. Now, all of these particular decisions are taken by the GST Council itself. It is the GST Council which will decide which indirect taxes have to be subsumed under GST, which indirect taxes have to be kept out of the purview of the GST. If at all these are brought under GST, what should be the rate of the GST applicable on this? Over a period of time, should we reduce the GST rate? Should we increase the GST rate on these particular goods and services? All these decisions are taken by the GST Council itself. That is the reason. Always remember this. Can central government unilaterally take a decision? I can underline the term decision here. Can it take a decision regarding a GST in India? Absolutely no. It has to have concurrence of some of the states. Right? There is a certain number of some of the states to make any decision within the GST Council. Now, these are certain points with respect to the GST Council. But when I say there is a representation of the central government, who is representing central government here? It is the Union Finance Minister. And from the states, you have a state finance ministers. And all those union territories which will have legislatures, they will also be present in the GST Council. Now, apart from this, right, what do you need to understand? This particular GST Council will be chaired by Union Finance Minister. Under the GST Act, there is a provision of a vice chairperson within the GST Council,
which has not been operationalized so far. Is okay? I'll repeat the statement. Under the GST Act, there is a provision of a vice chairperson. This particular chairperson will be chosen. Rather than using the term chosen, we can also simply say technically elected among the ministers of the state government. But so far, this particular position has not been operationalized by the GST Council. Third one, who are the members? Ministers of the states, right? All the ministers of finance or taxation of each of the state government, all of them will be present in the GST Council. Quorum is 50% of the total members. That is to start discussions within the GST Council. Minimum how many members should be present? And that is 50%. Means what? Let's assume the total number of membership in the council is 30. 50% of 30 will be how much? 15 members. If more than 15 members are present within the GST Council, then basically the discussions and deliberations in the GST Council can start. Now, with respect to the decision making in the GST Council, you have to understand certain important points here. Any decision of the GST Council has to be taken with at least 75% of the majority. Is it okay? I'll repeat the statement. Any decision of the GST Council has to be taken with at least 75% of majority. What do you mean by this? Have a look at this. Within the GST Council, there's representation of the central government, there's representation of the states. Out of all the votes, one third of the voting weightage has been allocated to central government. And as you will out of the number, 33%, right, voting weightage has been given to central government. Remaining 67% has been distributed equally amongst all the other representations from the state governments and union territories. Is okay? Right? Within 100% voting weightage, 33% has gone to central government. Remaining 67% has gone or has been distributed equally amongst all the states like this. And each state will generally get over 2.1% of the voting weightage like this. Now, if there is any discussion and the decision has to be taken, if the central government says, I agree to this, right? For example, take this particular pen. The council is discussing this particular pen should attract a GST rate of 28% and not 18%. If the central government says, okay, I agree with that, it essentially means in favor of increasing the rate to 28%. Now there is 33% voting weightage. If remaining states, let's say 20 more states say, yes, we also agree with that, then 40% more will get added. So like this, right, the voting will be conducted. And for any decision has to be taken within the GST Council, the majority is important. How much majority? You should have at least 75% of the votes in favor of the decision. Only then this can be passed by the GST Council. Otherwise, no, it cannot be taken as a decision of the Council. Apart from this, Council can make recommendations on everything related to GST, including the laws of GST, rules related to GST, the rates related to GST, etc. All these are certain very important points with respect to GST Council. Now, going forward, if at all a question is asked, please differentiate what are the changes in the indirect taxation that has been introduced with introduction of GST. That is, let me put it another way, compare and contrast the indirect taxation situation in India pre-GST and post-GST. That is with the implementation of GST. Right? If that is the kind of question asked, I've given a very simple table for you for the discussion here. First, goods and services were taxed separately earlier. Okay, so at central level we had excise, at state level we had sales or VAT for goods, and for services we had services tax. But now, under the ambit of GST, we are going to tax both the goods and services under the ambit of only one tax. That is goods and services tax. Some of you might be thinking, sir, what difference does it make? Earlier we had two taxes, and now we have a single tax. What difference does it make? A lot. For a very simple reason, whenever, let's say, you purchase a particular product in the market, it is not just including the manufacturing. There are a lot of services which are also included in order to ensure that you will get the product in the market. So what do you mean by that? Take the example of this particular pen, or the mobile that you're holding, or the laptop that you're holding. This particular product, not just manufacturing. In addition to manufacturing, there's also services sector which is involved, which ensures that you'll be able to purchase this particular pen in the market. For example, pen is manufactured in the factory. Okay, so pen is manufactured in the factory. You will purchase this particular pen, laptop, or mobile in the market. Between the factory and market, there are various services which are involved, which will attract a particular tax. Earlier, it was a service tax. For example, warehousing. Warehousing is a service. Transportation or logistics is a service. So earlier, we had two different types of taxes: one for production, one for services. And in the market, generally, there are various stages where the manufacturer will end up paying the tax on production or tax on the goods and tax on services. All the times it was not feasible for him, or all the times the government did not allow him to get the ITC on all the taxes that he's actually paying. But now, we do not have a different type of a tax for a good and a service. Both of them are being taxed under the same taxation, that is GST. Okay. Second, earlier, even though we implemented VAT, value-added taxes, or value-added taxation system, one of the issues with the VAT system was that the VAT tax as a concept was same across the states, but the tax rate imposed by the government from one state to another state varied. Right? For example, mobile phones. If the mobile phone is sold in state A, the state government of A would have imposed a VAT of 15%. State government B will impose 12%. C will impose 8%. D will impose 10%. So you can see that although the VAT was implemented by the state governments, the rates under the VAT were not same. There was no national market earlier. That is the third one. Okay. So different states had different tax rates. Now all the states put together will have a uniform taxation rate. National market was not possible earlier. National market is now established. Earlier, example CST was origin-based taxation. Now GST, it is end-based, consumption-based, right, or destination-based taxation. Earlier, cascading effect was one of the concerns. It was happening. Under the GST, we want to eliminate the cascading effect. Now under GST, how the system is going to function? Give me a couple of minutes, I'll explain that also. And there are multiple indirect taxes at center and the state. Now there is only one indirect tax between center and state. Having said so, I'll give a caveat also. Right, one condition, I'll put a star here. Right, so what do you mean by star or hash, whatever it is. Right, although written only one tax here, all the indirect taxes even today are not subsumed under the ambit of GST. Is okay? All the indirect taxes are yet to be subsumed under the ambit of GST. Right? Yes, more than 40 types of indirect taxes plus cesses have been brought under GST, but even today, taxes on, let's say, real estate, taxes on electricity, taxes on alcohol, etc., are out of the ambit of GST even today. Right? So these are some of the very important points which differentiate between the earlier taxation system with the new taxation system. Now let's have a discussion related to how GST is a much better version, or GST as a concept is a much better compared to earlier taxation system. I'll give you two calculations. Do not mug up these calculations. Understand the concept here. Right? Whatever we discussed so far, let me put it in application form now. The two examples are one, the intrastate transaction, and the second one is the interstate transaction. Right? That is within one state and right from one state to another state. Okay. Let me start with the interstate, that is within the same state. Imagine a good is manufactured by A, then sold to B, and then B will manufacture this. That is basically B will use this as a raw material, manufacture and sell it to C. In the pre-GST era, that is before the implementation of GST, let's take an example of, let's say, excise duty or sales tax regime earlier, there was a cascading effect which was observed. Now look at this, price of rupees 1,000, imagine I'm a manufacturer here, I'm purchasing raw material. I will purchase the raw material from you at 1,000 rupees. Government will impose a tax of, let's say, 10%. Essentially means I will be purchasing this particular raw material at 1,100 rupees. Now I will purchase the raw material, produce the good, I want to sell it in the market at 2,100. Is okay? I want to sell it in the market at 2,100. Now what will happen? Government will again impose a 10% tax on this, 210. I will sell it to the consumer in the market or customer in the market at 2,310 rupees. Again, should you mug up this calculation? Absolutely no. What you need to observe is simply this. Input to tax credit was not provided and that led to cascading effect. Done. Now, what will happen under GST? Let me start. Price will be how much? 1,000 rupees raw material price. You will sell the raw material to me. Government will impose a GST of 10%. That is 100 rupees. So when I purchase raw material from you, I've paid a GST of 100 rupees to the government. That is the input taxes. Now I use the raw material, right, and manufacture this particular product. I want to sell it at 2,000 rupees. Now some of you will be thinking, sir, wait, you say you purchase the raw material at 1100. You want to earn a profit of 1,000 rupees. Then basically you should be selling it at 2,100, not at 2,000 rupees. But please understand the calculation very carefully here. This particular 1100, yes, I paid to purchase the raw material, 1100 rupees. 1,000 is actually raw material, 100 is GST. But government simply says, whatever is your GST, that is the taxes that you paid on your inputs, I will give it back to you. Understand? I will simply give it back to you. You don't have to again transfer it to consumer. I will give it back to you. If government did not give it back to me in the form of input tax credit, I would simply transfer it to the customer. But under GST, government itself is saying, do not transfer this particular ITC or let's say the input taxes to a customer. I'm going to credit it back. I'm going to give it back to you. In that case, what I do? I will not consider this particular 100 rupee GST. So to purchase raw material 1,000, exclude GST because I'm going to get it back. I want to earn a profit of 1,000. So the selling price for me will be 2,000 rupees. Now government will basically, let's say again, you're selling GST of how much? 10%. So 10% of 2,000 will be how much? 200. So I will get this. I will collect 200 rupees by selling, right, this particular good in the market, give it to government. But on the inputs, I have paid 100 rupees and the government will give it back to me, right, refund it to me, this particular 100 rupees. That, so the actual amount of revenue collected by the government, I don't get confused here. How much revenue is being collected by the government? In the first step, 100 rupees. Okay, the first step 100, second step 200, but the 100 rupees that I've paid in the form of taxes on the inputs will be refunded. So essentially, the government will be collecting tax of 200 rupees. The government is essentially collecting a tax of 200 rupees, and this 200 rupees will be divided into two equal parts, 100 and 100. This 100 will go to central government, CGST, and this 100 will go to the state government, ESG, EST. That, and this SGST will go to which state? Same state, because the good is being produced and sold, consumed within the same state. That is an interstate GST application. Now, how this is being different, or how this particular structure is different from the other structure? At every step, the government will provide input tax credit, as a result of which there is no cascading effect. As a result of which there is no cascading effect, and that is the difference between the GST structure and the pre-GST structure. Next, what will happen in case of interstate? That is, good is manufactured in one state, moved across the border, sold in the second state. Right? Let's assume, right, from state 1, A is selling this particular raw material to B, who is sitting in the second state. B will manufacture the product, sell it to C, who is sitting in the third state. S1, S2, S3 are states. A and B and C are basically the companies, or let's say customers in the system as such. Let's start. Under the pre-GST era, before GST, what is to happen? Same numbers, raw material cost is 1,000. You are sitting in the first state, you will sell it to me. Is okay? You will sell it to me. So I will have to pay a CST of, let's say, 10%. So 10% of 1,000 will be how much? 100 rupees. So I will pay a central sales tax of 100 along with raw material cost of 1,000 and purchase this raw material at 1,100. Now this particular CST will go to the state government, right, to which you actually belong. Now I'm in the second state, that is S2. I will manufacture this particular product, sell it in the market again to a consumer who is sitting in the third state, S3. So again, there's a CST, central sales tax, and none of the state governments will give input tax credit. So as a result of this, there is a cascading effect seen toward the system. Market prices will be very high. The taxes paid by customers are very high. Cascading effect is seen. What will happen under GST? What will change under GST? Under GST, have a look at this. Now, right, rather than simply applying GST, I'm going to write IGST, integrated GST. Why? Earlier I discussed this. Under the context of integrated GST, it simply means goods are being manufactured and sold across the state borders. It's not simply manufactured and consumed in a single state. Manufactured, sold across the state borders like this. So let's consider the same example. A, that is, you're sitting in the first state, you will sell the raw material to me at 1,000 rupees. I will give IGST of 10%, that is 100 rupees. So I will purchase the raw material at 100 plus 1,000, 1,100. Now I want to earn a profit of 1,000. I want to sell it at 2,000 rupees. Again, you simply say, what about right, this 100 rupee IGST? Government simply says, I will give that 100 rupee back to you. You don't have to transfer it to customer. If you transfer it to customer, that leads to cascading effect. Tax on a tax. So what will happen now? 1,000 rupee profit, 1,000 rupee raw material. I want to sell the good at 2,000 rupees to a customer who is there in the third state. Again, across the state border. So IGST is applicable 10%. So 2,000 rupee selling price, 200 rupee is the IGST component. So the customer will be purchasing at 2,200. Now how the calculation will happen? 100 rupee IGST already paid. In the second step, from customer I collect 200 rupee and give it to government. So the amount of collection will be 300. But please understand this: the 100 rupee that is paid by me when I purchase the raw materials in the form of IGST will be given back to me. So actual collection by the government will be how much? 200 rupees. Okay, actual collection of IGST amount will be 200 rupees. Now this 200 rupees will be broken down into two equal components of 100 and 100. This is a CGST, will go to central government anyways, and this is a SGST, that is the state GST, which will go to the third state government here, which will go to the third state government, because this is the state where the consumption of the good has actually taken place. That, so this is how interstate and interstate GST will work. What you need to observe is simply 2 points. Is there input tax credit provided at every step? Yes, under GST. Whether it is within the state, across the state, doesn't matter. At every step, input tax credit is provided under GST. Second, is there cascading effect? Earlier, yes. As a pre-GST, yes. Currently, no. We want to eliminate the idea of cascading effect with the implementation of GST. Done. So this is how the GST is going to function, and this particular structure will be much better compared to the earlier taxation structure. Now there was one committee, Arvind Subramanian committee, which was set up by the government, and which has given certain important recommendations. Now, what is the importance of this particular committee? If a question is asked in the UPSC mains, give certain recommendation. You can quote these particular recommendations and say these are as per the Subramanian committee. First one, we will have to simplify tax administration, protect the revenue, and encourage compliance. What do you mean by this? Whenever you're going to shift from one tax structure to another tax structure, again, earlier there was a VAT system, service tax, excise duty, etc., and you're shifting from that to the current GST structure. The new structure of the taxation should be very, very simple. Comparatively, it should be very, very simple. And when the new tax structure is simple, generally it promotes more and more compliance in the market. That is, if I'm a taxpayer and if I come to know that okay, GST is much simple compared to the current taxation structure, I will be very happy to comply or come under the ambit of the GST. So the registrations, compliance, filing of GST, etc., will increase. Right? So simplify tax administration, protect your revenues, encourage more and more compliance. 3 rates are actually recommended. One was a standard rate, 17 to 18%, lower rate of 12%, and sin rate or demerit rate of 40%. That is, those particular goods which are referred as sin goods or demerit goods, which will harm the society. That is basically more the consumption of this, more harm is done to the society. On those particular goods, they recommend having a tax rate of 40%. And those particular goods and services, right, which are basically consumed by these particular poor households, they recommended a lower rate of GST of 12%. And those particular goods which will not fall under the first category as well as the second category, a standard rate of 17 to 18% was recommended. Third one, alcohol and real estate must be brought under the ambit of GST. Government of India is trying this now. That is basically GST council. 1% interstate GST should not be implemented. That is, here the proposal was, imagine the good is manufactured in state 1 will be transferred across the state border, let's say to state 2 for selling purposes. Imagine this particular pen. Under GST, this particular pen attracts a rate of 12%. Is okay? Under GST, this particular pen will attract a rate of 12%. But when it is manufactured and sold in the same state, the rate will remain same. Manufactured and sold across the state border. That is manufactured in state 1, sold across the state border in the second state. In addition to 12%, there will be 1% extra. Is okay? 12% as usual is applicable. This particular 1%, I'll call this as an interstate GST. And the logic that was recommended earlier was that this particular 12% will be given to whom? State 2, because the good is being consumed in the second state. And the state 1 will be losing revenue. So we'll collect this particular 1% and give it to the first state. This was actually recommended earlier. In fact, in the 115th Constitutional Amendment Bill, is okay, in 115th CAB, in fact, this particular provision was there. But when we introduced the 122nd Constitutional Amendment Bill, that is basically by a new government, we withdrew this particular provision. Why? Logic was very simple. The committee recommended that one of the objectives that we are trying to achieve under the ambit of GST is one nation, one national market. That is, whether this particular pen is sold in the state 1, state 2, state 3, state 25 doesn't matter. The rate of GST applicable on the pen shall remain same, uniform across all the states. But in this particular case, what is happening? In case of state 1, the rate of GST on the sales is at 12%. But when it moves into the second state, we are increasing it to 13%. So do you think that leads to creation of national market? No. So do not implement it. We are not implementing it. Compensation should be paid by the center to the states. We are doing it. GST implementation must be evaluated after every 1 or 2 years of implementation. So these are some of the very important recommendations of Subramanian Committee. Now next, there is a concept of GST network, goods and services tax network. Now the importance of this, I'll come to the current affairs. The importance is the goods and services tax network is basically a non-government organization or a non-profit organization. Okay, some of you will be confused. So what do you mean by non-government? The non-profit organization like this. Under the Companies Act, okay, under the Companies Act, there is one section, that is Section 8 company. Is okay, under the Companies Act, there are certain companies which are set up, right, under Section 8. These are essentially referred as a non-profit organizations and non-profit companies. Some of you might be thinking that company essentially means they have to generate a profit. Okay, they'll have to generate a profit. Then how can they not generate a profit when you say it is a non-profit organization? First and foremost, understand this very carefully. When I'm saying a non-profit organization, I'm not saying that it doesn't generate a profit. It will generate a profit. Understand this? It will generate a profit because any company, any business essentially generates a profit. If you're manufacturing, selling, if you are providing certain services, you impose charges on that, there is a profit component present. But the idea here is the profit that is generated is not given to the owners of the company. I will repeat it. The profit that is generated is not given to the owners of the company. It is basically again invested back in any services that are being provided by the company itself. Is it okay? In case of a goods and services tax network, there are certain owners. Is it okay? I've given you the picture here. I'll come to this just a minute. There are certain owners. So GST network, it basically provides IT infrastructure to all the stakeholders. Meaning what? In the implementation of GST, who are the stakeholders? Government is a stakeholder. The companies are stakeholders. The businesses are stakeholders. Service sector entities are stakeholders. Sellers are stakeholders. So essentially, the services such as filing the GST returns, registering under the GST, etc. All of these particular services, for that you require certain infrastructure. This infrastructure is provided by goods and services tax network. That, and when you provide these kinds of services, you're going to impose certain charges and collect these particular charges. Okay. Now, whatever profits is generated by this particular company will not be given to the owners of the company. Again, it will be utilized in providing the services itself. And that is the reason these are referred as non-profit organization. Non-profit organization. First point. Secondly, under Companies Act of 2013, these are also referred as Section 8 companies. And some of the books or some of the magazines or papers that you're referring, they will use another term here, Section 25 company. And you will get confused and say, sir, you're telling something and the book is saying something. Please understand this. Under the earlier Companies Act of 1956, is okay? Earlier, we had Companies Act of 1956, these were referred to as Section 25 companies. But as per the Companies Act of 2013, these are referred as Section 8 companies. Is okay? Both are one and the same. Only difference is the name of the section or the number section varies from one act to another. Now, who are the shareholders? Who are the owners in this particular GST network? Right? Remember, this particular GST network has been broken down into two components. 24.5, that is 49% of the ownership will be with the center and the state government. Remaining 51% will be with other stakeholders, other owners like this. Is okay? 49% equally divided between the central government as well as the state government. Remaining 51% is right in between LIC, ICICI, HDFC, NSE, etc. like this. Now, very recently, Government of India stated, this is connected to the that is the reason I'm giving an update here. Very recently, Government of India announced that rather than having ownership by other entities, will transfer the complete ownership to the government now. Is it okay? Rather than having these entities who are having certain amount of ownership in the GST network, we will completely transfer the ownership. That's 100% will be transferred to the government now. That is between the central government and the state government. That has been announced by the government. The next one, anti-profiteering measures. Okay, anti-profiteering measures. Now, what do you mean anti-profiteering measures here? Let's start. Anti-profiteering essentially means government under GST says that whenever the tax rates are reduced, is okay? I'll give an example, understand better. Whenever the tax rates are reduced, the benefits of this particular rate reduction must be transferred to the consumers in the market. Is it okay? I will repeat the statement here, understand this very carefully. Whenever the tax rates are reduced, the benefit of a tax rate reduction must be transferred to the consumers. If the benefit is not transferred or partially transferred, then government says that this is profiteering. Okay? If the benefit of rate reduction is not completely transferred or not transferred, then government simply says the seller or manufacturer is a profiteering. And the idea of profiteering means it is excessive, unreasonable profits. Is okay? Excessive, unreasonable profit. Now, what do you mean by this? Let me give you an example. Let's imagine before the GST rate is reduced. Imagine this particular pen. The seller wants to sell a pen in the market at 100. The government has 18% GST. Essentially, the MRP, right? That is the price at which you purchase in the market has to be 118 rupees. Now, government will reduce the GST rate applicable from 18% to 12%. Then essentially, what does it mean? It simply means selling price is 100, tax rate of 12. The MRP should be reduced from 118 to 12. MRP rate should be reduced from 118 rupees to 112 rupees. And if the seller actually reduces the price like this, he has transferred the complete benefit of rate reduction to the consumer. I'll repeat the statement. It essentially means he has transferred the complete benefit of rate reduction to the consumer. That is you. But what if I say that with the reduction in the GST rate, either he doesn't reduce the market price, he will continue to sell it at 118. The argument here is when the GST rate has been reduced from 18% to 12%, he is paying how much tax to the government? He pays 12 rupees to the government. So from 18 rupees, the tax that he is paying to the government has come down to 12 rupees. Don't you think that the market price should come down?
Yes. Now what if I say that? Okay, first situation, 118, right? And no benefit transfer to the customer. Now you say, sir, nothing has been given to customers. I give you second situation. What if he sells the product now at 115 rupees? 118, no. 115, yes now. In case of 115, the problem is, yes, sir, he will give 12 rupees a GST to the government, essentially reducing the selling price to how much? 103. But have a look at this, right? He's selling price, earlier was 100. Now has been increased to 103, which essentially means he's making higher profit. Again, he's earning higher profit here. So with the reduction in the GST rate, if the seller or manufacturer doesn't transfer any benefit of rate reduction to the customer or transfers only partial benefit to the customer, this is called as profiteering. And government simply says, I will not allow you to profiteer under GST. It's okay, you can earn profit, but I will not allow you to earn excessive unreasonable profit. If I have reduced the GST rate, you will also have to reduce the market prices. Right? For this, Government of India set up a new National Anti-Profiteering Authority. Is okay? National Anti-Profiteering Authority. Right? And this National Anti-Profiteering Authority can receive complaints from the customers, investigate whether the company or seller is profiteering, or can take up the case suo moto on their own and investigate whether the company or seller is involved in profiteering and impose penalties if there is a profiteering activity. Now, when this particular authority was established in 2017, the GST Council had essentially stated that the authority will function only for 2 years. Is okay? The authority will function only for 2 years, and that is the meaning of sunset clause here. And the authority should have functioned only for 2 years. After that, authority will be shut down. But the extension has been provided by 2 more years. That is in 2021. Again, the authority should have been shut down. Now, again, 1 more year extension has been provided for the National Anti-Profiteering Authority. And so this is one more concept related to GST. Now, what are the benefits or advantages associated with GST? Now, this is all of those. But let me put it in a single slide now. One nation, one tax, one national market. It will subsume the indirect taxes and cesses under one indirect tax. As a result of this will promote ease of doing business. Companies will find it easier to file their taxes. You don't have to have multiple registration. You don't have to file taxes at multiple points. Now it will become much easier. Cascading effect will be eliminated. Cooperative federalism, that is cooperation between center and states, will be promoted. Various sectors such as manufacturing, logistics sector will be benefited now. Eliminate the tax evasion under indirect taxes and will also promote formalization. Okay, so these are some of the benefits that are associated with the idea of GST. Now, in the context of GST and logistics, earlier also I've told you this. Let me repeat it. Implementation of GST is going to benefit the logistics sector. Okay, it is established. Implementation of GST will benefit the logistics sector. How so? When you evaluated earlier system, okay, when we looked at the earlier system, right, have a look at the problem here. Around right 40% of the time that was taken for transportation was actually spent right on transportation. Is okay. That is, let's imagine. Let's say a very simple number. Imagine from state A to right a particular point, state B. It takes 10 days for you to move these particular goods across one state, multiple states. Doesn't matter. Right? Just understand the concept here. It takes 10 days for you to move these particular goods. Essentially, out of these particular 10 days, only 4 days was the actual time taken for transportation. That is, for moving the goods, only 4 days were actually taken. What are the remaining 60% of 6 days? Out of this, around 2.5 days were actually spent at checkpost itself. That is, under the earlier system, if you wanted to move the goods from one state to another state like this, at interstate border, there was a checkpost. Is okay. The trucks or the lorries will have to stop at the checkpost, go to the authorities, submit all the documents or relevant documents, get the approval. Only then they will have to, or they will be allowed to move from one state to another state. So around 2.5 days was actually spent at checkpost, and remaining 3.5 days was actually spent at other official stoppages. For example, at toll booths. Understand? So only 4 days out of 10 days, 40% out of the total time taken was actually for transportation. Now under the GST, we simply say that there is no requirement to stop at checkpost. Is okay. The whole idea of a checkpost at interstate borders have been eliminated now. The trucks or lorries which are carrying the goods from one state to another state can easily move from one state to another state now. So it is going to provide a huge benefit to or boost to the logistics sector. Having said so, are there any concerns related to GST? Are there any problems related to GST? Yes. First one is the number of rates are very, very high. Is okay. The number of rates or slabs under GST are very high. Generally, the practice that is followed by majority of the countries is either there are 2 slabs, 3 slabs, etc. But India is one of the very few countries which has a 4 or more than 4 slabs. So you have to rationalize, reduce the number of slabs. Second one, for following the GST structure by basically filing the returns, generating receipts, right, collection of the bills, etc. The cost that is incurred, expenditures that are being incurred by the companies are actually increasing. Compliance burden for the companies are higher. Multiple tax rates are there. You have to rationalize this. Revenue protection has to be done right in this particular context. HSN codes have been used now. What is HSN code? Basically, whenever you manufacture and sell these particular goods, certain codes are allocated. Okay, and invoicing and e-way bill also has been introduced under the concept of a GST. There are certain goods which are exempted. You'll have to bring them under the ambit of a GST, right? And anti-profiteering have given it as a concern for a very simple reason. Some of the experts say that when you have a structure such as GST, that is indirect tax structure in the economy, what you can simply expect is the private sector in acquiring the market will transfer the benefit to the consumers. Will simply transfer the benefit to customers. Government doesn't have to interfere. Right? Through this authority, government doesn't have to interfere in the market. So the private sector participation is there. If the rate GST rate is reduced, automatically they will transfer the benefit. There is no need for this kind of authority, and that might basically lead to terrorism or tax terrorism in the system. Okay. Now this is in detail related to the concept of GST.
Next, what are the other features of GST? Dual GST and integrated GST. Now, please understand this. When we are talking about goods manufactured and sold within the same state, we simply use the term GST. But if you're talking about interstate trade and commerce, we use the term integrated GST. That is IGST. Okay, that's the only difference. Apart from that, rates, everything will remain the same. Now, have a look at this. When you talk about GST, there are 2 components to GST. One is a central GST, and the second one is a state GST. Okay, they will simply use the short form CGST and ESG EST. And same thing even with respect to IGST also. That is, there is a central GST as well as a state GST. Now, what is this idea of a central and a state GST?
Now, whenever we talk about GST, what we say, we have basically taken away the indirect taxes from the central government as well as the state government, and we have framed the model of the GST. And because we have taken away the indirect taxes from the center as well as the state, whatever is the GST collected in this way, half of it has to go to central government, and the remaining half of it has to go to the state government. What do we mean by this? Under the GST, we have different slabs or different rates. We have 5%, we have 12%, we have 18%, and we also have 28%. Okay, so these are the different slabs under GST. 5% is broken down into two parts, 2.5, 2.5. Right, each of these 2.5 will go to central government, and the other one will go to state. Right, 18% divided into two parts, 9% and 9%. The first 9 or 1 9 will go to the central government, the other 9 will go to the state government. This particular structure is called as a dual GST structure. Okay, now in case of integrated GST, please understand this. GST is referred to as a destination-based tax. Okay, it is referred to as a destination-based tax, or else it is also referred to as a consumption tax. The basic idea is, in case of a GST, that is when the goods are sold across the state border, the state where the consumption of the good happens, I repeat, the state where the consumption of the good happens, that particular state will get the SGST component. Let me elaborate on this. Imagine first the situation, I'll write S1. X manufactures a good, sells it to Y. Both X and Y are present in the same state. Then, right, imagining 18% GST rate is applicable, 9% will go to central government, 9% will go to this particular state government. Right? In the second situation, right, the same producer, X, manufactures a good, sells it across the border, right, to another state, or a buyer who's sitting in the second state. And let's say this particular buyer, second buyer, I'll assume it is B, he will sell it to consumer C. So in the whole process, SGST is collected, so have a look at this, CGST is collected, SGST is collected. In the second situation, this particular SGST will go to this particular state government. That is the second state government. Okay. In the first case, consumption happens in the same state where the production has happened, so the SGST component will go to the same state government. But in the second case, what is happening? Production is happening in one state, the goods are moving across the border, and the consumption is happening in the second state. Right? And because the consumption is happening in the second state, the SGST component will simply go to the second state government. Now, some of you simply say, so what if there is a right, further trading into the third state? That is, have a look at this. State 1, A is here, manufacturing good, he will sell it to B, who's sitting in state 2, he will use it as a raw material, manufacture good, will sell it to C, who's sitting in state 3. Now, in this particular transaction, if the consumption is happening in the third state, okay, then the SGST will go to this particular state government. And there should not be any confusion with respect to CGST, because it doesn't matter whether the good is consumed in the same state where production happens or in another state apart from the state of production. CGST anyways will go to the central government. That is the precise reason, right? We use the terms such as destinations, consumption-based taxation related to GST. Then, next one. In the earlier bill, which spoke or which tried to introduce the concept of a GST, that is 115 the Constitutional Amendment Bill, there was a provision with respect to additional levy of 1% in state of, or in the cases of interstate trade and commerce. What's the meaning of this? Have a look at this. The proposal was, imagine this is the first state where production is happening. The good moves across the border and is sold in the second state. Now, generally, have a look at it. If the GST rate applicable is 12%, because the good is moving across the border, it is being sent to another state. In addition to 12% GST, it proposed 1% interstate GST. Okay, it proposed 1% interstate GST, and the further proposal was this 1% will be collected and given to the first state government. This was a 1% additional interstate levy, which was earlier proposed in the 115th Constitutional Amendment Bill, and the government has actually withdrawn it. It is not present in the 122nd CAB. Right now, it is not there. Third, there are certain goods which are exempted, which are kept out of the purview of the GST. These are not even covered under the ambit of GST. Alcoholic liquor for human consumption is the one best example for this. In addition to this, have a look at this. GST Council will decide when to impose taxes on crude petroleum, high-speed diesel, petrol, aviation turbine fuel, etc. Right? In essence, these particular commodities, although are covered under GST, so far GST Council has not yet notified the rates on this. Once it is notified, GST rates will be applicable on all of them. And the last and the very important feature related to GST is a compensation will be given for a period of 5 years. Note the side of a compensation. Understand the logic very carefully. Imagine here is a state government. A, B, C. Is okay. This is a state government. Before GST was introduced, A, B, C could simply impose number of indirect taxes and collect these particular tax revenues and use it for budgeting purposes. With the introduction of GST, what has happened? Some of these particular indirect taxes have been taken away from the state of ABC, and these have been kept under GST now. The problem here is the state government ABC individually or alone unilaterally cannot decide these indirect taxes now, because that particular power has been given to GST Council. Yes, ABC is a part of the GST Council, but earlier it could simply decide the rates on these indirect taxes. Today, because this is part of a GST, the state government unilaterally cannot decide the rates. So the concern for this particular state governments was, what if I give away the powers of indirect taxes under GST, and the amount of revenue that I'll be able to collect under GST will be lower, right? In simple terms, they were worried about the revenue implications of giving away the taxation powers under the GST. For this, central government basically introduced the concept of a compensation and stated that once the GST is implemented, for the first 5 years after the implementation of a GST, or 5 years of implementation of GST, I will provide 100% of the revenue shortfall in compensation. I'll read the statement. With implementation of GST for the first 5 years, 100% of the revenue shortfall shall be paid in the form of a compensation by the central government to the states. Now, what is the meaning of this? For this very carefully. Imagine this particular state government used to impose these particular indirect taxes and collect 100 crore rupees like in the year 2015 and 2016. And whatever was the indirect tax revenue collected by this particular state government from these particular indirect taxes, which are basically subsumed under the GST in 2015 and 16, I'll take this as a base year for calculation or base number for calculation. Right? What is this? Central government says whatever indirect taxes have been subsumed under GST from the state level, and from these particular indirect taxes, how much revenue was collected by these particular states in 2015 and 16 will be taken as a base. And from this year onwards, I'll simply assume that these tax revenues will grow by 14% per year or per annum. These revenues will grow by 14%. Right? Let's elaborate so that you understand. In 2015 and 16, how much indirect taxes were collected by the state government? That is basically those particular indirect taxes which are subsumed under GST. 100 crore. Then in 2016 and 17, right, the government says these tax revenues should increase by 14%. So from 100 crores, it will increase to how much? 114 crores. And in 2017 and 18, further this will increase by 14%. That is 114 crores plus 14% of 114 crores. Then right, the same calculation will be used for the remaining years also. Now you don't have to mug up the calculation here. Calculation is not important. You'll have to remember this particular number. And understand this. Let's take an arbitrary number here. Let's say for 2020 and 21. Is okay? For financial year 21, let's ask for this particular calculation. This particular state government ABC is supposed to collect, let's say 170 crore rupees. Again, I'm not calculating. I'm just taking an arbitrary number. That is, as per this particular formula, from 1 year to next year, these particular indirect tax revenues, which are subsumed under GST, would keep on increasing by 40%. I will simply call this as expected revenue collection. Is okay? This is expected revenue collection. As per the formula, this is how much the state ABC is supposed to collect under GST. Now, what if in that particular year, that is in the financial year 21, the state ends up actually collecting 130 crore rupees. So this is actual revenue collection. Is okay? So expected as per the formula is how much? 170 crore rupees. Actually, how much has been collected? 130 crore rupees. So the difference between this, that is a 40 crore rupees. This is called as revenue shortfall. And central government says this particular revenue shortfall, 100% of this will be paid in the form of a compensation to this particular state. So in the same way, for every year, since the GST has come into force, right, the revenue shortfall will be calculated. And whatever is the amount of revenue shortfall, it will be compensated by the central government 100%. Means what? I will look at this. The GST has come into force from 1st July 2017. So imagine in the financial year 18, a particular state had a revenue shortfall of 10 crore rupees. Government says a full 10 crore rupees I will compensate you. In the financial year 20, if a particular state had a revenue shortfall of let's say 250 crore rupees, full 250 crore rupees, 100% of this will be compensated by the central government. So for the first 5 years, after the implementation of GST, right, the central government would provide 100% compensation for any revenue shortfall that is incurred by the states because of the GST implementation. This is the concept of a compensation. Now, central government to provide compensation to the states under the concept of a GST has introduced GST compensation cess. Remember this, has introduced GST compensation cess. That is, under GST, as already mentioned, there are different slabs. We have 5%, we have 12%, we have 18%, we also have 28%. Now, in some of the goods which are kept under the ambit of 28%, right, some of the commodities which are under 28%, in addition to the rate of 28%, central government imposes compensation cess. For example, if you purchase a luxury car in India, right, a luxury car in case of India, you will have to pay GST rate of 28%, but in addition to this, you will also have to pay compensation cess or simply cess of 20%. And if you purchase a SUV in India, in addition to 28%, you will also have to pay a cess of 22%. So on some of these particular commodities which are considered as demerit goods, sin goods or luxury goods, the GST Council imposes a cess in addition to 28% slab rate. And any amount which has been collected within this particular compensation cess will be utilized by the government to pay for the revenue shortfall for these particular states. Next point, this particular revenue shortfall generally is calculated for annual range or annually, but please understand, central government for every 2 months will keep on paying the compensation to these particular states. Second very important point, some of you will have this kind of a doubt. So you're simply saying the amount of cess that is collected will be used to pay for compensation to the states. We get it. But what if there is a particular situation where the amount of cess which is collected under GST is smaller than the revenue shortfall? What will happen in this particular situation? Very valid doubt. Understand this. In such situation, the GST Act says that central government will have to basically ensure that the revenue shortfall of the states is compensated for by taking the funds from consolidated fund of India. In case of a situation where the amount of cess collection or collected is lower than the total revenue shortfall of all the states, in such a situation, central government has to take the funds from the consolidated fund of India and transfer it to the states like this. So this is a discussion with respect to the other features of the GST.
Now, this particular table basically provides all the slabs which are there in the GST and the idea of a dual
GST structure that we're following, and also the concept of integrated GST. As earlier discussed, basic idea is whenever the goods are sold within the same state, we use the term GST, goods and services tax. And whenever the goods or services are going to be traded across a state border, that is produced in one state, consumed in another state, in that particular situation, rather than using the concept of GST, we use the term integrated GST. It's okay, I'll repeat it again. Whenever a good is produced and consumed within the same state, we use the term GST. And whenever goods is produced in one state, consumed in another state, we use the term IGST. Now, if you ask me, sir, why we are using two concepts like this? First and foremost, although the terms are slightly different, that is in first case GST, second case IGST. Please understand the underlying concept doesn't change. That is, GST rate will be imposed, tax will be collected, and will be equally divided between center and the state. Then what is the basic difference here? In case of the GST, when the good is produced and consumed in the same state, let's take a very simple example. Imagine this is state 1. So good is produced in this state as well as consumed in this particular state. So when production and consumption, both of them happen in the same state, half of this particular GST, and let's take an arbitrary number here. Imagine the GST rate applicable is 18%. So half of this particular 18%, that is 9%, will go to central government, CGST. And remaining half of this, that is remaining 9%, will go to the state government, which is the government of state 1. Is okay? Right? So the state 1 itself will get SGST component. Second, what about the IGST? Let's have a simple example here. Imagine the good is produced in state 1, then is consumed in the second state. Is okay? Consumed in second state, but produced in the first state. Imagine this particular pen itself. So on this particular pen, imagine the rate of GST is 18%. So half of this particular rate, that is 9%, will go to CGST. This will not change. As usual, it will go to CGST, central GST. That is 9% will go to the state where this particular good, that is the pen, is actually consumed. And whenever I use the term consumption in the context of GST, do not literally assume that we are going to eat, because consumption for a layman or for a common man means for eating. So consumption of goods is also done, consumption of services is also done. If I start using this particular pen, it is as good as saying that I'm consuming the pen itself. Okay, so have a look at this. This particular 9% will go to central government CGST, and the other half, that is remaining 9%, will go to the state government SGST component. Now the question is, which of the two states will get this particular SGST component? Very simply remember this: the state where consumption happens. Is okay, I'll repeat the statement. The state where consumption happens will get the SGST component. That is the second state. Now some of you looking at this particular picture will simply say that, so in that case, we feel that, or I feel that, it is a disadvantage for the first state.
because the first state production is happening, but because the consumption is happening somewhere, right? Or let's say the second state or the third state where the consumption happens, we get the GST component. I don't think the first state is losing money. Please understand, when you look at only one transaction, yes, you will feel that state 1 is not getting anything, and in this example, state 2 will get GST component. Absolutely correct. But please understand the 2 points very carefully here. First point, in this particular case, when you always assume that state 1 is going to lose the revenue, you're assuming whatever is produced by yes 1 will always be consumed in yes 2. Again, so you're simply assuming that whatever is produced in the state 1 is completely consumed in the second state. If that was the situation, definitely yes 1 will not be collecting anything. But you think in reality, this will happen? Whatever is produced in one state, everything is sold into the second state, consumed in the second state. Do you think that actually happens in the economy? No, that will not take place. So part of this will be consumed in the same state. So obviously, because it is produced and consumed in the same state, the state 1 will also get certain amount of yes GST. First point. Second point, in this example, I stated that this pen was manufactured in yes 1 and consumed in yes 2. In the same way, right, a similar product, let's say a mobile, a laptop, etc., which is produced in the second state, might be sold and consumed in the first state also. Have you understand? What is produced in the second state, part of it would be consumed by state 1 also. And in this second example, who will get the SGST component? It is the first state which will get the SGST component. So again, understand this. Only look at one transaction, yes, you will feel that state 1 will not get anything, everything will go to state 2. Right? Only one transaction, that holds true. But in reality, there are so many other transactions wherein the production will be done in some other state, consumption will be done in the first state. So SGST will be collected by whom? First state. And whatever is produced in the first state, everything is not sold across the border in other states. A part of it is consumed in the first state itself. So state 1 will collect SGST there also. In fact, please understand this, the same concern was raised by some of the states which are referred to as production states. It's okay, there are certain states in India which are referred to as production states. For example, Tamil Nadu, Karnataka, Andhra Pradesh, Maharashtra, Gujarat are generally referred to as production states. And the concern, right, which are raised, same concern was actually raised by these particular production states. Clarification has been provided. First thing. And second thing, if you see how much GST collection has been done by various states, is okay. And where will you get this particular data? From economics, we will get this kind of data. Budget documents will get this kind of data. So when you analyze how much GST is collected in India and how much has been the share of all these particular states, what you will realize is most of these particular states which are referred to as production states are the states which are able to collect a very, very high amount of GST. Is okay. They are able to generate a huge amount of GST revenue. That next important point. I've given certain number of goods which are provided or which are covered under various GST rates. Should you mark up this particular number? Absolutely no. Do not mark up this particular number. Why? It was this particular category or it was this particular number of goods which are kept under these particular slabs at one point of time. By the time you write the exam, the number of goods under these particular categories would have changed. For example, the GST Council could have decided, let me take some of the goods which are falling under 28% slab. Is okay? Let me take some of the goods which are falling under 28% slab. Let me shift them to 18% slab. Can that be done? Yes, definitely. In fact, once the GST has come into implementation, over a period of time, many of these particular commodities or items have been shifted from a higher slab to a lower slab. That has been done already by GST Council many of the times. So you don't have to mark up these particular number of articles or goods or services which are covered under which slab, not ever required for UPSC. And next up, so what is this particular breakup that I have given? In case of India, as already mentioned, the GST is implemented in different slab rates. There are different slabs under which GST is implemented. The most important slabs are 0%, 5%, 12%, 18%, and 28%. Is okay? I'll repeat the statement here. There are different slabs under which the GST structure has been framed or GST is being implemented. But the most important slabs for you will be 0, 5, 12, 18, and 28%. Now these are the most important slabs under which majority of the goods as well as services have been classified. Done? And whenever you talk about any of these particular slabs, you have to break up this particular slab into 2 equal parts. Is okay? Any GST rate will have to be broken down into 2 equal parts. Why? As earlier mentioned, we are basically following a dual GST structure. And in the dual GST structure, the GST rate is equally divided between the central government and the state government. And to be very, very specific now, the state government, where the consumption happens, will get the SGST component. And this particular feature, follow this very carefully, this particular feature wherein the state government, where the consumption has taken place, will get the SGST component, is a feature of a destination-based taxation. It is a feature of a destination-based taxation. VAT was a destination-based taxation. GST is a destination-based taxation. Now, is there any other form of this? Definitely yes. Have a look at this. On one side, VAT, GST are destination-based taxes, whereas there was earlier a tax referred as the central sales tax, CST. Is okay? Central sales tax. And what is the concept of CST? Earlier, that is before the implementation of GST, when we had VAT system, value added taxation system, VAT was basically a feature of the tax policy implemented by the state governments. Is okay? And the state governments actually implemented the VAT structure. Central government basically facilitated the implementation of VAT. Now, VAT, because it is framed, implemented, collected, utilized by the state government. What if a particular good is manufactured in one state, then moved across the border to another state? Is okay? Take the example of this particular pen. Imagine this is manufactured in state 1, then moved across the border, sold, consumed in the second state. Now, whenever you're talking about interstate trade and commerce, understand my statement here. Whenever you're talking about interstate trade and commerce, state governments cannot impose the taxes on this because as a state government, this government is empowered only when the good is manufactured and consumed in the same state. But in this case, good is that this particular pen is manufactured in one state, then moved across the state border, then consumed in the second state, sold and consumed in the second state. So do you think state 1 has the right to impose taxes on this? Absolutely no. Interstate trade and commerce comes under the powers of the central government. So earlier central government had a concept of central sales tax. Although it was basically announced by the central government, the central sales tax was actually administered, that is implemented by the respective state governments. For example, same pen, manufactured in the first state, moved to the second state. So because this is interstate trade and commerce, which tax must be applicable, central sales tax must be applicable. But imposed and collected by whom? Respective state government. So state government 1 would simply impose a tax on this central sales tax, collected, and the same state government used to use this particular central sales tax. So have a look at this. In this example that I'm telling you, the tax is imposed at the point of origin. Is okay? At the point of production. The good is being produced in the first state. So the first state will impose the tax and collect it and use it. So unlike GST, where the good is imposed with the tax, but that particular tax, that is GST component, will go to the state where consumption happens. Under CST, the tax was imposed and collected in the origin state itself, in the production state itself. And that is the reason central sales tax was basically referred to as origin-based taxation. Is okay? It is an example of
origin-based taxation, GST VAT, destination-based taxation, and CST, origin-based taxation. Done. Now, are there any of these particular goods which are not covered under GST right now? Not covered essentially means what? GST rate is not applicable, or it is not even brought under the ambit of or purview of GST. Please understand the fuel products such as petrol, diesel, ATF, etc. right now are covered under GST. They are part of GST, but so far the GST Council has decided we will not announce a GST rate on this. And on the other hand, some of the products such as alcohol for human consumption, it has not been even brought under the GST as of now. Is it okay? Right? So there are certain goods on which GST rate as of now is not yet notified. Let's continue. The GST, goods and services tax, will subsume some of the taxes at the state level and some of the taxes at the central level. And please remember this, these particular taxes are indirect taxes. Is it okay? These particular taxes are indirect taxes. First point. And when you have a look at the number of indirect taxes plus cesses which have been subsumed at a central level and a state level under the ambit of GST. Today, more than 40 types of indirect taxes and cesses at state and central level have been subsumed under GST. Now, just for sake of information, I've given you a list of these particular indirect taxes which have been brought under the ambit of GST. Please have a look at it, and if you ask me, please mark up 3 to 4 types of taxes which are mentioned here, and another 3 to 4 types of indirect taxes which are mentioned here. Why? There are two ways the question can be asked in the UPSC exam. One, he might ask you a question on this in the prelims. Is it okay? In the UPSC prelims, a question can be asked. Straightforward question could be, which of the following indirect taxes, or you can simply say taxes, are subsumed under the ambit of GST? A question can be asked. Second, he might ask you as a part of the mains-based question also. For example, a couple of years ago, UPSC in fact asked a question which had 2 parts. Mains question which has 2 parts. And the first part was enumerate, list out the taxes which have been subsumed under the ambit of GST. So the kind of questions which can be asked in UPSC, right, are varied. So just to be on the safer side, please mark up, right, 3 to 4 types of indirect taxes on both the sides. Let me continue. In the context of GST, goods and services tax, generally what we say is the goods and services tax, that is a GST, has a central theme which is one nation, one tax, and one market. Is it okay? One nation, one tax, and one market. Now, what do you mean by this? One nation, straightforward, they are referring to India. One tax essentially refers to the object of GST to subsume the indirect taxes and have only one type of indirect tax. And what about one market? One market basically refers to the national market, wherein the object is to ensure that across India, whether the good is sold in state X, Y, Z, A, B, C, doesn't matter, the GST rate applicable on this particular good will be the same. Is it okay? I'll repeat it again. Whether the good is sold in any state, doesn't matter, the GST rate applicable will be one and one across India. What do you mean by that, sir? Let's take an example of this particular pen. Imagine this pen is being sold in Himachal Pradesh, and let's say hypothetically GST rate is 18%. So if the pen is sold in Himachal Pradesh, rate of 18%. Uttar Pradesh, 18%. Bihar, 18%. Gujarat, Karnataka, Tamil Nadu, Maharashtra, Kerala, doesn't matter. The rate of GST applicable on this will be 18%. And that is called as a national market. Is it okay? The rate of taxation will remain uniform, it doesn't change. That is the idea of a national market. Done? So one nation, one tax, and one national market. Now, having said so, if you have followed the discussion, just some time ago I basically stated that in case of GST, although we say this is one nation, one market, one tax, there are multiple slabs within this GST. That is, there's a slab of 5%, 12%, 18%, and 28%. Okay, these are the slabs. Why did government of India have this kind of an approach? Why did the GST Council decide to have so many rates of a GST rather than having a single rate of a GST? Let's have a critical evaluation with respect to this. Have a look at this. First, let me go through all the points citing which GST Council has adopted this particular approach. First one, there are too many groups using too many goods. And so based on the goods used by these particular groups, different tax rates are required or needed. So what do you mean by this? Let me give a very simple example. In case of India, there are households which consume essentials only, for example, food commodities, clothes, etc. And there are certain households which consume essentials plus certain luxury products. And there are certain households which spend a lot of money on luxury products compared to the spending that they do on essentials. For example, high net worth individuals, rich people, they spend a lot of money on luxury products compared to the money that they spend on other commodities or other items. So in case of India, there is no single group with respect to consumption of goods or services. There are different groups and the consumption patterns will be different. So in this particular situation, imagine there is one household which is purchasing a Hawaii chappal and there is another household which is purchasing, let's say, an Audi car. Do you think it is preferable to impose the same rate of GST on both of these goods? Do you think this is the right approach? A household which consumes Hawaii chappal, should they pay a GST rate of, let's say, 28%, which is actually imposed on Audi car? Do you think it is a feasible form of a tax? Absolutely no. So there are different consumption groups. The goods and services that they consume will be different. And when you have this kind of a structure in the economy, you cannot have a single rate of GST. You need to have multiple rates of GST so that you will be able to impose a very low rate of a GST on the goods that are consumed by poor households, and you'll be able to impose a very high rate of GST on the households or on the people who are spending a lot of money on luxury products. Second one, the government needs to maintain revenue neutrality. First and foremost, let me explain the idea of revenue neutrality here. Revenue neutrality essentially means that whenever the tax structure changes, whenever the tax changes, essentially, let's say you're shifting from one type of tax to another type of tax, or you're basically restructuring the tax rates within the same tax, the revenue of the government should not be affected. For example, let me give a very simple example. Again, don't bug this example, but let me give you a clear idea. Imagine government of India is imposing tax on two products, A and B. And let's say hypothetically, tax rate on A is 20%, and the cost of the product is, let's say, 100 rupees. And tax rate on B, let's say, is again 20%, and the cost of the product is 200. So have a look at this calculation very carefully. 20% on 100, government will be collecting 20 rupee tax here. 20% on 200, government will be collecting 40 rupee tax here. Okay, just see the calculation. So totally, government will be collecting how much tax revenue? 60 rupees. Now what if government of India simply says, I will reduce the tax rate on product A from 20% to 10%. Is it okay? I'm going to reduce the tax rate on the product A from 20% to 10%. Now have a look at the second calculation. If government imposes 10% on 100, government will be collecting 10 rupee tax. And 20% on 200, that is, it is not changing on the second product. Same thing.
rupee tax. Now government will be collecting how much taxes? Government is collecting 50 rupees, which is lower than the earlier collection. So with changes in the taxes or tax rates, the revenue of the government might be affected. But the whole idea is whenever you change the tax rates or taxes like this, your revenues should not be affected, should not come down, and you'll have to maintain or earn at least the earlier amount of tax revenues. That is the essential idea of a tax neutrality or revenue neutrality. How can I have revenue neutrality when I'm changing the tax rate on productivity and not on productivity? Can I have revenue neutrality? No. I can only talk about the tax rates here. So have a look at this. If Government of India changes the tax rate on productivity to 10%, it will increase the tax rate on productivity, let's say to 25%. Now, as per the third calculation, 10% of 100 will be how much? 10 rupees. 25 percentage of, let's say 200 rupees, will be how much? 50 rupees. So how much I'm able to collect? I'm able to collect the same amount of revenue. That is revenue neutrality. So when the government is shifting from the earlier tax rates, earlier VAT was there, excise was there, sales tax was there, service tax was there. So rather than having that particular structure, now we are shifting to a new structure of a GST. Government needs to ensure that its revenues are protected. And if you have a single rate of a GST, let's say 5%, okay, if you have a single rate of a GST, let's say 5%, do you think the revenues of the government would be affected? Right? So in order to maintain the revenue neutrality, the government has decided to have multiple tiers of GST, because on some of the goods and services, when the tax rate is low, the revenues will come down. And for some of these goods and services such as luxury products, government will impose a higher GST rate to collect higher amount of tax revenues. Third one, it will lead to inflation if all or majority of the commodities used by the poor are in higher slab. What do you mean by this? Let's give a very simple example. Some of you might be thinking, sir, let's keep a flat rate of GST, single rate of GST on all the goods and services. But there are more than 1,200, 1,300 goods and services which are covered under the ambit of GST. So if you have, let's say, only 5% rate of GST applicable on all of this, but I think the revenues of the government would be affected. That's the first point. Second point, the people who are purchasing high-end luxury products such as Audi car should be paying higher rate of GST. They should not be paying lower rate of GST. It makes perfect sense. Because understand this, in the context of taxation, we are going to impose the taxes as per the ability of the person to pay. Understand this? A very good taxation structure always focuses on imposing and collecting taxes based on the ability of the person to pay these particular taxes. Don't you think a person who can spend 50 lakh rupees, 60 lakh rupees to purchase a luxury product or a car in this matter should be asked to pay a higher rate of GST? Definitely yes. Right, so have a look at this. If you have only 5% GST rate applicable on all the goods and services, it doesn't make any sense. Yes, the goods which are consumed by the poor people will remain cheaper, but it doesn't make any sense in terms of revenue, in terms of imposing taxes on the rich people. Now some of you will be thinking, in that case, why don't we simply raise the tax rate on all the goods and services to let's say 28%? You're saying 5% will lead to loss of revenue. Okay, let's increase the tax rate on all the goods and services to 28% directly then. Okay, in that case, what is the problem? The problem is yes, understand this, no doubt. Okay, you'll be able to collect large amount of tax revenues, no doubt. But the problem here is when you increase the GST rate on all the goods and services to 28%, then essentially, first point, the goods will become very, very costly in the market. For example, today many goods which are specifically consumed by the poor households are either kept in 0%, 5%, etc. Rather than imposing a low rate of GST, now these particular goods and services will start attracting high rate of GST, 28%. So do you think these particular goods and services will become very costly? Definitely yes. Second, when they become very costly, do you think the poor households will be able to afford these particular goods and services? No, it will go to a point wherein the amount of income that these particular households have will not be sufficient to purchase these essential commodities. And the third one, when the market prices of the goods and services will start rising up, can I simply say that it will add to inflationary trends in the market? Yes. So you have a very low rate of GST, uniform GST, problem. If you have very high rate of GST, only one rate, that's also a problem. Next one, it may also become regressive in nature. Why? If you have a single rate of GST, earlier I told you this, it simply means the people who have a sufficient amount of money, who can spend lakhs of rupees on luxury products, they are paying low rate of GST. Whereas poor households, whose income is very limited, whose sources of income are limited, are paying the same rate of GST when they're consuming these particular products in the market. So it becomes regressive in nature. I can also understand this. I'll take a calculation so that you understand the concept clearly. Imagine there are two people, A and B. Okay, A and B. A is earning 100 rupees, B is earning 10 lakh rupees. Is okay, A is earning 100 rupees, B is earning 10 lakh rupees. If A pays 10 rupee out of 100 rupees, is okay, if A pays 10 rupee out of 100 rupee, it essentially is how much? 10% of his income. Is okay? A is essentially paying 10% out of his income. And if B pays, let's say 100 rupee out of 10 lakh rupee income that he is earning, I can understand this. If B pays 100 rupee out of 10 lakh rupee that he is earning. So understand this, compared to A, B is paying a higher tax rate, no doubt. I can understand. The amount of taxes paid by B are higher compared to A, no doubt, because A is paying 10 rupee, B is paying how much? 100 rupee. But when you compare the taxes paid to the income that is earned by these people, A is paying 10% of his income in the form of a tax. B is paying how much? He is paying only 1% of his total income in the form of a tax. So do you think, right, B should be paying a higher amount of taxes here? Definitely yes. And that is the reason I say that, right, if you have a uniform rate of a GST, it could make this bigger structure regressive in nature. And so these are some of the reasons why in case of India, we are following a multiple slab structure. And please understand this, GST is a concept of indirect tax. India is not the first country to implement this. There are more than 150 countries around the world who have actually implemented GST. India is one of these particular countries. But when you talk about the GST structure, there are two important points here. One, India is one of the very few countries which has a dual GST structure. Right? What do you mean by dual GST? GST has two components, central tax as well as state tax. India is one of the very few countries which has a dual GST structure, right? Like we have in case of Canada. Second important point, many of these countries either have a two rates under the GST, three rates under GST, or a single rate of GST. India is one of the very few countries around the world which actually has a multiple rates of GST or multiple tiers under GST. Have you understand this? It is one of the very few countries around the world which has multiple tiers or multiple rates under the GST. So these are the reasons why we have gone for multiple tiers. Having said so, right? Are there any concerns related to this? Are there any issues related to having multiple tiers of GST? First one, it makes administration of the GST very, very difficult. What do you mean by this? More and more rates of GST that you have, the amount of a filing or the amount of returns that you're supposed to
the information that you're supposed to collect, the receipts that you're supposed to collect, the tax officials who are supposed to go through all of this, the complexity increases. So what do you mean by this? I did not understand. No worries. Let me start with an example. Imagine you're a manufacturer. Okay? Imagine you're a manufacturer. To manufacture, let's say, 3 products, you're purchasing 3 raw materials. Is okay? You're purchasing 3 raw materials and you're producing 3 products. And when you purchase 3 raw materials, I'm just throwing an arbitrary number here. Imagine the rate of GST applicable is 5%, 12%, and 18%. Is okay? 5%, 12%, 18%. And when you manufacture this particular product and sell it in the market, let's say you attack on some of the goods 12% GST, on some 18% GST, and on some 28% GST. Now, you will have to collect the receipts on which you paid GST like this. You have to collect all the receipts. You will have to generate a receipt here also. That is, on which good, how much GST you're going to collect and you're transferring to government. So based on this only, government would transfer input to tax credit in your name. Is okay? Government will provide input to tax credit to you. But understand this, more and more rates of GST that you have, you will have to keep a track of how much raw material at what rate of GST has been used for which product. You have to file all of those particular details. And not just you, even the tax officials will have to go through all of these particular details very carefully because they are supposed to provide input to tax credit for you. So administration becomes difficult, right? And that is one problem. Second problem is there is a term called as inverted duty structure. Okay, inverted duty structure. Now, what do you mean by inverted duty structure? Let me give a very simple example, then we'll connect it back. Imagine you're manufacturing this particular pen. Okay, simplify so that you understand and remember for a longer duration. Imagine you're manufacturing this particular product, and in the process of manufacturing, you purchased a raw material. Okay, you purchased a raw material, and when you purchase a raw material, you'll have to pay GST on this. And let's say hypothetically, the GST rate was 18%. Okay, let's say hypothetically, the GST rate applicable is 18%. Now, after purchasing raw material, you will manufacture this particular pen, and you will sell it in the market, and the GST rate now applicable will be 12%. Is okay on the final product or on the goods that you're selling, the rate of GST applicable is 12%. So whenever a situation arises where the tax that you paid on your inputs is okay, the tax that you paid on your inputs is higher than the tax you collect on your output. I'll repeat the statement here. Whenever a situation arises wherein the tax that you paid, that is the GST that you paid on your input, is higher than the tax that you paid on your output, that particular situation is called as inverted duty structure. Okay, that is referred as inverted duty structure. Right. So can you give me an example here? In case of a food, in case of a textiles, there is a presence of inverted duty structure. Right? Even if you have not understood this, let me give you an example. Right? Much more simple. Imagine you're a manufacturer, you purchase raw material, you paid a GST of 20 rupees. Is okay, you paid a GST of 20 rupees. You will manufacture the product, sell it in the market, collect 15 rupee GST. Is okay, 15 rupee GST. And 20 rupees, suppose you get in the form of input tax credit, you will give the government 15 rupees. So government not only does have to pay 15 rupees to you back, plus it also has to pay 5 rupees. Is okay, the 15 rupees which are collected, you give to government has to give it back. And in addition to this, government also has to give you 5 rupees. That is the idea of input tax credit. Then this is called as inverted duty structure. Right? Now the problem with inverted duty structure is first one, because there are different rates of GST. Again, because there are different rates of GST, it may lead to a inverted duty structure like this. That's the first one. And second one, whenever you have an inverted duty structure like this, the problem with that is government will pay refunds to you. Government will pay money to you. That is whatever taxes you paid on your inputs has to be given back by the government. The refund that is given by the government is higher than the taxes that you actually collected and given to government when you sold the good in the market. So government tax revenues would be affected. That's the first one. Is okay, government tax revenues would be affected. Second one, whenever we're talking about inverted duty structure, it essentially means what? Some of the funds of these particular manufacturers are stuck up with the government. So government will give you this particular ITC, but it might take certain point of time or it might take certain days or months or weeks. But until then, this particular money which is supposed to be given back to the manufacturer is stuck with the government. So a particular company, let's say manufacturing unit, which is working on the scarcity of the working capital, is okay, the amount of capital that is there with the company or the unit is very, very low. And at this particular point of time, some of the funds of the company are getting stuck up with the government. I don't think that will create problems for the manufacturing unit. So there are a lot of issues with respect to administration of a tax structure where there are multiple tiers like this. Next up, it goes against the central theme of the GST. The central idea of the GST is what? One nation, one indirect tax. The name of the tax is same. It's okay. We have GST. That's it. For all the rates now, only one name we are using, GST rate. But in reality, the name is single. But under this particular rate or under this particular GST, we have multiple slabs of GST. Okay, it's going against the central theme of the GST. And it may also lead to inflation. Again, under the term, I'm saying that it may lead to inflation. Why? Imagine you're a manufacturer. Now, more raw materials that you purchase, more the receipts you have to collect, more goods you produce and sell in market. Again, more bills you have to generate. You'll have to basically submit all of these particular documents. If you're not having sufficient amount of knowledge as to what kind of a classification is used by the government, how to file these particular returns, then essentially you'll have to hire an expert, outsource it to a third party like this, who is going to charge a certain amount on you. All of these will basically lead to increased cost of operations. All of these are basically expected to lead to increased cost of operations. And when the cost of operations increase, that might lead to increased market prices, which might lead to inflation in the market. Again, there's no guarantee it might lead to inflation. In fact, many of the countries where GST was implemented, for the initial couple of years, there was inflation in the market. Right? So these are some of the reasons as to why we have gone for multiple tiers and the issues because we have chosen to go with multiple tiers. Having said so, what is the way forward? We are basically looking at critical evaluation. What is the way forward? The way forward is one recommendation has been provided by there is one institute by the name NIPFP, which is basically backed by the Ministry of Finance, National Institute for Public Finance and Policy, NIPFP. And this particular NIPFP has given a very good way forward or recommendation with respect to addressing the issue of multiple tiers in the GST structure. Generally, when you discuss the problem with respect to reducing the number of GST slabs is that how should we reduce this particular slab? What should we do so that we go for reduction in the number of slabs? And we basically move towards what's the best international practice? That is having one or two slabs or one or two rates under the GST. The concern is, let me give you a very simple example. Imagine there are two slabs, 12%, 18%. Now, imagine these particular two slabs are merged into one. That is 15%. Okay, I'll repeat again. There are two slabs of GST, 12%, 18%. We'll merge both of those particular slabs into 115%. Now, on paper, when you look at this, it looks a very good recommendation. We can implement it easily. Why? You will say that, sir, right, we are increasing the GST rate from 12 to 15%, so I'm going to earn certain extra amount of revenue there, and I'm going to reduce the GST rate On others from 18 to 15, I'm going to lose 3% revenue there. So I'm losing on one side, I'm earning 3% on the other side, right? So there will be no impact on the revenue. That is what you think. But in reality, it will be different. Why? It is not just changing the rate of GST that is going to determine how much revenue you're going to generate. In addition to GST rate, it is also important to note what is the value of goods and services on which you're going to impose this particular GST rate. Let me give a very simple example. What if I say that there are 100 crore worth of goods and services on which you're imposing 12% GST and 500 crore goods and services worth of which on which you're basically imposing 18% GST. So I will look at this total value of goods and services will be how much? 600 crores. Okay. Now, what if you increase that 12% to 15% and decrease 18% to 50%? You can simply bring all the 600 crore worth of goods and services, tax them at 80%. But there is a revenue implication. What is the revenue implication? When you impose 12% on 100 crore, you'll be earning 12 crore GST here. 18% on 500 crore, you're earning 90 crore GST here. So totally, the amount of GST revenue that will be collected when you have a different 12%, different 18% slab will be 102 crores. Now what you have done? You basically merged that 12 and 18% into one, that is 15%, and all this particular 100 plus 500 crore, that is totally 600 crore, will add to 15% GST now. So 15% of 600 crore will be how much? It will be 90 crore rupees. So earlier you used to collect the GST revenue 102. Now you'll end up collecting GST revenue only 90 crore. Right? So do you think your revenue collection would be affected? Definitely yes. And this is a much smaller number. I'm just saying very small numbers just so that you can understand what is the revenue implication. In reality, as per various estimates, if you merge both the 12 and 18%, have only one slab, then annually the government of India might end up losing a tax revenue, that is GST tax revenues, to the extent of over 1 lakh crore rupees. Is okay, I'll repeat it. If you merge both the 12 and 18%, have only one slab of 15%, then annually you might end up losing a total GST revenue of over 1 lakh crore rupees. And it's a very, very huge amount of GST revenues for the government. Now what should be done here? And that is where the recommendation of a National Institution of Public Finance and Policy comes into play. What this particular institution recommends is, right now we have 12% and 18%. Okay, we have 12 and 18% two slabs. We will merge both the 12 and 18. We will have a slab of 15%. Okay, we will have a slab of 15%. Now some of you might be thinking, sir, just now you told us there is a problem with respect to merging 12 and 18. Now you're recommending the same thing. Just give me a second. So you will merge both 12 and 18 and you have 15% slab. And when you have 15% slab, there's a concern that you might end up losing tax revenues. Yes, for this only, this paper or this particular institution recommends that the slab rate of 5%. We have a slab rate of 5%. You will have to increase this to 8%. We have a slab of 5%. Increase it to 8%. You will generate additional revenue here. You have a slab of 28%. Increase it to 30%. Whatever revenue you're using by merging both 12 and 18%, that revenue will be collected by increasing the 5% to 8% and 28% to 30%. This is what has been recommended by NIPFP. Done.
Now let's have a look at certain important concepts which can be asked in the UPSC prelims. Generally, these particular terminologies are mentioned in the UPSC prelims and they'll ask you a statement related to these particular the terms as such. Let's start. One is the tax buoyancy. Second one is the expenditure, tax expenditure, tax to GDP ratio, and tax elasticity. Let's start with the first one, tax buoyancy. Tax buoyancy basically measures the growth rate in tax revenues compared to the growth rate in the economy. That is, if I simply say that tax buoyancy is 1.2 times, what does it essentially means?
compared to the growth rate in the economy. That is, if I simply say that tax buoyancy is 1.2 times, what does it essentially means? The tax buoyancy essentially refers to the ratio of growth in the tax revenue collection divided by growth rate in the GDP. And always remember this, there is a close relationship between the taxes as well as the growth rate. Why? Whenever from one year to next year you achieve a certain rate of growth in the economy, it essentially means the GDP has increased, and when GDP increases, economic activity has increased, and when economic activity increases, the amount of taxes which are collected by the government should also increase. So there is a very close linkage between the tax as well as the GDP. And when you measure the growth rate in the tax collection to the growth rate in a particular economy, and that is referred as a tax buoyancy. Okay, higher the tax buoyancy, always is preferred. Tax expenditure, it is the tax revenue which is formed by the government as a result of exemption, rebate, etc., which are provided by the government. Meaning what? Imagine here's the government. Right? You are supposed to pay certain income tax to government, and government simply says, out of this particular income tax that you're paying, some of it will be rebated back, some of it will be paid back to you. So imagine you're supposed to pay 100 rupee income tax to the government, but government simply says, out of this 10 rupee I will give it back. So government effectively collects how much? 90 rupee taxes. So the idea of a tax expenditure is the amount of a tax revenue which should have been collected by the government, but government will give it back either in the form of exemption, rebate, etc. So essentially in this example, government should have collected 100, but because it is a rebated back, it has given back a tax of 10 rupee, government has ended up collecting only 90 rupees. This 10 rupees is nothing but tax expenditure. Is okay? Tax expenditure. It refers to the tax revenue which is foregone. Foregone essentially means not collected by the government in the form of rebates, in the form of exemption, etc. Next one is the tax to GDP ratio. Tax to GDP ratio essentially is the total amount of a tax collected divided by GDP. Is okay? Understand this? Don't say that the first one and the third one both are looking the same. No. In case of the first one, I'm comparing the growth rate in the taxes to growth rate in the GDP. Whereas in case of the third one, I'm comparing what is the value of a tax revenue divided by value of a GDP. For example, imagine a particular country has a GDP of 100 rupee and the amount of a tax collected is 20 rupee. So essentially tax to GDP ratio will be 20 divided by 100, that is 20%. Is okay? So tax to GDP ratio is this. And is it okay if I say that the higher the tax to GDP ratio, the better it is for the government? For example, in the context of India, can I always say that the tax to GDP ratio should be higher, right? But what is the situation in case of India? The tax to GDP ratio somewhere comes at around 17 to 18%, whereas in case of OECD economies it is somewhere around 35%. So you need to increase the amount of a tax revenue collection. Tax elasticity, right? It basically measures the proportionate change in the tax revenue as a responsible to the change in the tax rate. And that is essentially, if I increase the tax rate, let's say by 5%, as a result of this, how much will be the growth rate or the change in the tax revenue collection? Is okay? How much is the change in the tax revenue collection as a result of increase or decrease in the tax rates imposed by the government? That relationship is called as a tax elasticity. Right? So these are some of the terminologies which I use here and there. Please go through them. Next, let's have a discussion related to the problems which are related to Indian taxation system. Let's start here. One, India undertaxes as well as underspends compared to developed countries. What do you mean by this? The amount of taxes which are supposed to be collected by the government is much higher, but the collection is much lower. And the reason for this is very simple. Have a look at this. I've given you the fourth point as well as the fifth point. That is, most of the economy is not covered under taxation. For example, there is a concept called as informal units. Is okay? Informal units. Formal and informal. What's the basic difference? Whenever a particular company has to be set up, or let's say a manufacturing unit or a service sector unit has to be set up, you're supposed to be registered under one of the laws. For example, you want to set up a manufacturing unit, then government of India simply says you're supposed to be registered under Factories Act. Now, if you do not go right or undergo this particular process of registration, then government doesn't have the information related to you. Government doesn't know that you're actually existing as a manufacturing unit in the economy. So there is a huge amount of economy in case of India which is informal in nature. And when you have informal economy presence like this, it becomes very difficult for the government to collect these particular taxes. That's the first one. Second one, in the context of India, there are a large number of the voters who are earning income, but the amount of taxes that they're paying is very, very less. Right? Some of them are evading taxes, some of them are avoiding the taxes. Is okay? Some of them are evading and some of them are avoiding. Evading essentially means to illegal means you're not paying or paying lesser amount of taxes. Avoiding essentially means you're using certain tools, right, which are essentially leading to lower amount of tax revenue collected by the government. For example, if you are underreporting your income, is okay? If you're underreporting your income, essentially it is a tax evasion. Right? So people, taxpayers, are either evading taxes, avoiding taxes. Companies, multinational enterprises are evading taxes, avoiding taxes. As a result of this, a large amount of tax revenue which should have been collected by the government. I understand this. Government should have collected a lot of these particular revenues, tax revenues, but because of all of these particular reasons, it is able to collect. And the problem here is when your tax revenue collection is affected, obviously your expenditure patterns will also be affected. Okay, so India undertaxes as well as underspends. The ratio of taxpayers to voters is very, very low. The exemption limits have been increased from time to time, as a result of which your tax expenditure also has increased. Meaning what? Imagine here's a person who is earning income of 5 lakh. Government will basically say first 2.5 lakh rupees is exempted. That is out of 5 lakh. On 2.5 lakh you don't have to pay any tax. Remaining 2.5 lakh you have to pay income taxes. But earlier this exemption limit was actually 1.5 lakh. So essentially when the limit was 1.5, the taxpayer would end up paying income taxes on 3.5 lakh. Now this has been increased from 1.5 to 2.5 lakh. So which means that the amount of taxes which should have been collected by the government will become lower because of a rise or increase in the exemption level. That so government also has increased the exemption level, which has led to a huge amount of tax under recoveries or tax collections have come down for the government. Right? And government also provides huge amount of exemption to corporates, etc. For example, under the Startup India SEC policy, government of India provides a tax exemption to the companies as such. So these are some of the problems related to Indian taxation system. Okay, so we've discussed all the issues. Now, what steps should be taken by the government to address some of these issues? One, refrain from raising the exemption thresholds that will essentially protect the tax revenues of the government. Reduce corruption in the system. Right? There are a lot of times when some of the tax officials are hand in glove with some of the companies, right? There's a tax evasion, but the officials don't report it as a result of which the tax evasion is a very rampant. Revenue collection also is affected. Reduce corruption in the system. Increase the tax base, expand the tax base. Now, what do you mean by the term tax base here? The tax base essentially refers to the assets, incomes, taxpayers, etc., from whom the government will collect the taxes. So, expanding the tax base essentially means more and more people should be covered under the taxation system. More companies should be covered under the taxation system. More assets should be covered under the taxation system. As a result of which, the amount of taxes collected by the government will automatically increase. Property tax must be developed. That is basically understand this. A lot of corruption happens in case of the property taxes. When I say corruption, there is always an issue with respect to undervaluation of the property in case of India. And when the property is undervalued, based on the value itself, you pay taxes to government. So when there is undervaluation, the amount of taxes collected by the government will also be affected. And you have to go for rationalization of GST, which government of India is actually trying to do. Next up, let's have a look at some of the reforms as well as the committee recommendations. The first one, RD is for committee. First and foremost, understand the context here. RD here, the UK government, they proposed changes to be done in case of direct taxes as well as indirect taxes. Is okay? They basically proposed the concept of goods and services tax to restructure indirect taxes in India. And they recommended, UK government basically brought in the concept of direct taxes code (DTC), which was basically related to direct taxes. Okay, one was indirect taxes, second one is direct taxes. The later government has basically implemented GST. They have done away. They basically withdrawn the proposal of a direct taxes code. But other than that, they have set up a committee, RVSO committee, to give certain recommendations with respect to direct taxation structure in India. So what are the recommendations? One, go for computerization of IT department. That is one recommendation. Second one, tax refunds must be provided faster, and in case of delays, the beneficiary has to be incentivized. Meaning what? Imagine I paid certain taxes to government. I filed the income tax returns. Some of the refunds out of these income taxes has to be given back to me by the government. If there is a delay, then this committee recommends that the person or the official who is responsible for the delay must be held accountable. He must be penalized. And because there is a delay in providing the tax refunds to the beneficiary, that is the taxpayer, he must be incentivized. So the interest must be paid for the delay in providing the refunds. Treat stock trading returns up to 5 lakh as capital gains and not as a business income. The argument is very simple here. We want to attract a lot of investors to participate and invest in the market. And when they invest in the market, let's say investors, and if they are earning stock trading returns up to 5 lakh rupees, the government would simply treat this as a business income, impose a higher income tax rate on this. Rather than this, recommendation is it should be treated as a part of the capital gains, and the rate which is applicable on capital gains should be applicable here. In essence, if this is done, the taxes that are paid by the investors on the returns that they won from stock trading will be coming down. This will attract more and more participation of investors in the market. TDS rates for individuals must be reduced from 10% to 5%. TDS basically stands for tax reduction at source. For example, effective for deposits in the banking sector, on the interest, right, whenever the interest on these particular deposits will cross a certain threshold level, the bank will deduct the tax and give it to government. That is what is TDS. Okay, the TDS rate must be reduced from 10% to 5%. Adjustment of tax refunds against outstanding demands should be avoided. That is, let's say a very simple example here. Imagine on one side, the tax official or tax department is supposed to give me a refund of 10,000 rupees. Okay, this is the refund value. And on the other hand, regarding certain year, I'm supposed to pay an additional tax. There is a demand for additional tax of, let's say, 20,000. So I will get this on one side. The tax department is expecting 20,000 additional tax to be paid by me to them. And on the other hand, they are supposed to give me a refund of 10,000. Generally, what tax department does is they will try to adjust this with this particular number. That is, they are supposed to pay 10,000 and I'm supposed to pay them 20,000. So they will not give this. Rather, they will simply say, okay, give me only 10,000 rupees. This is basically adjustment. This company says that don't go for this particular adjustment. Why? This refund that you're supposed to provide is guaranteed. But this particular tax demand that you have generated can be contested. The taxpayer might contest this and simply say, no, I don't have to pay this amount to you. Can be contested. So do not go for adjustment. Treat both of them separately. Then dividend income should be treated as a part of total income. Right? What is the dividend? Imagine here's a company. I've purchased certain shares of the company. Is okay? Certain shares of the company. Now, when the company earns a profit, part of the profit is given to me, and that is called as a dividend. Okay, that is referred as dividend. So dividend is a part of the profit that is earned by the company, which is given to the shareholders. So on this particular dividend, government imposes a tax called as a dividend distribution tax. This government says that do not impose it. Rather, allow the company to pay full dividend to the shareholders, and whatever dividend earned, let it be counted as a part of the total income. Whatever is the tax applicable on the income of this particular taxpayer, let's apply that. Okay, that is the recommendation here. So these are some of the recommendations of RVSO committee. Next, the government in 2020 launched another very important reform by the name of transparent taxation, honoring the honest. Okay, transparent taxation, honoring the honest. Now, under this particular concept, the objective was to basically promote efficiency, transparency, and accountability in the system. Okay, the key features of this particular platform are that we are going to use technology, artificial intelligence, recognizing the taxpayers, right, a role as a nation builders in the economy. So these are some of the key features of the taxation reform. That is the transparent taxation, honoring the honest. Now, under this, there are three pillars. One, a faceless assessment, a faceless appeal, and a taxpayer charter. Let's understand them right one by one. First one is a faceless assessment. What is a faceless assessment? Imagine here is a taxpayer. Okay, this particular taxpayer will submit the income tax returns (ITR), submit the documents, and file the income taxes. Now, the tax official is supposed to go through all of these particular documents and evaluate whether the taxes paid by the taxpayer is correct or not. So, when a system is set up, where the taxpayer knows who is the tax official who is looking into my documents, and the tax official knows who is the taxpayer, there could be corruption in the system. So now government simply says we will not simply give it to any tax official. We'll set up a centralized system. That is how we get this, right? They have set up a national faceless assessment center (NFAC). Once you file these particular income tax returns, these ITR returns will go to NFAC, and from NFAC, the identity of the taxpayer will be masked, and these documents will be sent to any tax official. So now the tax official doesn't know whose the tax documents or IT returns are these, and the taxpayer doesn't know to whom these tax documents are actually reached. So this will basically promote honesty in the system, transparency, efficiency in the system. That is a faceless assessment. Done. Next one is the faceless appeal. Let's continue the same process here. You have submitted your documents. It has been sent to a tax official. Now the tax official looks at your returns, that is the documents, and raises a demand. Okay, he looks at the documents and says you have paid 1 lakh rupees income tax, but no, you are supposed to pay 1.2 lakh rupee income tax. He will raise a demand. This is called as a tax demand. Earlier, whenever such tax demands were raised, physically the letters or the documents were sent to the taxpayers. Now government says no, we will not follow this. They have set up another centralized system, National Faceless Appeal Center. That is basically from this particular assessment center, the tax notice will be sent to all the taxpayers. Is okay. What is the taxpayer where the official has raised an additional tax demand? A notice will be sent, and this particular notice will be sent to the mobile number, email ID, the registered email ID, registered mobile number. Rather than physically sending the documents now, it will be sent through digital means. First point. Second point, once I've received a tax demand, is okay. Once I've received this particular tax notice, I will appeal against this, right, through Faceless Appeal Center. That is, I don't have to physically go to the income tax office now. Everything can be done using this particular online platform itself. Okay, this is called as Faceless Appeal. Now there's a third one. That is basically a taxpayer charter. Taxpayer charter is nothing but it's a document. Is okay. It's just a document which has been published by the government, wherein the government says that the taxpayer will have to abide by certain duties. There are certain obligations that the taxpayer will have to follow, and the tax department will also have to provide certain commitments. Will have to abide by certain commitments. That is in the context of the tax department. They will have to abide by the commitments such as they will have to treat every taxpayer as an honest taxpayer. They will have to be fair, courteous, and will have to provide a reasonable treatment to the taxpayer. Will provide a mechanism for appeal, and just now we discussed this. Will provide complete and accurate information to the taxpayers. Will also provide timely decisions and respect the privacy of the taxpayer. And in the context of the taxpayer, the obligations under the taxpayer charter are the taxpayer has to be honest and compliant. He has to disclose the complete information to the tax department. He has to be informed about the tax rules as well as what rules or the compliance he has to satisfy. He has to keep and maintain and provide all the accurate information to the department. So these are the obligations for the taxpayer, and these are the part of taxpayer charter. In addition to these reforms, government also has implemented one more type of assessor, agriculture infrastructure development assess, AIDC, very recently. Now what is AIDC? Government has identified 25 products which are being imported into India, and in addition to customs duty, now government will impose assess. Is it okay? Let me give a simple example. Imagine a particular product is imported into India, and let's say the government is
is imposing 20 rupees customs duty on this. So now government simply says, imagine the cost is 100, 20 rupees was the customs duty. Actual import cost would be how much? 120. The government says import price remains same, customs duty I will reduce it to 50, and I will impose cess and collect this. Is okay. And this particular cess which has been imposed in addition to the customs duty. Is okay. Now you'll ask me, sir, why the customs duty has been reduced? Very simple. If the customs duty is kept at 20 and government imposes an additional cess of 5, then the price of import will increase to 125. Imports will become costlier. So government says, I will import it, but I will not impose additional tariffs on this. Whatever customs duty is there, I will reduce it, and I will introduce a new type of cess which I will collect and ensure that the import prices will not increase because of this particular cess. Is okay? Right? So on 25 imports, we have identified them and we have reduced the customs duty and imposed a cess on it. And this cess is called as agriculture infrastructure development cess. And what's the objective here? Government simply says the revenue that has been collected by imposing the cess will be used for development of agriculture infrastructure. Is okay? The cess which we are collecting here will be used only for the purposes of agriculture infrastructure. Some of you might be thinking, sir, government would have done it earlier also when they were collecting 20 rupees. That is the basic customs duty. They were collecting 20. They were simply given 5 rupees for development of agriculture. What difference does it make? A lot of difference it will be making. Follow this very carefully. Imagine the government collects a basic customs duty of 20. This 20 rupees will go to the divisible pool. Is okay? I will discuss more about the concept of divisible pool under the ambit of a fiscal policy. That is a budgeting and finance function. So I will look at this. This 20 rupees the government collects a basic goes into divisible pool, and the divisible pool is divided between the center as well as the states based on the recommendations of the finance function. But now what we are doing is we want to ensure that funds will be allocated only for the development of infrastructure in the agriculture sector. So what we do? We will set up a cess. Whatever money is collected by imposing will be deposited into this particular cess fund, and the funds will be used only for development of infrastructure. Right? So these particular funds will not become part of the divisible pool of taxes. And so this is the discussion related to AIDF. Now the concept of Laffer curve. Okay, idea of Laffer curve. Now the Laffer curve basically provides a relationship between the tax rate, is okay, the tax rate along the x-axis and the tax revenue along the y-axis. Okay, it basically gives you a relation between the tax rates imposed by the government and the revenue that is collected by the government. And the concept of Laffer curve was given by economist Arthur Laffer. As per this particular Laffer curve, it basically states that when the tax rates will increase, the amount of tax revenue will also increase. But beyond a certain rate, is okay, beyond a certain rate, if government further increases the taxes, then the tax revenue collected by the government will not increase, will decrease. I will repeat the statement here. Follow this. What does Arthur Laffer basically state here? When the tax rate is increased, the amount of tax revenue collected by the government will also increase. But after a certain tax rate, after crossing certain threshold level, that is the tax rate, the amount of tax revenue collected by the government will not increase, rather decrease. Right? Why does this happen? As per the Laffer curve, or as per the explanation given by the economist, follow this very carefully. When the tax rate will increase, let's say from 0% to 5%. Earlier, what was the tax rate? 0%. So when you have a tax rate of 0%, how much money in the form of taxes will be collected by the government? 0 rupees. But when it is increased to 5%, can I simply say government tax revenue will start increasing? First point. Let's say hypothetically, imagine this particular point is a 24%. Is okay? Imagine this particular point is 24%. So what this particular Laffer curve states is from 0% till 24%. If the government keeps raising the tax rate like this, the revenue that is collected by the government under taxation will increase. But when government crosses 24%, and imagine government increases the tax rate to 30%, the tax revenue will not increase, rather the tax revenue will start decreasing. Why? As per this particular theory, as the tax rates will cross a certain level, assumption here is how much? 24. I'm saying assumption, because in reality, under Laffer curve, no number is actually given. No number is actually given. So assume it is 24%. So government increases the tax rate beyond 24%. The theory basically says that people will start replacing work with leisure. Is okay? People will start replacing work with leisure. Meaning what? I as a worker, now I've concluded that no point in working 6 days or 7 days or 8 hours or 9 hours a day, because anyways I'm paying higher amount of taxes to government, rather than working let's say 7 days or 6 days a week, I will reduce it to 5 days. I will take off on 2 days. So I will start replacing work with leisure. So when I replace work with leisure, the production comes down, the revenue comes down, that is income earned by me comes down. When income comes down, can I simply say that the tax revenue of the government will come down? And when the tax rate is the highest, let's say 100%, means whatever I'm earning, I'm paying it to government. Will I even earn anything? If I'm earning 100 and I'm paying 100 rupees to the government in the form of a tax, what's the point of earning? I will not earn. And if I don't earn, how much will the revenue collected by the government? 0 rupees. This is what the Laffer curve actually provides. But please understand this. There are a lot of issues with the Laffer curve. Generally, the idea of Laffer curve is used when the governments want to reduce the tax rates. That is the argument here is when you reduce the tax rates like this. Imagine you're here. This is the amount of a tax revenue that you're collecting. If you reduce the tax rate from here till here, right? If you reduce the tax rate from this rate to this rate, the amount of revenue that you're collecting will increase. Generally, the idea of Laffer curve is used by the governments to reduce the tax rate. But there are issues. Right? There are various concerns which have been raised with respect to Laffer curve. One, it generally assumes that the tax revenue collection is only dependent on tax rates. Is okay? Very simple assumption. Tax rate, tax revenue. In reality, no. It's very, very complicated. Second one, Laffer curve doesn't give numbers along the x-axis. So what is this particular T star? It's like optimal tax rate. What is the T star? How do I arrive at this particular T star? No methodology. I understand. There's so many issues with respect to Laffer curve. Hence, right? Generally, this is discussed given in the books, right? But application part there are problems. So these are the various concepts related to taxation. Now let's have a look at certain questions. Which one of the following is not a feature of value-added tax? Which of the following is not a feature? Underline the term, not a feature of value-added tax. It is a multi-point destination-based system of taxation. True. That's a feature. It is a tax levied on the valuation at each stage of transaction in the production distribution chain. True. It is a tax on the final consumption of goods or services and must be ultimately borne by the consumer. True. It is basically a subject of the central government, and state governments are only a facilitator for its successful implementation. Exactly vice versa. It is a subject of the state government, and the central government is a facilitator. Option D is the right option. That is, it is not a feature of VAT. Next, the sales tax you pay by purchasing a toothpaste. Underline the term sales tax. Sales tax is associated with the state government. Okay. So tax imposed and collected by the state government is the right option. Option D. Next one. What is or are the most likely advantages of implementing GST, goods and services tax? It will replace multiple taxes collected by multiple authorities and will thus create a single market or a national market in India. True. It will drastically reduce the current account deficit of India and will enable to increase the foreign exchange reserves. Whenever we come across the term drastically, either increases or decreases, nothing drastically will happen in the economy just because a single reform is taken. But anyways, most of the times when they talk about sudden increase, sudden decrease, drastically happening, most of the times the statements are wrong. This statement is also wrong. Current account deficit, please do not worry. Statement is wrong. You will come across the term current account deficit when I discuss balance of payments. Let me not deviate and start discussing BOP now. We'll take it up later. It will enormously increase the growth and size of the economy of India and will enable it to overtake China in the near future. China's GDP value is $14 trillion. India's GDP value is around $3 trillion. Do you think just because of GST will overtake China? Absolutely no. C is also wrong. So right option here will be option right A, that is one only. Next, consider the following statements. Tax revenue as a percentage of GDP of India steadily increased in the last decade. Wrong. From where will we get this kind of information? Economic survey, budget documents. Fiscal deficit as a percentage of GDP of India has steadily increased in the last decade. Again, this is also wrong. Okay. Right option is option D, neither one nor two. GST has subsumed services tax. Yes. Excise. Yes. Entertainment. Yes. Right option will be option D, 1, 2, and 3. A higher tax revenue can be collected by imposing higher tax on commodities which have highly inelastic demand. Right? There are two terms here: highly elastic demand, highly inelastic demand. What do you mean by this? Elastic demand and inelastic demand essentially refer to the relationship between price and demand. Okay. If the price varies by a small margin, either increase or decrease. Okay, if the price changes by a small margin, demand changes by huge number. Right, this is called as elastic. Okay, this is called as elastic demand. And if the price changes by a huge margin and demand changes very small margin, okay, that is called as inelastic demand. Okay, elastic essentially means price changing by a small number, demand changing by a large number. Elastic. Inelastic, price changing by a large number, demand changing by very small number. Inelastic. So tax revenue can be collected by imposing higher tax on commodities which have highly inelastic demand. So when the prices will increase, what will happen to demand? Demand will not change by a large margin. Is okay. So prices are increasing because higher tax is imposed by the government. Demand doesn't change by a large margin. Don't you think that tax revenue will increase? Yes. Which have highly elastic demand. Price increases because the taxes imposed by the government has increased. Demand abruptly will fall down by a large margin. So will the tax revenue increase? No, tax revenue decrease. What would habit forming, such as cigarettes, alcohol, etc. Even the government imposes a higher taxes on them, market prices increase, people will continue to consume them. So government's tax revenue will increase. Third one is correct. So 1 and 3 are right. Right option is only 1 and 3. Consider the following statements about GST network. Goods and services tax network provides IT infrastructure and services to the central and state governments, taxpayers, and other stakeholders for the implementation of GST. Correct. Government of India holds a 51% stake in the GST network. Wrong. Okay, so first one is correct. Right option is option B, only 1 is true. Consider the following statements about the GST Council. You will have representation from all 29 states. There are no 29 states, there are 28 states now. Okay, first one is wrong. The voting rights has been distributed equally between central states. No, central will get 1/3 voting right. States will get 2/3 of the voting right. Second one is also wrong. Right option will be option A, both are false. Consider the following statements. Amongst the BRICS economies, India has the highest tax to GDP ratio. Statement is wrong. Okay. With implementation of GST, the number of indirect tax assessees, that is, number of payers, have increased. Statement is true. Again, right. So earlier question, this question is from where will I get the information? Economic survey. Okay. So second statement is true. Option B is the right one. Next one, government foregoes certain tax revenues by giving exemptions, refunds, etc. This is known as a tax expenditure. We have discussed this. Option 3 or option C is the right one. Consider the following statements about left factor. It tries to give an optimal tax rate beyond which the tax revenues will fall. Statement is true. It is an upright U curve. It is a downward U curve. Okay, it is a downward U curve, not an upright U curve. Second one is wrong. Right option is option A. Only one is true. Okay, so these are some of the descriptive questions. Please go through them. There is a separate video where we have discussed all of these descriptive questions in detail. So this is the detailed discussion with respect to the module of taxation. Thank you. States non-tax revenues. Now let me put forward a question to you. What if UPSC will ask you this kind of a descriptive question? UPSC says, in the current physical stress in the overall economy, it is very pertinent or it is very important for the states to improve their non-tax revenues or to improve the collection of their non-tax revenues. Right? Again, this kind of a question can be asked in UPSC? Definitely yes. Right? It is a kind of a question which generally UPSC reserves for means as such. Now what is the basic idea? Please understand this. Whenever I talk about the state government, because most of the times when we talk about the finances, focus is always on the central government or the union government. But in this case, I'm focused on the state government here. Have a look at this. When we talk about the state government, right, what are the different sources of revenues for the state government? Because obviously just like central government, state government also spends money. It also invests expenditure. It also provides social welfare schemes. So what are the different sources from which state government will get the money from? Right? One, we have transfers from the central government. Best example for this is finance commission. As for 15 finance commission, more than 50 lakh crore rupees, right? Because of the central reserve pool, because of various grants, state specific grants, more than 50 lakh crore rupees will be transferred between 21 to 26 to the states. But that is for a period of 5 years. Then, in addition to this, the states also get GST compensation. Okay? States also get GST compensation. States also implement certain other types of taxes, indirect taxes, and collect a certain amount of revenue. Best example, sales tax on petrol and diesel. And there are other non-tax revenues. Is okay. In addition to all of these, there are other non-tax revenues, and this article discusses this component of the revenues collected by the state government. Now, for the discussion very carefully here, in recent times, what has happened is the issue with respect to GST has started cropping up. Right? We have implemented GST for a longer duration now, but the compensation period under GST is going to be over in July 2022. And once the compensation period is over, definitely yes, states may not be able to get, assuming there is no extension of the compensation period, states may not be able to get any amount of GST compensation from the central government. Now, as such, because of the pandemic, the finances of the states are already under a lot of stress. Now, even if the compensation cess will not be given to the state government, further stress will be put on these particular finances of the state government. Now, in this particular context, what is the role of the non-tax revenues? The article says that when you take into consideration the overall revenues collected by the state government, the non-tax revenues account for 10% of the overall revenues. And within this particular 10% of these particular non-tax revenues, majority of it, that's around 80% of these particular non-tax revenues actually come from providing general services, social and fiscal services, and economic services. Right? There are various types of services which are provided by the state governments on which charges are imposed, levies are imposed, and the state government will collect the money from. Now, this particular article says that state government, in order to protect its finances, in order to promote its finances, has to focus on the non-tax revenues in the coming days. Now, one problem with respect to promotion of non-tax revenues is, please understand, just like we have a finance commission at the central government level, there should also be a finance commission at the state level. Is it okay? Understand this very carefully. Just like we have a finance commission at the central government level, there should also be a finance commission at the state government level. In case of a central government or the union government, which will set up the finance commission, the authority is given under Article 280. Although the union government, right, technically the president of India shall set up or shall constitute the finance commission at the central level. But at the state level, this particular power has been given to governor under Article 243. Under Article 243, the governor of a particular state shall constitute this particular finance commission. And what is the importance of the finance commission at the state level? It will basically tell the state governments where are the issues with respect to collection of revenues, distribution of taxes between the state government as well as the municipalities, and even the third tier of the government. Right? These are very important roles which are generally played by the finance commission at the state level. Now, the problem here is, although there is an article related to finance commission at the state level, states have not been setting up these particular finance commission. And this is important for a simple reason. When you look at terms of references of a central finance commission, I'm talking about central finance commission.
of Central Finance Commission, or let's say Simple Finance Commission, one of the TORs basically mandates that the Finance Commission should also give recommendations as to how we can increase the consolidated fund of the states. Is okay? Right? It has to give a recommendation how to increase the consolidated fund of the states, and these recommendations are basically provided looking into the recommendations which are provided by the state finance commissions. And the 15th Finance Commission says that since states have not been able to set up their own finance commission, I will not be able to give you these kinds of recommendations. Now, in addition to this, another important problem with respect to state finance commission is this. Have a look at this. These particular finance commissions are not permanent in nature. Okay, so whenever any state sets up a finance commission, the finance commission has to get space, the real estate space has to get the office equipment, has to get the manpower, has to get the reports from all the departments concerned, and this will take a lot of time as well as incur a lot of expenses. And that is the precise reason whenever you talk about the state finance commissions, the time period which is taken by them to give the report is also very, very lengthy. So these are some of the concerns which have been raised with respect to the state finance commissions, which may basically add or which may basically enhance the non-tax revenues which are collected by the state governments in the current situation of the financial stress. So these are some of the important points given in this particular article. Now, based on this, I've given a question here. Consider the following statements. Under Article 280, Finance Commission is constituted at central as well as the state level. Statement is wrong. 280 central, 243 state level. The Finance Commission at central and the state level are constituted by President of India. Even the statement is wrong. Central Finance Commission set up by or constituted by President of India, state by the governor. Okay. So based on this, right option is option D, neither one, not two. It is related to GST anti-profiting. In the last 1 year, there has been no discussion with respect to one authority which has been set up under GST to look into the profiteering activity. And the authority that I'm talking of is National Anti-Profiting Authority, NAA. Follow this very carefully. National Anti-Profiting Authority has been set up under Section 171 of CGST, Central GST Act. And the role of National Anti-Profiting Authority is to simply ensure that whenever there is a rate reduction, whenever there is a change in the rate, the benefits of this particular rate reduction will be transferred, will be provided to consumers. And earlier also we have discussed more on the concept of anti-profiting. So I'll directly link to what is given in the article. This particular authority, initially when it was set up as a stopgap arrangement, a temporary arrangement. And with respect to this particular authority, there was a sunset clause of 2 years. Is okay? There was a sunset clause of 2 years. And whenever we come across a sunset clause, what is the meaning of it? It basically means a particular provision is applicable for a specific time period. So it was set up in the year 2017. So 2 years essentially means this authority will be wound up, will be closed in 2019. Again in 2019, the GST Council decided to provide an extension to this particular authority by 2 more years. And looking at the evolution, basically you have to come to the conclusion that in 2021, that is in now by 2021, this should have been wound up. This should have been ended. Now very recently, this particular GST Council has met and it has basically decided to increase the tenure of National Anti-Profiting Authority by 1 more year. Is okay? It has decided that there are certain cases which are pending at National Anti-Profiting Authority, so it will increase the tenure of this particular NAA by 1 more year. And it has stated that after 1 year, that is basically end of November 2022, we will wind up this particular authority. Whatever cases are there, we will be looking at a mechanism where we want to transfer these pending cases to Competition Commission of India, CCI. Now, in addition to this, the discussion is not in the article, but in other articles there was one particular discussion. Follow this very carefully. This particular National Anti-Profiting Authority is headed by a chairman. Is okay? It is headed by a chairman. In addition to the chairman, there are 4 technical members within this particular NAA. And why this is important? The total composition is 1 plus 4. And for quorum, basically for the proceeding to start within this particular NAA, you need to have at least 4 members. That is 1 chairman plus 3 members. Is okay? So I'll repeat it. The composition of NAA was 1 plus 4, 1 chairman, 4 technical members, and the quorum requirement for NAA is 1 plus 3. That is the chairman should be present, and the 3 out of 4 technical members should be present. And recently what has happened? Chairman, there is no chairman for National Anti-Profiting Authority now. There is 1 member who is also acting as a chairman of this particular authority. And there is also vacancy out of these particular 4 members. As a result of this, the National Anti-Profiting Authority is unable to attain the quorum. And because there is no quorum, the activities or the functions of this particular authority have been affected. And that is one of the reasons why there is a delay in clearing these particular cases within National Anti-Profiting Authority. But the 45th GST Council meeting. One of the important points that you need to understand from this outcome of this meeting is, one, you need to understand the idea of compensation cess, which has been discussed in these articles. First and foremost, earlier the idea of compensation cess was implemented in order to provide for revenue shortfall that would be incurred by the state governments. The state governments, when they would come under the concept of GST, that is give away the indirect taxation powers, they feared that there would be certain revenue shortfall, there would be certain revenue losses for these particular state governments. To pacify, to provide certain relief to the state governments, Government of India introduced the concept of GST compensation cess, which was provided for a duration of 5 years, under which the 100% of revenue shortfall for the states will be provided in the form of a compensation by the central government. And for this particular reason itself, there was the idea of a GST cess, which was implemented on some of the commodities under the slab of 28%. This is the basic background. Now, why this is being discussed? Earlier, there were 2 very important points. One, there was a discussion whether the central government will continue to provide the compensation cess even after the duration of 5 years. That is, the 5-year duration will end in June 2022. That is, from 2017 we started the implementation of GST. So June 22, the 5-year duration will be ending, which essentially means that the state governments, if there is no extension of this, will not be getting any type of a compensation under the concept of GST. So whether the central government or during the GST Council meeting, whether this will be extended or not, that was one point of a discussion. As of now, there is no decision with respect to this. Central government or the GST Council has categorically stated that there will be no extension as of now. But we'll have to wait and see what is the negotiation which is going to happen in the coming days. Because as it is very clear, the state governments have specified, many state governments such as Kerala have basically stated that this is not the end of the discussion with respect to GST compensation from central to states. So even in the coming days, you will come across this. Second very important point you need to understand is, despite central government not giving any clarification or not guaranteeing that there will be extension of the GST compensation provided to the states, has continued the implementation of compensation cess. Although using the term central government, please understand the decision was taken in the GST Council. It was decided that this particular GST compensation cess which is being implemented is going to be continued till the March of 2026, till the end of March 2026. Now some of you basically say, sir, earlier you stated that compensation is not going to be extended as of now. But on the other hand, you're saying that the compensation cess implementation is going to continue. It doesn't make any sense. You are right, but not completely. You are right in saying that it doesn't make any sense. But wait until you understand the story here. What is the story? Last 1.5 years, there is a lot of friction between the central government as well as the states. The friction arose for a simple reason. Because of the pandemic, the revenue shortfall within the GST expanded. Is it okay? The revenue shortfall within the GST increased because of pandemic. As a result of this, central government basically introduced the concept of act of God, trying to distance itself from paying a huge amount of compensation to the state governments. During this particular discussion, 2 options were provided by the central government to the states, and most of the states, as of now, might have agreed to one of those options wherein the shortfall of this particular GST amount will be borrowed from the market. Is it okay? The government will be borrowing from the market to provide GST compensation to the states. Now, when the government borrows from the market, obviously borrowing means what? In the future, there has to be a repayment. Now, who is going to repay this particular amount? That is where the idea of a GST compensation cess will continue. Central government or GST Council has stated that the implementation of compensation cess will continue. We are going to collect it, use this particular funds to repay the borrowing that has been done by the government to bridge the deficit, to bridge the gap, and pay money for these particular state governments under the ambit of GST. For the financial year 21, Government of India said to have borrowed around 1.1 lakh crore rupees to provide compensation to the state governments. And in the current financial year, so far the government is said to have borrowed around 75,000 crore rupees. So the borrowing has been done. Somebody has to repay it. So the compensation cess implementation will continue. Amount will be collected and used to repay this particular borrowing. That is the reason the compensation cess implementation has been continued till March 2026 or end of March 2026. That's the first very important point you need to understand here. Second very important point, which created a lot of discussion, is the concept of GST on food delivery. Please be very, very careful here. First and very important point, this is not a new type of a tax. Even Government of India has again and again repeatedly clarified that this is not a new type of a tax. Earlier or even today, because this is going to come from a future date or it is going to be implemented prospectively. Even today, what happens is, if you order, let's say, food from an app such as Zomato or Swiggy, the delivery, right, is provided by Zomato or let's say Swiggy,
but the hotel that will supply the food is going to add certain GST. And in case of GST currently on food delivery, it is 5%. The hotels or restaurants charge 5%. Now please understand the logic here. Earlier the rate was different, but in 2017, the restaurants or the hotels basically told government of India it is very difficult for them to provide the receipts, that is basically the bills, so as to claim the input tax credit, as they are purchasing most of their raw materials from informal sector. And when you purchase raw materials from informal sector, very difficult to get receipts, and much more difficult in maintaining and filing them and getting input tax credit. That is the precise reason what government of India basically did was, rather than charging a different rate of GST, they reduced the GST rate to 5% here, but with one condition. What is the condition here? On this particular GST, the hotels or restaurants will not be provided any kind of input tax credit. Remember this. The government maintained a flat rate of GST of 5%. Whenever you, let's say, dine in a restaurant or take away from a restaurant, the restaurant will charge you 5% GST. So restaurant is supposed to collect it, transfer it to government. And this particular 5% of GST, that is the rate that is collected by the hotel, which is paid to the government. On this, no input tax credit will be provided by the government to restaurant. You have to remember this. Now what happens? If you order for Swiggy, the restaurant will deliver, basically hand over the food to delivery guy, and the delivery person will come to your home and deliver this particular food to you. And there is GST applied at two places. One, the restaurant will apply 5% GST on which there is no input tax rate, and the delivery person or delivery company, food delivery company, upon over the charges which is charged by the restaurant, any service provided by them, they will also add the GST on this. And all of this GST is basically transferred to whom? Consumer. That is me and you, because the feature of indirect tax is what? The burden of it will fall on the consumers ultimately. Now this was the idea. What government of India found out during pandemic was, a lot of these particular restaurants are collecting GST, but they are not paying this particular GST to the government. There is a tax evasion that is happening. Now, as per the latest announcement of the GST Council, this particular GST will not be collected by restaurant, rather it will be collected by the food delivery company. Is okay? It will be collected by the food delivery company and it has to transfer it to government. That is the announcement which has been done. And this is not just applicable to food delivery companies, even those particular companies which are going to provide the services of transportation, right, such as the cab aggregators, Ola and Uber, also have been covered under this. And government of India clarified this, that these particular food delivery companies already are registered as the tax collectors at source. I repeat, these food delivery apps are already registered as the tax collectors at source, and now they are supposed to collect the tax at source and transfer it to the government. And against this particular policy, there are certain concerns which have already been raised by various stakeholders. For example, these particular food delivery companies are saying that, what about the input tax credit? Earlier, there was no ITC on restaurants, that is the GST collected by the restaurants, transferred to government, no ITC. Will you provide the ITC to me or not? Because you are asking me to collect and transfer the GST to you, will you be providing ITC or not? Right? There is no clarity with respect to this so far. And various stakeholders, such as these food delivery companies, are saying that if there is no ITC or there is no clarity with respect to this may actually lead to cascading effect or double taxation on these particular food delivered by the companies. So there is some clarity that is supposed to be given by the government with respect to this announcement also. Third very important announcement is with respect to inverted duty structure. In case of textiles, in case of footwear, there is a presence of inverted duty structure. A simple idea of inverted duty structure is, on the output you have a lower tax rate compared to the tax rate on an input. For a simple example, let's take a simple example here. Imagine this particular pen. You require plastic to manufacture this particular pen. Imagine government imposes 18% GST on the plastic that you will purchase, manufacture the pen, sell the pen in the market, and government imposes a GST rate of 5% on the pen. This is the example that I provided just now is a classic example of an inverted duty structure. In case of footwear, presently there is an inverted duty structure. For example, for a footwear which is priced below 1,000 rupees, the GST rate applicable is 5%. But if you purchase a sole, that is the manufacturer purchases a sole, right, or some of the raw materials to manufacture this particular the footwear as such, GST rate applicable is 18%. So there is an inverted duty structure that is present in the economy because of these kinds of difference in the tariff. Now some of you may think, what is the problem? Let it be there. What is the problem if there is an inverted duty structure? The problem with respect to inverted duty structure is, one, whenever there is an inverted duty structure, the capital of the manufacturer, the money of the manufacturer, gets stuck up in the form of inverted duty. Second, whenever there is inverted duty structure, let's say in the first case there is a taxation of 15 rupees. I'm just doing an arbitrary number here. In the first case, government has collected GST of 15 rupees. In the second case, the amount of GST collected is, let's say, 5 rupees. In essence, the inputs has attracted higher tax compared to output. In such cases, government will not only have to pay back the 5 rupees that is input tax, will also have to give credit of extra 10 rupees. Because the complete amount has to be given to the manufacturer. Otherwise, what will happen? He will simply transfer it to the consumer in the market. That is again cascading effect. So inverted duty structure will also affect the tax revenues of the government. So from 1st January next year, government of India stated that they are going to address the inverted duty structure that is present in textiles as well as in footwear. Another very important discussion that was happening before the GST Council, but no outcome has happened, is related to inclusion of petrol as well as diesel under GST. As per the GST Act, the GST Council shall decide when to notify the GST rates on petrol as well as diesel. It was expected that there would be certain communication provided by the GST Council with respect to this, but the Council has stated that currently it is not the right time to basically notify or bring them under the ambit of GST. So no discussion or no outcome has happened with respect to petrol as well as diesel here. So these are some of the very important points with respect to GST Council or the 45th GST Council, which happened very, very recently. GST on textiles. In the last 1 week, every day in the newspaper there has been one or the other article related to the idea of GST on textiles. Now for the UPC exam, should you read what is the GST rate applicable on textiles? Not required. Okay, not required. Because for a simple reason, within textiles there are so many fragments or there are so many divisions, different types are there, and different rates of GST are applicable. But why this article became relevant for UPSC? There is a concept called as inverted duty structure. Okay, inverted duty structure. Now what do you mean by inverted duty structure? Let's try and understand that. Then we'll connect it to the idea of textiles as well as footwear and GST. Imagine you're a manufacturer. Okay, you're the manufacturer here. You'll purchase a raw material, and when you purchase a raw material, you'll pay GST of, let's say, 15 rupees. Is okay, you pay GST of 15 rupees. And now you'll manufacture a particular good, sell it in the market, and again collect GST on it. And let's imagine the GST that you're going to collect will be 10 rupees. Now just understand this more than sufficient. What is the inference? The GST that you've paid on the inputs is okay. The GST that you paid on the inputs is higher than the GST that you've collected on the output. That is basically what you have sold either to the supplier or let's say to the manufacturer, consumers, etc. And you collected GST. That particular GST is smaller compared to the GST that you actually paid when you purchased the raw material or an intermediate good in the market. Now this particular structure wherein the GST on inputs is higher compared to GST on outputs is called as inverted duty structure. Is okay. This situation wherein the duty that you're paying is higher on the inputs compared to the duty that you're collecting when you sell the output, that is called as inverted duty structure. And the problem with respect to inverted duty structure is the government of India will have to provide higher refunds to this particular manufacturer. Why? If you're the manufacturer, you've paid an input tax of 15 rupees on the inputs, you would always want to get all the 15 rupees back from the government. So the government has to pay higher amount of refunds whenever there is an inverted duty structure. That's the first one. Second one, until unless the government will give you this particular 15 rupee back, imagine you're a micro enterprise or a small enterprise which is actually working on the shortage of the funds. Some of your working capital gets stuck up in the form of the input taxes. And because there is no or there is a delayed refunds or credits which are given to you, and there is a shortage of funds for you, this becomes a problem for the micro, small and medium enterprises. So these are some of the issues related to idea of inverted duty structure. Now some of you might be thinking, sir, why are we discussing all of this in the context of textiles? Very simple. The government earlier when they implemented GST, they found that this instance of inverted duty structure is happening in various sectors, and over a period of time, the rates have been adjusted to address the issue of inverted duty structure. But even today, in the context of footwear,
as well as the textile sector, there is inverted duty structure. And when I say footwear, please understand, from the 1st of January 2022, new rates are applicable, so they've already addressed, right, the issue of inverted duty structure in case of footwear. In case of textiles, there is a segment called as MMF, man-made fibers. It's okay, MMF, which attracts a GST of around 18%. So there is an inverted duty structure present in this particular component within the textile sector. So over a period of time, various the stakeholders or companies or manufacturers have approached government of India, have started addressing this particular issue of inverted duty structure. And last year, well, basically in the last quarter, right, last 3 months, government through the concept of GST Council announced that in case of footwear, the rate of GST applicable will be 12%. In case of textiles, any kind of textiles, the whole textile sector now will come under the GST rate of 12%. And there was a huge opposition of various state governments regarding this particular decision that was taken in the GST Council. And that is what is important for UPC now, right? One, the idea of inverted duty structure addressed. Why there was opposition by the state GST Council. And that is what is important for UPC now, right? One, the idea of inverted duty structure addressed. Why there was opposition by the state governments. For a simple reason, textiles, right? Whenever the clothing is sold and the price of it is up to 1,000 rupees, the GST rate applicable is 5%. Now government simply says we want to address the issue of inverted duty structure, so we'll simply increase this uniformly to the whole textile sector at 12%. So the argument here was, if your clothes that you're going to purchase, if the piece of clothing that you're going to purchase in the market, irrespective of whether it is below 1,000 rupees or above 1,000 rupees, doesn't matter. Now you'll have to pay GST of 12%, which essentially means market price of this particular product will increase. That's the first one. Second, when the market prices will increase, what do you think will happen to demand? Don't you think to a certain extent demand would be affected? Third, we had this particular differentiated GST structure or GST rate for a very simple reason, right? The clothing or the piece of clothing up to 1,000 rupees generally are preferred by middle class households or lower income households. Now, don't you think we are going to, right, increase the price of this particular clothing when they're going to be purchased irrespective of any income households in the market? And that might basically lead to lower demand in the market, increase the market prices, some of the demand lowering, having an impact on the production done by smaller, that is micro, small, and medium enterprises, and this might simply force some of these enterprises to be shut down. In addition to this, there's always a concern that in the last 1.5 years, the cost of production, because the cost of raw material has increased, cost of production has already increased in the textile sector. And if government further increases the GST rate, makes it uniformly 12%, then it could basically spell doom for these smaller enterprises. And that is the precise reason various experts and even representatives of the state government, they were throwing certain numbers like millions of jobs will be lost, right, so many units will be shut down, etc., etc., etc. Now these are certain important points related to this particular article. Now, update for this particular article is that Government of India, the GST Council, has met very recently, has announced that they have withdrawn this particular rate hike in the GST on textiles. The GST rate hike on textile sector has been withdrawn, right? So that is the updated information here. ATF under GST. ATF essentially stands for Aviation Turbine Fuel. Now, first and foremost, what are the important points here? Although the article is very short with respect to FM announcing that the issue of covering ATF under GST will be taken up in the next GST Council. That is what has been provided in the article. But let's go beyond what is given in the article. Let's try to understand what are the important aspects related to the UPSC from this particular issue. First and foremost, remember this: the fuel products. Is okay, the fuel products right now are not covered with the GST rate. That is, there is no GST rate applicable on the fuel products. For example, petrol, diesel, aviation turbine fuel. When the GST as a concept was introduced under 101 or 101 Constitutional Amendment, essentially the GST is defined as a tax on goods as well as services. A tax on goods as well as services. But it excluded, I repeat, it basically excluded the alcohol that is used for human consumption. Okay, alcohol that is used for human consumption. But in addition to this, the GST Council basically decided that let's not announce the GST rate on these particular fuel products. In the future, we will decide when we will basically bring it under the GST and have GST rate on these particular fuel products. That is the first very important point. Second, in that case, how the fuels are taxed currently. How is the fuel taxation applicable in India? For example, in the context of aviation turbine fuel, ATF attracts the central excise as well as the state VAT. The ATF basically is attracting 11% tax from the central government, that is the central excise, and the VAT from one state to another state, it will vary, you don't have to remember. But what is the problem here? The problem is that when the airlines or the service providers pay so much of tax on the ATF, it forms around 60% of the cost of a ticket itself. Is it okay? It forms around 60% of cost of ticket, that is overall ATF charges which are paid by the airliners, including taxes, the market price of this, etc. It forms around 60% or generally around more than half of the ticket price itself. And the problem within this itself is that because the VAT attracts a central excise as well as the VAT, these two are not provided as input to tax credit under GST, because if the GST is not applicable, there is no GST rate on this, right? Naturally, there is no input tax credit provided for these particular products. So ITC is not provided on this particular fuel, and as a result of this, the airlines will basically transfer this particular tax to the customer who is actually using their services, and that is one of the reasons why these particular the ticket prices are very high. That is the second point. Third very important point: in recent times, as already mentioned, crude oil prices are inching upwards; they are increasing, and we get ATF as one of the components out of the crude oil itself.
And if the crude oil prices remain very high or increase because of various international issues that are taking place, it will become very difficult for these particular airlines to provide the same services without increasing the ticket prices. And as such, already civil aviation market is one of the battered sectors within the Indian economy thanks to pandemic, and that would create so many problems for the whole economy, specifically civil aviation sector as such. So in order to address all of these particular issues, the finance minister very recently announced that in the upcoming GST council meeting, she would propose inclusion of the fuel products starting with aviation turbine fuel. Now some of you might be thinking, sir, there are so many fuel products, petrol is there, diesel is there, etc. But why are they targeting ATF specifically? The ATF, please remember this, when compared to petrol or diesel, the consumption of ATF is much lower. Is okay? The consumption of ATF is much lower. For example, in the current year itself, that is for 2022, the ATF consumption is somewhere around 4 million tons, whereas the petrol and diesel are more than 25 million tons. So obviously states will not be much concerned, much worried about loss of the revenues if the ATF is brought under GST, and this could be a very good starting point to include all the fuels under GST in the coming days. And mind you, the central theme of GST is one nation, one tax. Is okay? The central theme of GST is one nation, one tax. So far we have not been able to achieve the concept of one nation, one tax. So this inclusion of ATF is basically a movement towards achieving one nation, one tax concept. So these are some of the very, very important points with respect to ATF to be included under GST. Now based on this, I've given a question here. Consider the following statements. The ATF attracts both central excise and VAT by the state. Yes, statement is true. The airlines get ITC on the taxes paid on the ATF. No, this particular statement is wrong. Right? So remember this. But a very interesting fact related to the airlines industry is that although the fuels on which they are paying the taxes both to central and state, there is no ITC provided. But the airline tickets, is okay, the airline tickets, on this the GST is applicable. On the airline tickets which are sold or which are purchased by all of us, there is a GST imposed on this. For economic class, 5% GST is applicable, and for all the other classes, the GST applicable is 12%. Okay? So first statement is true. Right option in this particular case will be option A, only one is correct.